Candlesticks, Fibonacci, and chart pattern. Trading tools. Contents. Chapter 1 Trading Psychology and Investor Behavior 1. Chapter 2 The Magic Figure 37. Chapter 3 Basic Principles of Trading Strategies 9 Fibonacci Analysis 9 Candlestick Analysis 24 Chart Pattern Analysis 32 Trend Lines and Trend Channels 41 Chapter 4 Applications of Trading Strategies 45 Double Tops and Double Bottoms 45 Fibonacci Price Corrections 52 Fibonacci Price Extensions 67 Candlestick Chart Patterns 77 3-point Chart Patterns for Trend Reversals 88 Phi Channel Applications 108 Chapter 5 Phi Ellipses 115 Basic Features and Parameters of Phi Ellipses 116 Working with Phi Ellipses on Daily Data 132 Phi Ellipses on Constant Scales 150 Working with Phi Ellipses on Intraday Data 155 Reliability of Phi Ellipses Reconsidered 162 She. Chapter 6 Merging Candlesticks 3-point Chart Patterns, and Fibonacci Tools 167 Fibonacci Price Correction Levels 168 Fibonacci Price Extensions 187 Support and Resistance Lines 195 Phi Ellipses 207 Summary 218 Some Final Remarks 221 Tutorial 227 List of Abbreviations 229 Disclaimer 231 User Manual WINPHI Getting Started 233 Index 251 Candlesticks, Fibonacci, and Chart Pattern. Trading Tools 1. Trading Psychology and Investor Behavior. The market price of a stock at any exchange never represents the company's fair value. The stock instead is trading either above or below that valuation. Over the past couple of years, the potential discrepancy between market capitalization and fair value became painfully obvious to investors. Supported by analysts' unrealistic price forecasts, many high-tech stocks reached untenable high prices and then, in some instances, became worthless because there was no real value behind these companies. In general, the market price fluctuates higher or lower around the fair value, depending how the market sentiment values the company. Guidelines for investors. In the following sections, we list some rules that can help investors improve their investment decisions. These guidelines come from our experience and are not necessarily based on new theories. 1. Know yourself. If you start sweating when you watch the price swings of a product you have invested in, you either have the wrong trading concept, are in the wrong products, or your positions are too big. 2. Put your ego aside. The biggest losses happen after investors make their first big profits. If you accumulate profits with a proven, tested investment strategy, you can pride yourself on its success. However, if you make profits without an investment strategy, you may lose not only all your profits but your total investment. Unexpected price moves do not have to mean big losses, they occur because investors work with the wrong trading concept. 3. Hoping and praying do not guarantee success. Many traders keep repeating the same mistake, they take small profits and let the losses run. The main reason to work systematically with an investment concept is to get the best average performance. This requires placing a stop loss with every trading position and calculating the profit target when opening a position. Hoping that losses will become profits by waiting a little bit longer is gambling. It might be appropriate once in a while, but in the long run, it ruins every account. 4. Investors must learn to live with losses. It is easy to enjoy profits, but everyone hates losses. A market price that drops below the entry price is not the only reason for a loss. If a position with a 100% profit is liquidated at the entry price, this is also a big loss in the account, although it may not seem as damaging. 5. Never double your losses. Dollar cost averaging is one of the best strategies for investors if they execute it systematically as part of a long-term strategy. Almost all huge bankruptcies in trading companies worldwide happened because they doubled up losing positions. Hoping to recover losses through additional leverage never works unless someone is really lucky. 6. Know your pain level. Investors create their biggest problems when they change their investment strategy without sufficient reason. The trouble begins when traders jump from one trading strategy to another to follow the short-term sentiment, mainly because a product seems to have changed. Each investment strategy has its advantages and disadvantages. Someone who has expertise in picking stocks should continue to use this approach, despite the risk of big drawdowns. A perfect trading concept does not exist, unless someone has discovered a niche product and keeps quiet. At the same moment that this niche market becomes common knowledge, the profit potential disappears. Each investment strategy has a predetermined pain level that investors can identify. It is important to know this pain level before executing an investment strategy. 7. Diversify the risk. No matter how promising the future of a product may seem, diversify the risk. Many traders profitably trade the same product every day and are especially successful in intraday trading. But these traders are disciplined and have specific product knowledge that is not available to most people. In general, diversifying the risk with a systematic trading approach will result in a much more stable equity curve than investing in a single product. 8. Making money by trading is hard labor. Many people believe that it is easy to make money by investing in stocks, bonds, stock index futures, or commodities. The opposite is true. Investors who show quick profits through trading either have inside information or are remarkably lucky. Average investors have neither of these advantages. All traders must develop a personal profile of risk preference and find a systematic trading style that fits the profile. Then they have to execute it. Months or years of systematic trading may be necessary for real-time trading results confirm that the trading concept works. 9. Intuition versus execution of a tested trading concept. All of the information that comes over the tickers, from newsletters, and through the internet is already old when we receive it. There will always be someone with faster access who can take advantage of that information. Speculating with this old information is dangerous. Trading concepts that have been tested and have good historical track records on paper provide valid information only if the advisor is willing to share how the trading concept works. Real-time trading records are only reliable if market behavior does not change. Many of the successful fund managers in the 1980s did less well in the 1990s because the market patterns were very different. Investors must be highly skilled to identify trading concepts that did not perform well in the past but will perform well in the future. 10. The importance of a trading plan. The secret of success on the exchanges is not to make money fast, but to make it consistently. One of the most difficult accomplishments for traders is to create a portfolio that builds up equity over the long term, independently of market conditions. To reach this goal, it is essential to work with a reliable investment strategy and to guard against being greedy. 11. Feel comfortable with your trading strategy. Successful traders begin the morning with a trading concept that they can use comfortably for executing trading signals throughout the day, no matter what the markets are doing. Feel good about your trading strategy as long as the real-time trading results are in line with the historical test results. If the maximum drawdown gets bigger than the drawdown of the historical test results, reevaluate the trading concept. 12. Nothing is more important than discipline. Discipline is always the most important attribute of successful traders. Many traders fail or have limited success because they cannot control their emotions and execute their established trading strategy in any given market situation. 13. Value of available trading concepts. Many worthwhile trading concepts are available, but none of them will always make money. An effective trading concept does not have to be difficult, but it must be executable. The trader has to believe in it and be willing to trade it even after a string of losses. 2. The magic. Figure 3. In presenting Fibonacci trading tools, candlesticks, and chart price patterns, we concentrate on the ones that have a high analytical value and can be combined with each other. Our goal is to avoid information overflow, while providing adequate detail, because all of the strategies can be important in different market situations. A key question is whether all of these patterns have a common denominator. The answer is a definitive yes, all of them include the figure 3. 3 waves in price extensions. 3 waves as the basic structure of the phi ellipse. 3 peaks and valleys in triple top-bottom chart patterns. 3 peaks and valleys in head and shoulder formations. 3 peaks or valleys in symmetrical, ascending, or descending triangles. 3 rising valleys and 3 falling peaks formations. 3 peaks or valleys in rectangles, flags, wimples, wedges, and other chart formations. 7. Traders who analyze only chart patterns that feature the figure 3 and eliminate all other formations may lose some price moves, but their overall analysis will be safer and more accurate because they will know what to look for on the price charts. The biggest advantage of this approach is that most investors can identify patterns and execute corresponding trading strategies with or without a computer. Figure 2.1 shows 8 relevant chart patterns based on the figure 3. Figure 2.1 chart patterns including the magic figure 3. As explained in the following chapters, the phi ellipse is the best trading instrument for daily and intraday trading. What makes this trading tool interesting and unique is its ability to surround most chart patterns that include the figure 3. Whenever we can integrate chart patterns into the phi ellipse, it allows us to work with only one trading tool. This is why in this book we focus on trading tools that have similar characteristics, and many times we identify the same turning points or breakouts, but from a different perspective. 3. Basic principles of trading strategies. This chapter focuses on the key principles of 4 successful trading strategies. 1. Fibonacci principles, 2. Candlestick formations, 3. Chart patterns, and 4. Trend lines and trend channels. The analysis is simple and concise, but nonetheless provides readers with all of the tools and insight required to apply the trading strategies discussed later in the book. Fibonacci analysis. Fibonacci 1170-1240, an Italian merchant, became famous in Europe because he was also a brilliant mathematician. One of his greatest achievements was to introduce Arabic numerals as a substitute for Roman numerals. He developed the Fibonacci summation series, which runs as follows: 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144. 9. The mathematical series tends asymptotically, approaches slower and slower toward a constant ratio. This is an irrational ratio, however, it has a never-ending, unpredictable sequence of decimal values stringing after it and can never be expressed exactly. If each number, as part of the series, is divided by its preceding value, e.g., 13 divided by 8 or 21 divided by 13, the operation results in a ratio that oscillates around the irrational figure 1.618033988875, being higher than the ratio one time and lower the next. We will never know, into infinity, the precise ratio even with the powerful computers of our age. For the sake of brevity, we refer to the Fibonacci ratio as 1.618 and ask the reader to keep the margin of error in mind. This ratio had begun to gather special names even before Luca Pacioli, 1445-1514, another medieval mathematician, called it divine proportion. Among its contemporary names are golden section and golden mean. Johannes Kepler 1571-1630, a German astronomer, referred to the Fibonacci ratio as one of the jewels in geometry. Algebraically, it is generally designated by the Greek letter phi. Phi equals 1.618. And it is not only phi that is interesting to scientists and traders. If we divide any number of the Fibonacci summation series by the number that follows it, e.g., 8 divided by 13 or 13 divided by 21, the series asymptotically gets closer to the ratio phi, with phi equals 0.618. This is a remarkable phenomenon and a useful one when designing trading tools. Because the original ratio phi is irrational, the reciprocal value phi to the ratio phi necessarily is also an irrational figure, which means that again there is a slight margin of error when calculating 0.618 in an approximated, shortened way. We have discovered a series of plain numbers that can be applied to science by Fibonacci. Before we try to use the Fibonacci summation series to develop trading tools, it is helpful to consider its relevance in nature. It is then only a small step to reach conclusions about the relevance of the Fibonacci summation in international market movements, whether in currencies or commodities, stocks or derivatives. Humans subconsciously seek the divine proportion, which is nothing but a constant and timeless striving to create a comfortable standard of living. The Fibonacci summation series in nature and geometry. It is remarkable how many constant values can be calculated using Fibonacci's sequence, and how often the individual numbers of the sequence recur in myriad variations. This is not just a numbers game, however, it is the most important mathematical representation of natural phenomena ever discovered. Generally speaking, the Fibonacci summation series is nature's law, and it is a part of the aesthetics found in any perfect shape or curve. Fibonacci discovered how nature's law related to the summation series when he proposed that the progeny of a single pair of rabbits increased in a repeatable pattern. Suppose there is one pair of rabbits in January, which then breed a second pair of rabbits in February, and, thereafter, these offspring produce another pair every month. The mathematical problem is to find how many pairs of rabbits there will be at the end of December. To solve this little algebraic puzzle, we tabulate the data in 4 columns. 1. The total number of pairs of breeding rabbits at the beginning of each given month. 2. The total number of pairs of non-breeding rabbits at the beginning of each month. 3. The total number of pairs of rabbits breeding during each month. 4. The total number of pairs of rabbits that have been bred at the end of 12 months. Table 3.1 shows the progression to the total number of rabbits, based on the 4 criteria. Table 3.1 Progeny of a single pair of rabbits month 1, 2, 3, 4. January 0101, February 1012, March 1113, April 2125, May 3238, June 53513, July 85821, August 138, 1334, September 21, 1321, 55, October 34, 2134, 89, November 5534, 55, 144, December 89, 55, 89233. Source: The New Fibonacci Trader Workbook, by Robert Fisher, New York, Wiley, 2001, p. 20. Each column contains the Fibonacci summation series, formed according to the rule that any number is the sum of the pair of immediately preceding numbers. One needs only to look at the beauty of nature to appreciate the relevance of the Fibonacci ratio phi as a natural constant. The number of axils on the stems of many growing plants and the number of petals on flowering plants provide many examples of the Fibonacci ratio and underlying summation series. The following illustrations depict some interesting applications of this mathematical sequence. Fibonacci numbers found in plants. The sneezewort, a Eurasian herb, is an ideal example of the Fibonacci summation series in nature. For every new branch springs from the axil and more branches grow from a new branch. Adding the old and the new branches together reveals a number of the Fibonacci summation series in each horizontal plane. Figure 3.1 illustrates the count. Figure 3.1 Fibonacci numbers found in the flowers of the sneezewort. Source: The New Fibonacci Trader Workbook, by Robert Fisher, New York, Wiley, 2001, p. 4. According to the same algebraic principle, we can easily identify Fibonacci summation series in plant life, so-called golden numbers, by counting the petals of certain common flowers. Taking the iris at 3 petals, the primrose at 5 petals, the ragwort at 13 petals, the daisy at 34 petals, and the Michaelmas daisy at 55 and 89 petals, one must question whether this pattern is accidental or a particular natural law. Rule of alternation in the sunflower. The beautiful curving lines of the sunflower have existed naturally throughout thousands of centuries, and mathematicians have made them a subject of study for hundreds of years. The sunflower has two sets of equiangular spirals superimposed and intertwined, one turning clockwise and the other turning counterclockwise. There are 21 clockwise and 34 counterclockwise spirals. Both numbers are part of the Fibonacci summation series. The order is closely related to the rule of alternation, which Elliot used in his wave principles to explain human behavior. See Figure 3.2. Figure 3.2 The rule of alternation shown in the sunflower. Source: The New Fibonacci Trader Workbook, by Robert Fisher, New York, Wiley, 2001 p. 5. Geometry of the golden rectangle and the golden section. The famous Greek mathematician Euclid of Megara 453–70 BC was the first scientist to write about the golden section and to focus the analysis of a straight line. The more complex structure of the geometry of a golden rectangle is shown in Figure 3.3. The ratio of the long side of the rectangle divided by the short side of the rectangle has the proportion of the Fibonacci ratio 1.618. Figure 3.3 Geometry of the golden rectangle. Source: The New Fibonacci Trader Workbook, by Robert Fisher, New York, Wiley, 2001 p. 7. Parthenon Temple in Athens. The proportions of the Parthenon Temple in Athens bear witness to the influence of the golden rectangle as well as the golden section on Greek architecture. The proportions of the Parthenon Temple fit exactly into a golden rectangle. Its total width is exactly 1.618 times its height. See Figure 3.4. Figure 3.4 Parthenon Temple in Athens. Source: The New Fibonacci Trader Workbook, by Robert Fisher, New York, Wiley, 2001 p. 7. Other geometric curves that are important to humankind are plentiful in nature. The most significant to civilization include the horizon of the ocean, the meteor track, the parabola of a waterfall, the arc that the sun travels in the sky, the crescent moon, and the flight of a bird. Many of these natural curves can be geometrically modeled using ellipses. The latter finding leads into a brief description of trading tools that use the Fibonacci ratio. A basic knowledge of the construction and functions of these tools is necessary to understand the trading strategies that are introduced later in this book. Introduction of the Fibonacci trading tools. Corrections. In general, for corrections with Fibonacci-related trading tools, an impulse wave that defines a major market trend upward or downward will have a corrective wave before the next impulse wave reaches new territory. This occurs in both bull market and bear market conditions. Analysis would be easy if we could detect a single general pattern of corrections. The problem is that there can be many more price patterns than impulse waves in the commodities, futures, stock index futures, stocks, or currency markets. Markets move sideways for a longer period than an impulse wave appears. We can never predict which of the next waves will be an impulse wave instead of another false move in continuation of a sideways market. Therefore, every serious trading approach using corrections has to be designed to survive even the longest sideways market correction phase. No market pattern can assure a profitable trade. At any time, we can be in a correction of an impulse wave or at the beginning of a new impulse wave. Trading with corrections is a trend-following strategy. It is based on the assumption that after a correction of an impulse wave up or down, the next impulse wave will follow in the direction of the first impulse wave after the correction is finished. Thus, we generally expect a minimum of a 3-swing price move, and in many cases, this assumption is correct. Therefore, working with corrections is a valid investment strategy, and it is discussed in detail later in this book. Corrections work equally well long or short, to the upside or downside of the markets. The worst thing that can happen in trending markets is that the market may run away without correcting enough and without leaving a valid signal. Markets moving sideways involve the risk of the trader getting stopped out in a streak of losing trades if the strategy's parameters are too restrictive. Trading with corrections is a short-term strategy. The goal is to have many trades, of which a large number are profitable. Likewise, there should be a low number of losing trades, and these should be small losses. Corrections are closely related to the Fibonacci ratios through the swing size and the volatility of a product. Which ratio to choose depends on the product and the time interval selected. Weekly data might need different ratios from daily or intraday data. The safest way to find the best ratio for products and time spans is to test them on historical data with a computer. The most common approach to working with corrections in research and practical trading is to relate the size of a correction to a percentage of a prior impulse wave. For Fibonacci's phi, the following prominent percentages of possible market corrections can be derived directly from the ratios 0.618, 1.000, and 1.618 of the phi series. 38.2% as the result of the division 0.618 divided by 1.618. 50.0% as the transformed ratio 1.000. 61.8% as the result of the immediate ratio 1.000 divided by 1.618. Figure 3.5 shows the different risk profiles when trading alternative percentages of corrections with stop-loss protection. Figure 3.5 different stop-loss risk profiles on investments into a correction of 38.2% and a correction of 61.8%. Forecasting the exact size of a correction is an empirical problem. Investing after a correction of just 38.2% might be too early, whereas waiting for a correction of 61.8% might result in completely missing a strong trend. But no matter what corrections are considered, traders should focus on the phi-related sizes. Price extensions in three-wave patterns. Price extensions are exuberant price movements that result from runaway markets, opening gaps, or limit moves, up or down, at high volatility. Most extensions occur when unexpected news, such as weather information, crop reports, or interest rate announcements by the Federal Reserve Board, reverse major market trends within seconds. When news runs counter to investors' expectations, market situations emerge with strong trading potential. However, investors can only take advantage of these situations if they follow sensible, definitive rules in carrying out analysis. Extensive market moves can be very dangerous for investors who get caught by surprise with a wrong position in the marketplace. Extensions take place primarily in the third wave of a three-wave price pattern. In a regular three-wave pattern in an uptrend, the correction does not go lower than the bottom of wave 1. In extensions out of a bear trap formation of irregular bottoms, the correction can go lower than the low of the first impulse wave opposite in a bull trap. The two basic chart formations for price extensions are illustrated in Figure 3.6. Figure 3.6 extensions out of a regular three-wave pattern and a bear trap chart formation. Exploring price extensions means investing against major trend directions. Working with extensions also suggests that an investor is looking for quick profits by taking advantage of imbalances in the marketplace. Therefore, it is important to know in advance not only when to enter a position, but also when to exit it. Entry rule, stop-loss rule, and profit target always must be integrated to achieve long-term investment strategies that are consistently profitable. 3 consecutive analytical steps are needed to calculate price targets in price extensions of the third wave out of a three-wave chart formation. 1. A minimum swing size has to be defined for the sizes from peak to valley or valley to peak of the first impulse wave of the three-wave pattern. 2. The swing size has to be multiplied by the Fibonacci ratio 1.618. 3. The resulting value is added to the size of the initiating swing to define the price target. Figure 3.7 illustrates these steps. Figure 3.7 Extension in the third wave of a three-wave pattern uptrend. Target level measured by the Fibonacci ratio phi equals 1.618. Sophisticated investors who want to explore fast markets can easily follow the basic principles of extensions in three-wave patterns and extend the rules into five-wave price patterns. Price extensions in five-wave patterns. When analyzing price extensions in a 5-wave pattern, we look for an additional parameter from the Fibonacci summation series to confirm our price target calculation for extensions out of a 3-wave pattern based on the 1.618 ratio. To analyze a 3-wave price pattern, we multiply the size of the first impulse wave by the Fibonacci ratio 1.618. The product is then added to the swing size of the initial move to calculate the Fibonacci price target line. It is at this Fibonacci price target line that we expect the third wave to reverse. Because there are usually more than 3 waves in a trending market, we need to modify our calculations for the Fibonacci target price. The most common price pattern has at least 5 waves, 3 impulse waves and 2 corrective waves. A target price line in a typical 5-wave market price pattern is shown in Figure 3.8. Figure 3.8 Calculation of Fibonacci price target in a regular 5-wave move. In a regular 5-wave move in an uptrend, the price target line for the end of wave 5 is calculated by multiplying the amplitude of wave 1 by the Fibonacci ratio 1.618, and then multiplying the amplitude from the bottom of the wave to the top of wave 3 by the reciprocal value to the Fibonacci ratio 0.618. In a downtrend pattern, we also multiply the initial swing size by 1.618 and multiply the amplitude from the high of wave 1 to the low of wave 3 by the ratio 0.618. By combining the two calculations, using ratios 0.618 and 1.618, we can recalculate the end of wave 5 at the same price, given that the market moves in a regular price pattern as described. In practical terms, however, this is seldom the case. Instead of finding the same price level with both ratios, we get two price levels that are closer together or wider apart, depending on the amplitudes of wave 1 and wave 3. We find an upper and lower price target, defined as a Fibonacci price target band. Do we know whether this price forecast will ever be reached? Absolutely not. But we know in advance whether the price band calculated at 1.618 times the size of wave 1 and at 0.618 times the distance from the top or bottom of wave 1 to the bottom or top of wave 3 will be close together or far apart. If the price target band is far apart, we do not use it for the analysis. A band is worth consideration if its upper and lower levels are close together in relation to the underlying swing size of the initial move of the first impulse wave. Phi ellipses. The phi ellipse is an almost unknown trading tool that is closely related to the Fibonacci ratios. This tool surrounds price moves and makes investors' behavior visible for analysis on any kind of data. Because swing formations are easy to identify and integrate into computerized trading environments, traders or managers investing in smaller accounts often use peak and valley formations. Many profitable trades are possible, as long as there are regular wave patterns and each impulse wave defines new highs or new lows by a wide margin. In multiple corrections with many false breakouts, however, swing systems have little use because exogenous factors like slippage and commission can consume all of the system's small profits. Adding the time element to the analysis of market moves immediately changes the conditions by filtering out noise and increasing the stability of investment strategies. This is where phi ellipses come in. Working with phi ellipses can be difficult. The basic structure is simple, but because price patterns may change over time, the final shape of a phi ellipse also may vary. What makes phi ellipses so interesting is that they can identify underlying structures of price moves and can circumvent price patterns. When a price pattern changes, the shape of the phi ellipse circumventing the respective market price pattern changes too. We find long and short phi ellipses, fat and thin phi ellipses, and even phi ellipses that are flat or have a steep angle. There are very few market price moves that do not follow the pattern of the phi ellipse. Phi ellipses are related to the Fibonacci ratio. Generally speaking, the ratio of major axis A to minor axis B defines the shape of an ellipse. Ellipses are turned into phi ellipses whenever the ratio of major axis to minor axis is a member number of the phi series. To make phi ellipses work as devices for chart analysis, we have applied a proprietary transformation to the mathematical formula that describes the shape of the ellipse. We still consider the ratio of the major axis A to the minor axis B of the ellipse, but in a Fisher transformed way. Phi ellipses are instruments for investments that represent a countertrend to market actions. Thus, we observe whether a price move stays within a phi ellipse and invest accordingly if a price move breaks out of a phi ellipse at the very end. To draw a phi ellipse correctly, 3 points are necessary, the starting point and 2 side points. It is possible to draw the phi ellipse if the second impulse wave is at least as long as the first impulse wave. This principle is shown in Figure 3.9. Figure 3.9 Phi ellipse circumventing a 3-wave price pattern. After identifying the points A, B, and C in the typical 3-wave swing, we can position the phi ellipse around these points. Wave 1, from A to B, is an impulse wave. Wave 2, from B to C, is the corrective wave to the impulse wave. For wave 3, we expect a second impulse wave in the direction of the first impulse wave. This general pattern follows Elliott's wave principle and can be seen in every traded product, be it commodities, futures, stocks, or cash currencies. The fundamental structure of the phi ellipse provides another way to analyze price moves. What makes it unique is that it is dynamic over time and follows price patterns as they develop. That is why it is necessary to be patient and wait, from the very beginning to the very end, until a price move stays within the phi ellipse. Traders can take action as soon as the market price moves out of the phi ellipse, but only if a price pattern runs completely inside until reaching the final point. There are several ways to invest against the market trend at the end of the phi ellipse. Enter a position when the market price breaks the outside line of the phi ellipse. Enter a position based on a chart price pattern that forms at the end of the phi ellipse. Enter a position when the market price moves out of the outside line, which is parallel to the median line of the phi ellipse. Selling at the end of a phi ellipse is recommended when the phi ellipse has an upward slope. Buying at the end of a phi ellipse is recommended when the phi ellipse has a downward slope. An entry rule confirms trend reversals to the upside or downside at the end of a phi ellipse. The rule is set to the lowest low of the previous 1, 2, 3, or 4 days for sell signals, and the highest high of the previous 1, 2, 3, or 4 days for buy signals. The choice of entry rule depends on investors' risk preference and how early they want to be invested. In the example shown in Figure 3.10, we choose the conservative option of a double confirmation by phi ellipse and trend channel. With this option, we may give up some of the profit potential that we could have realized with a more sensitive entry rule. On the other hand, we avoid losing trades in strong trending market conditions by staying in the trend as long as it lasts. Figure 3.10 Short entry on a combination of phi ellipse and trend channel S, entry short. As a standard rule, when 3 little phi ellipses can be surrounded by a bigger phi ellipse, it is often a signal of an important turning point. See Figure 3.11. Figure 3.11 Short entry on a large phi ellipse circumventing 3 smaller phi ellipses S, entry short. Phi ellipses work on monthly, weekly, daily, and intraday charts. However, to avoid complicating the analysis at this point, we defer integrating phi ellipses on sets of intraday data and describe intraday samples in a later chapter. Summary. In this section, we have explained the basics of 3 trading concepts: price corrections, price extensions, and phi ellipses. We have concentrated on these Fibonacci-related trading tools because they are easy to understand and combine well with the candlesticks and price patterns that are described next in this chapter. The interested reader can find more detailed information in our book The New Fibonacci Trader, New York, John Wiley & Sons, 2001. Candlestick analysis. Even though the structure of candlesticks is different from that of bar charts, it is easy to combine candlesticks with the technical chart analysis. By focusing on the relationship between open and close prices, candlesticks show how market forces change during market hours. This often indicates the short-term momentum in different products or markets. In this section, we describe basic candlestick charting and chart analysis. We concentrate on the most meaningful patterns for traders. Combining candlestick charts with Fibonacci trading tools and chart patterns is an effective strategy because every combination is based on the same principle, the analysis of investor behavior as X pressed through the Fibonacci ratios, candlesticks, or chart patterns. Structure of candlestick charts. Candlestick charts are based on the same market data as regular bar charts but present that data in a different way. The components of candlestick charts are the opening price level, the closing price level, the high price, and the low price of any data compression rate, be it weekly, daily or intraday data. Figure 3.12 shows the composition of a candlestick. Figure 3.12 Constituents of candlesticks. The relationship between the open price level and the close price level forms the body of the candlestick chart. If the close is below the opening, the body is black. If the close is above the opening, the body is white. The opening and closing price of every data compression, weekly, daily, or intraday is, therefore, important for analysts who use candlestick charts. The price moves above and below the candlestick body are called the shadow. Depending on how large the distance is between high and low of a price bar to the body of the candlestick, the shadows can be long or short. In Figure 3.13, we compare a bar chart and a candlestick chart based on the same open, high, low, and close data. Figure 3.13 Bar charting technique and candlestick charting technique in comparison. Analysis of selected candlestick formations. Most candlestick formations identify either a slowdown in a market trend or a trend reversal. It is important to understand that there is a close relationship between reversal candlestick patterns and reversal patterns in the chart analysis. For example, a key reversal day in the chart analysis can also be shown in the candlestick analysis by using a bullish belt hold or a bearish belt hold. Traders like working with candlestick charts because they show investor behavior in a different, but simple, price picture that is easy to combine with other trading tools. Candlestick charts can be analyzed without any time lag, and investor behavior can be examined just by looking at the relationship between the open, high, low, and close at every price bar. The following candlestick chart patterns are seen often and combine well with the Fibonacci trading tools. The interested reader will find many books that describe candlestick patterns in detail. Hammer and Hanging Man. A candlestick chart pattern is called a hammer if it has a long shadow and a small body, black or white, that is very close to the high of the day. At the end of a downtrend, the hammer is considered a bullish reversal signal. Figure 3.14 Hammer and Hanging Man. Hammer and hanging man should both have a long shadow. Ideally, the shadow should be about 3 times as long as the body. The long shadow shows that the market price dropped very sharply after the opening and then recovered at the end of the trading session. The opening and closing price should be close together, which will result in a small body on the candlestick chart. At the end of an uptrend, the same candlestick chart pattern is called a hanging man. The hanging man is also a reversal pattern. To get a sell signal, the market price should trade below the lowest low of the hanging man in the following days. It might be even safer to wait until the close of a day is below the lowest low of the hanging man candlestick pattern. See Figure 3.14. Bullish and bearish belt hold. The bullish belt hold is a candlestick formation with a wide body, which means that the opening price was very low, the market started a rally, and the closing price is very high. The opposite holds true for the bearish belt hold. In this case, the opening price is very high and the closing price is very low. The bigger the body in the belt hold candlestick pattern, the more important is this pattern for a trend reversal. Figure 3.15 Bullish and bearish belt hold. If the opening price of the next day is higher than the bearish belt hold candlestick pattern, it is likely that the market will go higher. On the other hand, if the opening price of the next day is below a bullish belt hold, traders can expect that the market will continue to go lower. See Figure 3.15. Bullish and bearish engulfing pattern. While hammer and hanging man as well as bullish and bearish belt hold are single candlestick formations consist of one candlestick, the bullish and bearish engulfing patterns always need a pair of candlesticks to complete the pattern. Figure 3.16 Bullish and Bearish Engulfing Pattern. The bullish engulfing pattern is a reversal pattern at the end of a downtrend. This formation is completed when a large white candlestick body completely covers a smaller black candlestick body from the previous day. It is not important that the big, white candlestick body covers the shadow of the previous day as well. A bearish engulfing pattern is important at the end of an uptrend. In this case, a big black candlestick body covers a small white candlestick body of the previous day. See figure 3.16. Harami pattern and Harami cross. The Harami pattern needs two candlesticks and is the exact opposite of the engulfing pattern. In the traditional bar chart analysis, the Harami pattern is called an inside day. Figure 3.17 Harami pattern and Harami cross. The Harami pattern has a small body, black or white, that fits completely into the big, black or white body of the previous day. It is not important whether the shadow of today's small candlestick pattern goes higher or lower than the previous candlestick shadow. The Harami pattern has greater importance if, at the end of a downtrend, today's small candlestick body is white, whereas the big candlestick body of the previous day is black. The reversal signal is even stronger when today's candlestick body is very small. The Harami pattern can be a bullish signal after a downtrend or a bearish signal at the end of an uptrend. The Harami cross is a special kind of Harami pattern. In this candlestick pattern, today's candlestick body is very small, which means that the opening and the closing price are almost identical. See figure 3.17. Doji pattern. The doji pattern identifies when the momentum of markets is slowing down. Doji candlesticks have a very small body. Opening and closing prices of the day are almost identical, and there is a long shadow either above or below the candlestick body. Figure 3.18 Doji pattern. Doji patterns are only interesting at the end of longer upswings or downswings. They have more importance when there is an engulfing pattern on the following day. See figure 3.18. Piercing pattern and dark cloud cover. The piercing pattern looks much like the bullish engulfing pattern and is only valid at the end of a downtrend. While in the bullish engulfing pattern, the large white body of today's candlestick covers the small black candlestick body of the previous day, the piercing pattern is similar. Figure 3.19 Piercing pattern and dark cloud cover. A valid signal with a piercing pattern is generated when today's big, white candlestick body covers at least 50% of the previous day's black candlestick body. The more the body of the piercing pattern covers the candlestick body of the previous day, the stronger is the reversal signal. The candlestick formation of a dark cloud cover is important as a reversal signal at the end of an uptrend. In this case, the big, black body of the dark cloud cover has to cover at least 50% of the previous day's white candlestick body. The more the candlestick body of the dark cloud cover pattern covers the candlestick body of the previous day, the stronger is the reversal signal. See figure 3.19. Morning star and evening star. In a star candlestick formation, a small candlestick body, black or white, is separated through a price gap from the candlestick body of the previous day. See figure 3.20. Figure 3.20 Morning star and evening star. The body of the star can touch the shadow of the previous day's candlestick pattern, but it does not touch the body. If the star does not have a small body, but is a doji, opening and closing price are almost identical, the candlestick pattern is a doji star. Star and doji star are warning signals for an imminent trend reversal. A morning star is a bottom reversal pattern formed by three candlesticks. The first candlestick has a big black body, for this is still a downtrend. The second candlestick is a star with a very small body that is below the previous candlestick and has no connection to the previous body. The third candlestick has a big, white body that should cover at least 50% of the big black body from 2 days ago. In the ideal form, the third candlestick body should trade with a gap to the body of the star of the previous day. Should the third candlestick be an engulfing pattern, this is also a valid trend reversal signal. An evening star is a trend reversal pattern after a strong uptrend. This formation also has three candlesticks. The first has a long white body. The following candlestick is a star with either a black or white body that has no connection with the previous candlestick body. The third candlestick has a big black body that covers at least 50% of the big black body from 2 days earlier. Between the body of the star and the last big black body, there also should be a gap. If there is a bearish engulfing pattern, this constellation has a valid trend reversal signal as well. Summary. When working with candlestick patterns, traders look for indications of short-term trend reversals. The unique structure of candlesticks makes them a convincing and easily managed charting technique. Trend changes are much more visible on candlestick charts than on regular bar charts. Chart pattern analysis. Analysts, investors, and traders often ask how to determine where a trend comes to an end. The Fibonacci trading tools and the candlestick patterns provide two significant ways to answer this question. Chart patterns are a third method for analyzing trends. We try to integrate Fibonacci trading tools, candlestick patterns, and chart patterns because, as mentioned, they are all based on the most important element that moves the markets, investor behavior. The study of chart patterns has gone on for at least a century, and analysts have written many excellent books about this topic over the past decades. Today, many traders prefer to focus on technical indicators that are computer-driven and are based on complex mathematical formulas. But computer models have yet to prove that they can consistently outperform pattern recognition as an analysis approach. The following chart patterns are well known, have a high analytic value, and can be combined with other trading tools described in this book. Selected reversal chart patterns. The most common reversal chart patterns share three characteristics. 1. They form at the end of an uptrend or downtrend. 2. The bigger the chart formation, the bigger is the following reversal. 3. In general, chart formations on tops are shorter and have a bigger volatility than bottom formations. Double top and double bottom. The most common chart patterns are double top and double bottom formations. Since double tops and double bottoms occur frequently in small price moves, their forecasting value is somewhat limited. The reliability of double top and double bottom formations increases with the selection of bigger underlying swing sizes. Figure 3.21 Double top and double bottom. Figure 3.21 illustrates ideal price moves that lead to double top and double bottom formations. As shown in the price patterns in this figure, the double top formation with peaks at points 1 and 3 is completed only when the valley at point 2 between peaks 1 and 3 is broken on the downside based on a closing price. As an exception, it can happen that the second peak at point 3 is higher than peak 1. A false breakout is an early indication of a trend change. The maximum swing size can be used as an initial profit target. Triple top and triple bottom. Triple top and triple bottom chart patterns are based on the notion that three tops or three bottoms can be found almost at the same price level. The forecasting value is the greatest if there is a good symmetry between the peaks and the valleys. Ideally, the distance is the same from the middle peak or valley to the peaks or valleys to both the left and right. See Figure 3.22. Figure 3.22 Triple top and triple bottom. A triple top chart formation is completed when the low, which is before the third peak, is broken on a close basis. If the third peak in a triple top formation is a false breakout, this is a strong indication of a trend change. The total distance between the peaks and valleys can be used as the initial profit target. Head and shoulder formation. The head and shoulder formation is the best indication for a trend change. It looks much like the triple top and triple bottom formation. The only difference is that in a chart formation at the end of an uptrend, peak 3 in the middle is higher than peak 1 on the left side and peak 5 on the right side. Ideally, the right and left shoulder should be on the same height or at least close together. The connection between valley 2 and valley 4 is called the neckline. Figure 3.23 shows a typical head and shoulder formation consisting of 3 peaks and 2 valleys with the highest peak in the middle. Figure 3.23 Head and shoulder formation. The head and shoulder formation is completed if the neckline from Valley 2 to Valley 4 is broken on a close basis. After a breakout, the initial profit target is the distance from the lowest valley to the highest peak of the head and shoulder formation. 3 falling peaks are 3 rising valleys. The formations of the 3 falling peaks or the 3 rising valleys are seldom recognized, although they have a clear structure and high analytic value. See Figure 3.24. Figure 3.24 3 falling peaks formation and 3 rising valleys formation. We get a short signal if the market closes below the second valley, which is located between the second and third peak. We get a buy signal if the market closes above the second peak, which is located between the second and third valley. As the initial profit target after a short signal, we can take the distance between the highest peak and the lowest valley. This chart formation works equally well for buy and sell signals. Key reversal day. To identify a key reversal day, we need fast-moving markets either up or down, based on continuing good or bad news. After a strong bull market that carries a product into new high territory, there are no more trend or resistance lines, but many investors have huge open profits in their accounts. If there is any bad news, there will be panic selling to protect at least part of the open profits. These price moves can be extreme in products with limit up or limit down facilities. See Figure 3.25. Figure 3.25 Key reversal day. The other formations where key reversal days can be important are false breakouts, especially in combination with triple top and triple bottom formations. If in a triple top formation, the third peak is a false breakout, this will show up many times in a key reversal day. Chart patterns can pinpoint major trend changes in the markets. In addition, some price patterns can identify trend moves that are only interrupted for a short sideward interval and then continue in the original trend direction. Price patterns of the latter type are the so-called continuation patterns, selected continuation patterns, symmetrical, ascending, and descending triangles. A symmetrical triangle has 2 merging trend lines. For this formation, at least 2 peaks and 2 valleys are necessary. To reduce false breakouts, investors should wait until there are either 3 peaks and 2 valleys or 3 valleys and 2 peaks. With this approach, however, it is possible to completely miss a trend. To receive a valid signal, a closing price has to be above the resistance line or below the support line. The more the price moves to the very end of a triangle, the weaker will be the breakout in either direction. Figure 3.26 covers the 3 alternative chart patterns that are based on triangle formations. In an ascending triangle, the resistance line runs parallel while the support line is rising. To avoid false breakouts, we again recommend waiting for 3 peaks or 3 valleys, respectively. And again, the price to pay for more safety in trading is sometimes missing a trade. We get a signal when the closing price is either above the resistance line or below the support line. Figure 3.26 clockwise from upper left, symmetrical, ascending, and descending triangle. In a descending triangle, the support line runs parallel while the resistance line falls from the left to the right side. Once more, we recommend waiting for 3 peaks and valleys even though this might result in missing a breakout. The initial profit target is the biggest distance measured from high to low of the triangle. Bullish and bearish rectangles. Bullish and bearish rectangles are usually called continuation patterns. However, they can be reversal patterns as well when they turn out to be triple top or triple bottom formations. Support and resistance lines run horizontally. To avoid false breakouts, it pays to wait for 3 peaks and valleys despite sometimes missing a breakout. See Figure 3.27. Figure 3.27 Bullish and bearish rectangle. To receive a trading signal, wait until a closing price is above the resistance or below the support line. The initial profit target is the maximum distance, the total height from high to low of the bullish or bearish rectangle. Spring and upthrust, false breakout. A spring is a false breakout from a support line. The market price trades for a very short time below the support line and then moves back above the support line in a volatile price move that opens very low and closes very high. The upthrust is a false breakout through the resistance line. The market price trades for a brief time above the resistance line and moves back below the resistance line in a volatile move that opens very high and closes very low. Spring and upthrust are shown in Figure 3.28. Figure 3.28 Spring and upthrust. Broadening formation. The broadening formation is the most difficult chart pattern to trade, for the support and resistance line are moving apart like an expanding triangle. Figure 3.29 shows price moves to the upside and downside that clarify the picture of consecutive and alternating new highs and lows before a new trend direction finally turns out. Figure 3.29 Broadening formation. A trader investing at breakouts will be stopped out at each new high or low. The only way to invest safer is to wait until there are 3 peaks or valleys. Broadening formations can often be found at long-term tops or bottoms. Flag and pennant. Normally, the flag slopes against the main trend and is near midpoint of a price move. To play safe in a bullish flag, traders should wait for the formation of 3 valleys. For a buy signal, the closing price has to be above the resistance line. To find the initial profit target, we double the price move from the bottom to the beginning of the flag. A bullish pennant is almost identical to a symmetrical triangle. The only difference is the time span. Whereas a symmetrical triangle can last a couple of months, the pennant usually does not last longer than 3 weeks. Because the pennant often happens at the midpoint of a trend, we double the price span from the bottom to the highest point of the pennant for the initial profit target. To receive a valid breakout buy signal in a bullish pennant, we wait until 3 valleys are formed. Figure 3.30 shows both chart patterns, the flag and the pennant. Figure 3.30 Flag and pennant. Wedge formation. The wedge formation looks much like the symmetrical triangle. What makes it different is its slant. The wedge formation has a noticeable slant against the prevailing trend. Therefore, a falling wedge is considered bullish, while a rising wedge is considered bearish. As in all the other formations that we have presented, we should wait for 3 lower valleys in a bullish wedge. In a bearish wedge, we should wait for 3 rising peaks. The wedge breakout occurs most often in the third part of the total length of the wedge. However, the price might go all the way to the very end of the wedge. This is one of the differences from the symmetrical triangle. Wedges take less time to form in downtrends than in uptrends. Figure 3.31 provides a graphical impression of wedge formations. Figure 3.31 Wedge formation. The initial profit target when working with wedges is measured from the highest high to the lowest low of the wedge formation. This price difference is added to or deducted from the entry price level. Summary. In this section, we have described the most important chart patterns and have paid special attention to the market price patterns that have at least 5 price waves, at least 3 peaks and 2 valleys, or 3 valleys and 2 peaks. The only exception is the key reversal day, which indicates either an instant trend change at the end of big price move or a trend change after a false breakout. Trend lines and trend channels. Human behavior and investor behavior is not only reflected in chart patterns such as large swings, small swings, or sideward markets, but to a significant degree in peak and valley formations. In addition to the patterns described in the preceding section, we have to consider constellations of peaks and valleys that lead to trend lines and trend channels. By introducing Phi channels, or Fibonacci trend channels, as independent Fibonacci trading tools, we make use of peak and valley formations in the markets and how to forecast major changes in trend directions. In this section, we first describe the general structure of regular trend channels. Then we discuss Phi channels as specific trend channels. Regular trend lines and trend channels. Every peak or valley in the markets is a prominent indicator of what the majority of investors were thinking at any particular moment in time. The significance of peaks or valleys becomes evident only through the passing of time. Intraday peaks or valleys are less meaningful than peaks or valleys monitored on a daily basis. In this section, we concentrate on daily data compression. To draw a trend channel, we need at least 3 points, 2 peaks and a valley, or 2 valleys and a peak. Figure 3.32 shows a regular 3-wave price pattern. Figure 3.32 regular trend channel. To draw a trend line between point 0 and point 2, peak 1 must be penetrated to confirm the uptrend. Once it is possible to draw the trend line between point 0 and point 2, investors can project peak 3 by drawing, through point 1, the parallel to the support line connecting point 0 and point 2. Different trend lines are used to stay as close as possible to the different degrees of a trend. When the upper channel line is broken, a new trend channel can be drawn if the market's price keeps moving higher. Figure 3.33. Figure 3.33 Continuing trend channels. A failure to reach the resistance line of the channel in an uptrend is often an early warning signal that the support line will be broken on a trend reversal at point 10, vice versa for a downtrend. Phi channels. Phi channels vary in distinct ways from regular trend channels. Initially, we can detect the same pattern structure as regular trend channels. However, instead of isolating the outside points, connecting highs with highs and lows with lows to come up with trend lines, we base phi channels on peak to valley and valley to peak connections. The baseline of a phi channel can be generated out of a 3-wave market move, as shown in Figure 3.34. Figure 3.34 Baseline of a phi channel. The baseline of a phi channel is the connection of the price move from the bottom, at point 0, to the top, at point 3. By connecting the high point 3 with the low point 0, we eliminate the biggest problem in working with regular outside trend channels, staying close enough to fast changes in price patterns. After establishing the baseline, we draw a parallel line to the baseline, using low point 2 as our outside point to the right of the price pattern. The distance from the baseline to the parallel line is the width of the phi channel, which can be used to calculate further parallels to the right based on the Fibonacci ratios. The important charting technique of getting to a set of parallel trend lines in Fibonacci distances from the phi channel is illustrated in Figure 3.35. Figure 3.35 Baseline and outside parallel line of a phi channel, and resulting trend lines in Fibonacci distances. The regular trend channels generally are used as indicators of trend market moves, not as trading tools to generate buy and sell signals. Phi channels are a good Fibonacci-related instrument to generate buy and sell signals, especially when used in combination with other trading tools, as described later in this book. Summary. Regular trend channels and phi channels are important tools for every analyst. They represent investor behavior and often indicate the support and resistance areas in the market. In contrast to regular trend lines and trend channels, which are mostly used for trend indications, phi channels can be used to generate buy and sell signals. Breakouts of phi channels lead to buy and sell signals at the outside lines of the respective phi channels. We describe phi channels in greater detail in our previous book, The New Fibonacci Trader. 4. Applications of trading strategies. In this chapter, we first briefly describe the relevant investment principles for merging candlestick charting into Fibonacci analysis. We then explain how to apply these trading strategies to market data. The discussion includes double top and double bottom formations, Fibonacci corrections and extensions, applications of candlestick patterns and important price patterns in bar charting, and finally, the advantages of using phi channels. Double tops and double bottoms. Double top and double bottom formations are the most common reversal patterns. If double top formations occur after an uptrend, they are called M formations. After a downtrend, double bottom formations are called W formations. Although most traders are familiar with these two chart patterns, it is helpful to study them because the basics covered here are applicable to more complex strategies later on. For example, tops and bottoms are very important when working with Fibonacci price corrections. 45. Basics for working with double tops and double bottoms. Double tops and double bottoms can happen in any price swing, big or small, weekly, daily, or intraday. In very small swing sizes, they may look attractive for trading. After deducting commissions and slippage, however, little profit remains in long-lasting sideways patterns. Bigger swing sizes are preferable to work with, but they have fewer trades. The ideal M formation has both peaks at almost the same level. With W formations, the same should be true for both valleys. Having the same level is not critical for success. Although the second high is slightly higher than the first high, a sell signal can be profitable if the expected swing size is reached. A double top pattern is only complete if the valley between the two peaks is broken by a daily close when working with daily data. A double top is difficult to identify if the second top is higher than the first top. It always makes traders question whether to expect a higher price or a bull trap. The following compromises may be helpful in dealing with this problem. When work with daily data, the daily close has to be higher than the first peak. The market price must go 3% higher than the first peak. Two daily highs have to be higher than the first peak. These are not optimal filters, for waiting can mean getting in very late and missing a profit opportunity. But false breakouts are costly as well and can cause big losses in an account. When the closing price is lower than the first peak in a double top formation, a false breakout can indicate a price change. Swing size. The most important determiner of success with double top or double bottom formations is the swing size that the trader chooses for analysis. The application of swing sizes that are too small will generate excessive commissions and slippage. Increasing the swing size will dramatically reduce the number of trades. Although this might not be attractive for traders who want to see action, it improves the chances for profitable trades while limiting commissions and slippage. As a rule of thumb, there should not be more than 5 to 10 trades a year in a product like the S&P 500 Futures Index. Figure 4.1 shows daily data for the DJ Eurostoxx 50 Futures Index between August 2001 and August 2002. The 13 turning points marked on the chart are based on a swing size of 300 points. Figure 4.1 DJ Eurostoxx 50 chart from 801 to 802. Significant turning points. The appropriate swing size is closely related to the volatility of a product and has to be determined for each product separately. Computer simulations can do this easily on historical test data. The time span for the test results should be at least 3 to 5 years. We consider the application of double top formations and double bottom formations to be a valid investment strategy. Its use demands discipline, however, since the investor must closely follow stop-loss rules, profit targets, or entry rules. Entry rule. Traders get a long or short signal if the swing size is broken by the daily close on daily data. There are many ways in practical trading to modify this approach, but the concept remains unchanged throughout our analysis. As we demonstrate on computer test runs later on, this approach is profitable over time. Figure 4.2 shows the entry rule for buying and selling. Figure 4.2 Entry rule. In addition to entry rules that can help traders track changing markets, reliable stop-loss exit rules can help them control risk in their positions. Stop-loss rule. The investor gets stopped out of a position if, after the entry, a previous peak or a previous valley is broken based on a closing price. There are many ways to place stop-loss orders. The conservative approach presented here reduces whipsawing. In a strong market, however, the loss may be bigger than expected, because positions are only closed out based on the daily closing price level. The experienced trader might work with two stop rules, depending on the market situation. Figure 4.3 shows the stop-loss rule after a long and a short entry. Figure 4.3 Stop-loss rule. Profit target exit rules to protect positions with accumulated profits complement stop-loss rules used to protect positions against excessive losses. Profit target rule. At this point in the discussion, we use the total swing size as the profit target, e.g., if the swing size is 300 points, our profit target is 300 points. It is amazing how often this simple rule works. But sometimes it does not. The experienced trader might want to tailor other rules for a special product or market situation. The preceding profit target rule is shown in Figure 4.4. Figure 4.4 Profit Target Rule. The rules described here work if traders have the patience to wait for profit targets and can live with bigger stop-loss rules. There is no perfect rule, every market situation is unique and products differ in volatility. We have backtested these rules in a diversified portfolio, they work. Later, we discuss these rules in greater detail. To keep it simple, we did not describe trailing stops, but they are included in some of the examples. Example. In Figure 4.5, we show how to apply the strategy of double tops and double bottoms using the DJ Eurostoxx 50 Futures Index between August 2001 and August 2002. Because we are working with a big swing size, there are only 3 signals in the test period. It is easy to increase the number of trades by reducing the swing size to 200 points or 100 points. Figure 4.5 DJ Eurostoxx 50 chart from 0801 to 0802. Trading signals L, entry long, S, entry short, XL, exit long, XS, exit short, PT, profit target. Figure 4.5 consists of 3 entry signals and profit targets. We did not get stopped out. The strategy might look unimpressive, but in the same time frame hardly any fund managed to get a positive performance. To further clarify the strategy underlying double tops and double bottoms, Table 4.1 shows a breakdown of the different signals. Table 4.1 Trading Signals. Profit. Loss in. Hash entry rule at exit rule at points. 1 buy long 3727.00 sell reverse 3550.00 177.002 sell reverse 3500.00 buy flat 3250 300.003 sell short 2700.00 buy flat 2400 300.00. These strategies work best in products with high volatility. They can be easily applied with little work. Diversification is important to reduce the portfolio risk. Summary. The strategies of double tops and double bottoms have the following characteristics. They work on every product and are easy to follow and execute. The number of trading signals depends on the swing size. The smaller the swing size, the higher the number of trades including transaction costs such as commission and slippage. There are many losing trades with small swing size. The profit-loss ratio is much better with bigger swing sizes. Products with large swings and high volatility are highly profitable. Fibonacci price corrections. The strategy of trading corrections can be very successful if it is related to the figures of the Fibonacci summation series and the Fibonacci ratios. The analysis would be simple if there were a general chart pattern for price corrections. The problem is that products always have more corrections than impulse waves. This means that products always move in a sideways pattern for a longer time than they move in impulse waves. In general, markets move sideways about 70% of the time and in impulse waves in the remaining 30%. It is never possible to know in advance whether a new breakout will be the beginning of an uptrend or a downtrend, or a false breakout with a continued sideways pattern. Therefore, traders must adjust their strategies so that they can survive the longest sideways patterns. No market pattern can guarantee profits because no one knows in advance the pattern that the market will take at any given time. When working with corrections as an investment strategy, it is necessary to integrate stop-loss rules, profit target rules, and entry rules. This strategy will only make profits over time if the stop-loss is smaller than the profit target and there are more profitable transactions than losing trades. A strategy based on price corrections can be computer programmed and tested on historical data. Some simulations that we have made can be found at the end of this chapter. Basic features of trading price corrections. Working with corrections is a trend-following strategy based on the assumption that after a correction of an impulse wave up or down, the next impulse wave will follow the direction of the first wave. Working with corrections is a short-term strategy. The goal is to have a high number of profitable trades and only a few losing trades at small individual losses per losing trade. Traders always must be aware of the possibility of false breakouts. False breakouts on the downside are often called bear traps, and on the upside they are called bull traps. Intraday data frequently reveal these patterns. In Figure 4.6, we present ideal typical market moves of false breakouts for bull trap and bear trap chart patterns. Figure 4.6 false breakouts to the downside and to the upside. Traders can base trading signals on false breakouts if they know how to separate the different types of breakouts. We discuss this topic in more detail later on when we talk about entry rules. Size of corrections. The most common approach for working with corrections in research and practical trading is to relate the size of the corrections to a percentage of the prior impulse move. In our analysis, we concentrate on 61.8%, which is directly related to a ratio out of the Fibonacci summation series. A price correction of 61.8% is the result of division 1.000 divided by 1.618. Forecasting the exact size of a correction is an empirical problem. Investing after a correction of just 38.2% might be too early, whereas waiting for a correction of 61.8% might mean missing a strong trend completely. We concentrate on 61.8% and keep the investment risk very small by placing a well-defined close stop loss. The best way to work with corrections is to combine the percentage of corrections with the swing size as a second parameter. Each product has a typical swing pattern that traders can identify with a computer simulation. This pattern should be part of the investment strategy. To get the best real-time results, the investor needs to identify and test it on historical data. The swing size depends on the product. The swing sizes between daily data and intraday data on the same product can be very different. The smaller the swing sizes are, the more noise there is in the price data and the more difficult it will be to filter out the product's typical swing size. For example, if 150 basis points cover the swing size in the cash currency Japanese yen every day, correction levels of 38.2%, 50.0%, or 61.8% might be too small to work with. On the other hand, a correction level of 38.2% might be the best to work with if, in the same product, we measure a price swing of 1000 points over a longer period. It might take weeks before the market price has a correction of 382 basis points. Entry rules. The main reason to work with an entry rule is to get an additional confirmation of trend changes. Working with entry rules also means working with a compromise because we always invest a little later than if we had entered the market as soon as a correction price target was reached. By giving up a little bit of the profit potential, we gain a safety net to avoid getting stopped out and whipsawed so often. Because we work only with a 61.8% correction level in our strategy, we need just one entry rule. We buy or sell after the correction level of 61.8% has been reached when the previous day's high or low is broken. Figure 4.7 shows market entries to the long and short side. Figure 4.7 entry signals long and short after price corrections of 61.8% on one-day high and low breakouts. As mentioned, we always have to expect false breakouts. We can integrate this into our investment strategy with a more conservative entry rule. We buy and sell after a false breakout as soon as the previous two-day high or the previous two-day low is broken. See Figure 4.8. Figure 4.8 entry signals long and short after false breakouts on two-day high and low breakouts. Immediately after establishing market positions, traders need to protect them with stop-loss rules. Stop-loss rule. In working with price corrections, the stop-loss after the entry should be the peak on short signals or valley on long signals before the entry point. Figure 4.9 shows the stop-loss rule of a peak valley exit and the imminent stop-loss risks. Figure 4.9 exits on valleys, long, and peaks, short, and imminent stop loss risks. The size of the stop loss changes in relation to the chosen correction level and the swing size. For example, if the swing size is 300 basis points, the correction level is 61.8%, and the stop loss is below the previous valley, our risk is much smaller than if we enter the market already at 38.2% or 50.0% correction level and define the same stop loss point. On the other hand, we can miss a complete price move if the market price does not reach our correction level. Working with the 61.8% correction level is preferable because we can have a small stop loss and, therefore, less risk. The stop loss level is after a buy signal below the previous valley and after a sell signal above the previous peak. After a false breakout, the highest high or the lowest low before the false breakout is the stop loss level. Trailing stop rule. To protect profits, traders can work with a trailing stop as an alternative to profit targets. A trailing stop is not always the best investment strategy. After investors get stopped out with a small trailing stop, the market price may continue the original trend direction and they will miss the big price move. Depending on the product and volatility, we recommend working with a 3 to 4 day trailing stop. Figure 4.10 covers the exit rule of a 4-day trailing stop. Figure 4.10 long and short positions protected with trailing stop exits on 4-day low and high breakouts. The more conservative option is to work with the previous peak or valley in profitable territory as a trailing stop. Practical applications of price corrections. Working with corrections requires accuracy and discipline. The chances for profits are very high in products with a big swing size and volatility such as in the S&P 500 index, the Nasdaq 100 index, the DAX 30 index, and the DJ Euro Stoxx 50 index. Cash currencies such as the US dollar against the Japanese yen or the euro against the US dollar also may present opportunities. But a big swing size in a product we want to trade is not enough. High volume is at least as important. If the volume in the product is too small, the slippage and commission may make trading unprofitable. Before working with corrections, traders need to determine the swing size and correction level that they want to work with. Only then can we determine whether a product has naturally big or small swings and has a high or low volatility. There is no perfect rule to determine these parameters, because every product is different. But eyeballing daily historical data for about a 3-year period can provide a good indication. As a rule of thumb, a product should not have more than 15 to 20 peaks or valleys over a 12-month period. In the DJ Euro Stoxx 50 index shown in figure 4.11, a swing size of 300 basis points is a good size to work with. In the S&P 500 index, a swing size of at least 80 ticks is needed, a move from 1000.00 to 1080.00. In the Japanese yen cash currency, a swing size of 180 ticks, a move from 110.00 to 111.80 is appropriate. Determining whether we are in an uptrend or a downtrend also can be a problem while working with corrections. The status of the market has to be addressed first, otherwise, investors will never be able to decide in what direction to invest. As long as the market price continues to make new lows and the swing size is bigger than our predetermined swing size based on historical test runs, we will always sell if the correction level reaches 61.8%. If the market makes new highs, we receive buy signals whenever a trend correction of 61.8% occurs. But we will never know in advance whether we invest into a correction of an impulse wave in a downtrend, into an impulse wave in an uptrend. Only future price movements can answer this question. To deal with this problem, we recommend working with bigger swing sizes and correction levels. Although we may anticipate the direction of the next impulse wave incorrectly, our risk remains low and we can liquidate a position with a small loss if we are on the wrong side of the trend direction. See figure 4.11. Figure 4.11 risk levels if a correction is already the impulse wave of a new trend. Table 4.2 sums up parameters for percentage of retracement, swing size, and entry rule. Table 4.2 Swing Size, Correction, and Entry Rule. Entry Rule: Swing Size Correction, previous high low in ticks in percent in days. 100, 200, 6, 1, 8, 3, 4, 200, 400, 3, 8, 2, 3, 4, 200, 400, 5, 0, 0, 2, 200, 400, 6, 1, 8, 1, 400, 800, 3, 8, 2, 3, 400, 800, 5, 0, 0, 1, 400, 800, 6, 1.81. Source: The New Fibonacci Trader, by Robert Fisher, New York, Wiley, 2001, p. 59. Every time investors choose to enter a market according to a pattern of corrections to initial impulse wave, they must make sure that the entry is realized by the time of the correction, or at least close enough to the time of the correction. A reliable way to manage being on time, or at least close enough for the correction, is to combine swing size and correction level with a convincing entry rule. Generally speaking, a strong first impulse wave is followed by a strong correction. The second impulse wave should be bigger than the first impulse wave. Therefore, a more sensitive entry rule can be used. Different entry rules in relation to swing sizes are shown in Figure 4.12. Figure 4.12: Big swing, big correction, previous one-day high entry; medium swing, medium correction, two-day high entry; small swing, small correction, previous three-day high entry rule. Source: The New Fibonacci Trader, by Robert Fisher, New York, Wiley, 2001, p. 60. Many successful combinations of swing size, retracements, and entry rules are possible. The sample constellations in Table 4.2 show the underlying general pattern and how the three parameters go together in a productive way. There are many other workable combinations. Sample parameters for an investment in the S&P 500 index might look like this. The minimum initial swing size in the S&P 500 index is set to 80 basis points, a sample move from 1000.00 to 1080.00. If no correction is as big as 61.8%, we do not get a signal. We never try to catch up with the runaway market, no matter how strongly the S&P 500 index might start to move, unless we get another entry chance that adheres to the rules of price corrections. When a correction reaches the level of 61.8%, we have to enter long on the buy side at the previous day's high, or short on the sell side at the low of the previous day. After we are invested, we work with a profit target of 0.618 times the total swing size of the first impulse wave. We work with a trailing stop that is set at the lowest low of the previous 4 days. Our stop loss level is defined at the low of the starting day of the initial impulse wave. We do not follow a re-entry rule. If we get stopped out, we wait for a full new swing high or low based on the minimum swing size. Only then do we start looking for new trading opportunities. Trading signals. All of the buy and sell signals that are presented in this section are based on calculations from daily bar charts. At the end of this chapter, we provide readers with years of computer test runs on various products. We use 3 examples: the S&P 500 index, the DJ Euro Stoxx 50 index, and the Japanese yen in the cash currency market to explain valid strategies for making money through price corrections. We remind readers, however, that these illustrations are purely for educational purposes and are not recommendations for specific trades. The book CD-ROM enables every investor to generate the same results that are shown here because the sample data sets we used are included with the software. Based on the preceding set of parameters for swing size from highs to lows and lows to highs, retracement, entry rule, profit target, trailing stop, and stop loss rule, 9 sample trading signals can be generated for the S&P 500 index from January to November 2000. Figure 4.13 shows the relevant entry and exit points for the trading simulation in the S&P 500 index. It consists of 9 entry signals, profit targets, and trailing stops. A stop-loss exit applies only once on the very first trade. The strategy looks quite impressive. The year 2000 was favorable for trading corrections. Figure 4.13 S&P 500 chart from 0100 to 1100. Simulation of trading signals based on corrections daily L, entry long, S, entry short, XL, exit long, SX, exit short, stop loss, PT, profit target, as trailing stop. Table 4.3 shows the breakdown of the different signals for a strategy that relies on corrections. The table consists of the 9 trading signals in the S&P 500 index with the respective high and low references from the chart, entry rules, exit rules, and profit or loss per position. Table 4.3 Trading signals. High hash profit. Low hash loss in reference entry rule at exit rule at points. H-1 polite number 2 entry sell 1427.50 stop loss 1449.80 22.30 H-3 polite number 4 entry sell 1386.20 reverse buy 1385.50 0.70 L number 4 H number 5 reverse buy 1385.50 profit target 1468.50 083.00 H number 5A, L number 6 entry sell 1517.50 profit target 1351, 30,166.20 H-7 polite number 8 entry sell 1467.00 reverse buy 1419. 48.00 L number 8, H number 9 reverse buy 1419.00 reverse sell 1456, 37.00 H-9 polite number 10 reverse sell 1456.00 trailing stop 1418, 38.00 L number 12, H number 13 entry buy 1449.00 trailing stop 1468, 19.00 L number 16, H number 17 entry buy 1384.20 trailing stop 1430, 45.80. To illustrate the application of price corrections with a second data sample, we conducted a similar simulation of trading signals on the Japanese yen cash currency. The basic underlying parameters for this analysis are: minimum swing size of 1 Japanese yen and 80 sen, a sample move from 110.00 to 111.80. Retracement of at least 61.8%. Entry rule at previous 1-day high or low, no re-entry. Profit target at 0.618 times the size of the impulse swing, trailing stop set to 4-day low on buys and 4-day highs on sells. The application of these parameters to the daily bar chart of the Japanese yen cash currency results in a set of sample signals comparable to the ones in the S&P 500 index. By similarly analyzing the Japanese yen cash currency, we can prove that the strong gains in the S&P 500 index were not accidental. Figure 4.14. Figure 4.14 Japanese yen chart from 0100 to 1100. Simulation of trading signals based on corrections daily L, entry long, S, entry short, XL, exit long, SX, exit short, stop loss, PT, profit target, as trailing stop. The 9 sample trades in the Japanese yen cash currency have been profitable overall. 6 trades ended up in wins, and only 3 trades were losing trades. Profits totaled almost 9.00 points, which is a promising result for 11 months of sample calculations. To interpret the results properly when trading the Japanese yen against the US dollar, readers must keep in mind that falling prices indicate a stronger Japanese yen and rising prices indicate a stronger US dollar. Buy signals in our calculation, therefore, refer to a speculation on rising prices, which means a stronger US dollar and a weaker Japanese yen. Sell signals refer to an opposite speculation on a stronger Japanese yen and a weaker US dollar. Thus, we buy and sell US dollars with reference to the Japanese yen as the base value for our calculation of profits or losses. The peak valley references, as well as the profits and losses for the signals in the Japanese yen cash currency against the US dollar, are summarized trade by trade in Table 4.4. Table 4.4 Trading signals. High hash profit. Low hash loss in reference entry rule at exit rule at points. L number 2, H number 3 entry buy 105.90 stop loss 104.65 1.25 H hash 3 politer number 4 entry sell 104.79 stop loss 105.76 0.97 L number 4 H number 5 entry buy 104.94 trailing stop 107.7 2.77 L number 8 H number 9 entry buy 109.04 reverse sell 109.05 0.01 H hash 9 politer number 10 reverse sell 109.05 trailing stop 107.9 1.14 H hash 11 politer number 12 entry sell 107.67 reverse buy 105.63 2.04 L number 16 H number 17 reverse buy 105.63 trailing stop 108.55 2.92 H hash 19 politer number 20 entry sell 108.91 profit target 106.15 2.76 H hash 23 politer number 24 entry sell 108.25 trailing stop 108.82 0.57. The results in the S&P 500 index and the Japanese yen cash currency are very promising. However, it is a serious mistake to overestimate the strong gains accumulated with the profitable strategy of combining corrections with parameters for swing size, entry rule, stop loss rule, and profit target. During the sample's limited time span of 11 months, market conditions happened to favor the strategy of investing into corrective waves in the index futures and cash curve. Currency markets. Extended example. The problem with every test run as the time period tested. To show a product of the most recent 12 months, we have selected the DJ Euro Stoxx 50 index from August 2001 to August 2002. The one-year period from mid-2001 to mid-2002 is interesting because it includes uptrends, downtrends, and sideways market patterns. The more we trace up moves and down moves mixed with sideways periods, the more reliable our trading strategy will become if the results of a simulation prove profitable. The following parameters are used for the DJ Euro Stoxx 50 index simulation. Our correction level is 61.8%, the minimum swing size is 300 basis points, a sample move from 2600.00 to 2900.00. As an entry rule, we choose the previous one-day high or low. In case of false breakouts, we work with 2-day highs or 2-day lows. As a trailing stop, we work with a 3-day penetration. After a buy signal, the stop loss is below the low of the previous impulse wave based on a daily close, vice versa for a sell signal. Figure 4.15 shows a chart with 15 trading signals. To make it easier to follow the chart, the same signals are summarized trade by trade in Table 4.5. Figure 4.15 DJ Euro Stoxx 50 chart from 0801 to 0802. Simulation of trading signals based on corrections daily L, entry long, S, entry short, XL, exit long, SX, exit short, trading signals numbered consecutively from 1 to 15. Table 4.5 trading signals. Profit. Loss in. Hash entry rule at exit rule at points. 1 buy long 3495.00 sell flat 3574, 79.00 2 buy long 3678.00 sell flat 3729, 51.003 buy long 3671.00 sell reverse 3819. 148.004 sell reverse 3819.00 buy reverse 3624, 195.005 buy reverse 3624.00 sell reverse 3797, 173.006 sell reverse 3797.00 buy reverse 3649, 148.007 buy reverse 3649.00 sell reverse 3736, 87.008 sell reverse 3736.00 buy flat 3567, 169.009 sell short 3725.00 stop loss 3801.00 76.00 10 buy long 3628.00 sell reverse 3707, 79.0011 sell reverse 3707.00 buy flat 3534, 173.0012 buy long 3052.00 sell flat 3073, 21.00 13 sell short 2670.00 buy reverse 2540, 130.0014 buy reverse 2540.00 sell reverse 2663, 123.0015 sell reverse 2663.00 stop loss 2800.00 117.00. Summary. Price corrections are important and profitable Fibonacci-related trading tools as long as investors handle them properly. The following considerations are essential when working with price corrections. Consistency in the strategy. Different swing sizes and volatilities for different products. Magnitude of the first impulse wave from which the correction level is measured. Strength of the market trend. Data compression weekly, daily, or intraday data. Even more important is that corrections can be computer-programmed and tested on historical price data. This makes it easier for traders to analyze different products at the same time to achieve better diversification. To conclude this section, we present some test results on a variety of stocks, one stock index future and one cash currency. See Table 4.6. Table 4.6 selected computer test results profit max. Loss in wins DD in. Product period EUR %% EUR. 766,400 Volkswagen 1996 plus 13,438.00 1450 9,373.00 870,737 Nokia 1996 plus 20,850, 1154 7,243.00 940,602 Philips 1996 plus 20,993, 956 5,165.00 840,400 Alliance 1996 plus 15,302, 838 3,956.00 723,610 Siemens 1996 plus 15,077, 1233 8,206.00 DAX 30 Futures Index 1996 plus 31,532, 3644 17,437.00 USD 1,996 Japanese Yen plus 26,250, 666 21,430.00. Fibonacci price extensions. Price extensions are volatile price movements that result from runaway markets. Usually, price extensions occur when unexpected news reverses the trend direction. This discussion of price extensions is subdivided into two parts: price extensions in 3-wave patterns and price extensions in 5-wave patterns. Price extensions in 3-wave patterns. Extensions take place primarily in the third wave of a 3-wave price pattern. In an uptrend, the correction does not go lower than the bottom of wave 1, whereas in extensions out of a bull trap or bear trap formation of irregular tops or bottoms, the correction can go higher than the high of the first impulse wave or lower than the low of the first impulse wave, respectively. Two basic chart formations for price extensions are illustrated in Figure 4.16. Figure 4.16 extensions out of a regular 3-wave pattern and a bear trap chart formation. Exploring extensions means investing against major trend directions. Investors looking for quick profits by taking advantage of imbalances in the marketplace need to know not only when to enter a position in advance but also when to exit it. Calculating price targets in extensions of the third wave out of a three-wave chart formation requires the following steps. Defining a minimum swing size and setting it to the size from peak to valley or valley to peak of the first impulse wave of the three-wave pattern. Multiplying the swing size by the Fibonacci ratio 1.618. Adding the resulting value to the size of the initiating swing to define the price target. Figure 4.17 illustrates the three-step approach to calculate Fibonacci target prices for extensions. Figure 4.17 extension in the third wave of a three-wave pattern uptrend. Target price level measured by the Fibonacci ratio phi equals 1.618. In general, we calculate price extensions based on the Fibonacci ratio 1.618. Those who want to extend the analysis to alternative ratios can do so by choosing appropriate ratios from the menu bar of the WINPHI software. The application of Fibonacci price targets to extensions leads to three scenarios. Market prices can come close to the pre-calculated target price, but miss it by a small margin. Reach the exact target price. Overshoot the target price. The most important variable in the analysis of extensions is the swing size, therefore, which scenario develops will depend on the strength of the selected impulse wave. If the swing size is too small, the thrust of the extension may be too big and overshoot the pre-calculated price target by a wide margin. This makes the Fibonacci ratio 1.618 unreliable for calculating the target price. Noise in the market can also cause underlying swings to become unpredictable. Even more important, a swing size that is too small can reduce profit targets to such narrow margins that it becomes difficult to execute them. If the swing size is too big, it could take weeks, months, or even years to reach the target price. The bigger the selected swing size, the more long-term oriented the analysis must be, especially if the trader is using weekly price bar charts. When long-term price targets are reached, they will determine major turning points in the products analyzed. Price extensions calculated on large swings are of little use for average investors who invest with a short-term or mid-term time horizon. In addition to the size of the impulse wave, a few other parameters determine a successful application of extensions. Entry rules, stop-loss rules, and profit targets. The general idea behind extensions is to invest countertrend short or long once the target price of an upward or downward extension has been reached. Integrating an entry rule makes it possible to fine-tune this countertrend investment strategy. Because we must deal with three scenarios, an entry rule is necessary to make the early stages of a market position more flexible and reliable. The application of an entry rule slightly reduces the profit potential because positions are entered with a time lag after the target price has been reached. Trades become safer, however, because positions are protected from excessive losses if strongly rising or falling markets do not stop at pre-calculated price targets. To properly handle the three aforementioned price target scenarios being missed, reach the exact target price, or exceeded by some margin, the analysis must include small price bands above and below the line for the price target at the end of an extension. As long as the market price moves within the price band, the entry rule remains in effect. Should the market price exceed the upper price band, no action will be taken because it has to be assumed that market prices will rise higher without a correction countertrend. Whenever a pre-calculated target price is reached on daily charts, we recommend working with an entry rule. This should be done in an uptrend either to the previous 2-day low, or to a market on close if the close of the last trading day is lower than the close of the highest day within the price band, vice versa for long entries on price extensions to the downside. Both patterns are shown in Figure 4.18. Figure 4.18 entry rules out of a price band at the target price line of an extension. The market itself decides the pattern that is realized. The one that shows up first will be filled. Whenever a market position, long or short, is established, a stop loss will protect it. The rule for short positions is to place the stop-loss protection one tick above the highest high of the previous bars. For long positions, the stop-loss rule is reversed. The stop-loss level is set to one tick lower than the lowest low of the previous bar. Figure 4.19 shows the stop-loss rule after a short signal. Figure 4.19 stop-loss protection on a short position. In addition to stop-loss protection, a profit target or a trailing stop rule maintains profits that accumulate on a position. The most common rules for daily data are: profit target set to a 50% retracement of the previous three-wave move that formed the extension. Trailing stop defined as a 3 to 4 day high, low breakout or a breakout of the previous peak valley. Each of the aforementioned exit rules has its advantages and disadvantages, but it's important to consistently stay with one rule. Sample calculations for extensions on daily data. Because the Japanese yen cash currency is a volatile product with high market participation, it is useful for demonstrating basic trade price extensions on daily data. The following settings are used as our parameters in the Japanese yen cash currency. Minimum swing size of 1 Japanese yen and 80 sen, a sample move from 110.00 to 111.80. Entry rule at previous 2-day high on buy signals, and previous 2-day low on sell signals. Price target calculated by multiplying the swing size of the first impulse wave by the Fibonacci ratio 1.618. Profit target 50% of the distance from impulse wave to price target, trailing stop set to 4-day low on buys and 4-day high on sells. Stop loss level at highest high before entry on sells, and lowest low before entry on buys. Applying these parameters to a chart, we conduct the analysis twice. We find 4 sample signals for the period from January to November 2000 on daily data. In the first setup, we exit profitable positions as soon as the profit target level is reached. The 50% profit target level is entered immediately after market entry as a limit order. We do not act until the market price triggers the profit target level or the stop loss if the position turns to the negative. According to Table 4.7a, the strategy provides us with 3 wins and 1 losing trade. Table 4.7 A calculation of sample signals in the Japanese yen. From 0100 to 1100 exiting positions with a profit target high hash profit. Low hash loss in reference entry rule at exit rule at points. H-1 polite number 2 entry by 105.50 profit target 107.602.10 H-3 polite number 4 entry by 105.65 profit target 107.101.45 L number 5 H number 6 entry sell 108.53 stop loss 109.38 0.85 H-7 polite number 8 entry by 106.45 profit target 107.320.87. In the second setup, we use a trailing stop according to our definition and do not immediately close out positions at the profit target level. According to Table 4.7b, we also find 3 winning trades and 1 losing trade. Table 4.7b Calculation of sample signals in the Japanese yen. From 0100 to 1100 exiting positions with a trailing stop high hash profit. Low hash loss in reference entry rule at exit rule at points. H-1 polite number 2 entry by 105.50 trailing stop 107.712.21 H-3 polite number 4 entry by 105.65 trailing stop 108.533.88 L number 5 H number 6 entry sell 108.53 stop loss 109.38 0.85 H-7 polite number 8 entry by 106.45 trailing stop 106.700.25. Figure 4.20 shows the underlying chart pattern in the Japanese yen cash currency including the 4 trading signals. Figure 4.20 Japanese yen chart from 0100 to 1100. Simulation of trading signals based on price extensions daily L, entry long, S, entry short, XL, exit long, SX, exit short, stop loss, PT, profit target, as trailing stop. When the 4 sample trades are analyzed signal by signal, it becomes clear that trading price extensions can be a profitable strategy. Trading signals are infrequent, but the 4 occasions where market patterns were in accordance with our parameter settings offered convincing trading opportunities in the Japanese yen cash currency. Nevertheless, it is difficult to decide on the appropriate exit rule. Both options, exiting immediately on the profit target level and waiting a little longer for the trailing stop pattern to close the position, paid off equally well. Interested readers can test both patterns on different sets of data and within different time frames to determine their personal preference. Extensions out of 3 wave moves are the easiest patterns to identify, which is why we used this simple pattern in our introductory section. In practical trading, however, most of the time, we must deal with multiple wave counts. Elliott based his principles on a 5-wave pattern, which is a static approach, but in strong bull or strong bear markets, we often find 10 or more waves in the same trend direction. Normally, the wave count will not exceed 5 waves. Price extensions in 5-wave patterns. When analyzing extensions in 5-wave patterns, we look for an additional parameter, based on the Fibonacci summation series that will confirm our price target calculation for extensions out of a 3-wave pattern. As explained earlier, to analyze a 3-wave pattern, the investor must multiply the size of the first impulse wave by the Fibonacci ratio 1.618. The product is then added to the swing size of the initial move to calculate a Fibonacci price target line. It is at this line that we expect the 3rd wave to reverse. Because there are usually more than 3 waves in a trending market, we must modify our approach to calculating a Fibonacci price target. The most common price pattern has at least 5 waves, 3 impulse waves and 2 corrective waves. Figure 4.21 illustrates the basic approach to calculating price targets for extensions out of 5-wave market movements. Figure 4.21 calculation of Fibonacci price target in a regular 5-wave move. In a regular 5-wave move in an uptrend, the price target line for the end of wave 5 is calculated by multiplying the amplitude of wave 1 by the Fibonacci ratio 1.618, and then multiplying the amplitude from the bottom of the wave to the top of wave 3 by the reciprocal value to the Fibonacci ratio 0.618. By combining the two calculations, using ratios 0.618 and 1.618, we can pre-calculate the end of wave 5 at the same price if the market moves in a regular price pattern as described. Most of the time, however, instead of finding one and the same price level calculated with both ratios, we get 2 different prices. They are either closer together or wider apart from each other, depending on the amplitude of wave 1 and wave 3. We find an upper and lower price target called a Fibonacci price target band. We cannot know whether our price forecast will ever be reached, but we know in advance whether the price band will be close together or far apart. When the upper and the lower levels of the Fibonacci price target band are close together, the price target band is worth considering. With the example of Japanese yen cash currency shown in figure 4.22, we show how to calculate a Fibonacci price band. Beginning with the high of wave 1 at 110.03 and the corresponding low at 107.72 multiplied by 1.618, we reach a price target of 103.99. The confirmation. Figure 4.22 Japanese yen chart from 0300 to 0700. Price target corridor calculated using the Fibonacci key ratios 1.168 to 0.618. From the high of wave 1 to the low of wave 3, multiplied by 0.618, leads us to the second price target at 104.08. The resulting Fibonacci price band is extremely narrow and is an ideal example of what we are looking for in the markets. The Japanese yen cash currency dropped to 103.94 and then immediately reversed its trend direction to the upside. Summary. Investing based on extensions always means investments against the main trend, which is defined by the first impulse swing in a 3-wave move or a 5-wave pattern. Extensions are important Fibonacci trading tools because they not only show up in fast movements over a couple of days or weeks in soft commodities, but also indicate major trend changes in financial instruments, derivatives, or currencies. The most important modification to the general calculation of extensions out of the 3-wave movement is the additional use of 5-wave patterns to get a multiple confirmation of a Fibonacci price target in a price band. The successful combination of two Fibonacci-related tools is only one step toward using other Fibonacci trading tools that can identify turning points in the markets. Candlestick chart patterns. Candlestick chart patterns visualize accelerations and slowdown in trends or indicate trend reversals. Candlestick charts work with the same OHLC opening, high, low, close data as regular bar charts. The only difference is that a key reversal day on a bar chart, for example, can be easier to identify by looking for a hammer or a doji candlestick formation. Candlestick charts are popular because they identify the momentum in a price move on every price bar by comparing the opening price with the closing price and showing black and white candlesticks, depending on whether the opening is higher or lower than the closing price. Candlestick charts are very good trading tools by themselves, but they also combine well with other trading tools. Basics of working with candlestick chart patterns. Working with candlesticks means that there is no time lag in the analysis compared with technical analysis tools, e.g., moving averages. Candlesticks show everyday investor behavior expressed through the relationship of open, high, low, and close of the day or week, month, etc. The following candlestick chart patterns occur frequently and combine well with Fibonacci trading tools. Our goal is to be practice-oriented, to show what works, is easy to understand, and is useful for all traders. The few candlestick patterns we show here represent probably 80% of all valid patterns in real-time everyday trading and can be easily integrated with other strategies. Generating trading signals based on candlestick patterns. Hammer and hanging man, inverted hammer. A candlestick chart pattern is called a hammer if it has a long shadow and a small body, black or white, that is very close to the high of the day. At the end of a downtrend, the hammer is considered a bullish reversal signal. See Figure 4.23. Figure 4.23 Hammer and hanging man. The hammer often shows up at the end of a downtrend. After we identify a hammer, we buy next day at the high of the previous day. The stop loss is below the low of the previous day. The corresponding candlestick chart pattern of a hanging man is a hammer at the end of an uptrend. We sell on the occurrence of this chart pattern if the low of the day with the hanging man is broken. The stop loss in this case is the high of the day at which the hanging man pattern has occurred. Bullish and bearish engulfing patterns. Whereas hammer and hanging man are single candlestick formations consist of one candlestick, the bullish and bearish engulfing patterns need a pair of candlesticks to complete the pattern. See Figure 4.24. Figure 4.24 Bullish and bearish engulfing pattern. The bullish engulfing pattern often occurs at the end of a downtrend and indicates a trend reversal. We buy at the high of the day with the big, white candlestick. The stop loss is placed below the lowest low of the small or big candlestick, whichever is lower. The bearish engulfing pattern often occurs at the end of an uptrend. The sell signal is at the low of the long black candlestick. The stop loss is placed above the highest high of the small or big candlestick, whichever is higher. Harami pattern. The Harami pattern is only an indication of a trend change at the end of an uptrend or downtrend. Harami patterns do not have relevance in sideways market conditions. Harami patterns always include two candlesticks, which can be compared with inside days in the regular chart analysis. The Harami pattern has a small body, black or white, that fits completely into the big, black or white body of the previous day. It is unimportant whether the shadow of today's small candlestick pattern goes higher or lower than the shadow of the previous candlestick. See Figure 4.25. Figure 4.25 Harami pattern. At the end of a downtrend, we get a buy signal if the high of the candlestick with the big white body is broken. The stop loss is placed at the low of that particular day. If the low of the candlestick with the big black body is broken, we receive a sell signal at the end of an uptrend. The stop loss is placed at the high of that particular day. Morning star and evening star. Morning star and evening star are chart patterns that comprise three candlesticks. See Figure 4.26. Figure 4.26 Morning star and evening star. The morning star pattern indicates an uptrend market movement. We buy at the high of the right candlestick with the long white body. The stop loss is placed at the low of the small candlestick in the middle of this pattern. An evening star indicates a downtrend. We sell at the low of the right black candlestick. The stop loss is placed at the high of the small candlestick in the middle of this pattern. Sample trading signals. We show trading signals based on candlestick chart patterns for the DJ Euro Stoxx 50 index between June and August 2002. 3 months is a short time span. However, it is sufficient for demonstration purposes because candlestick charts need a lot of space. This time period is identical with the Fibonacci price correction analysis presented earlier in this chapter, and later on, we combine the two approaches. Figure 4.27 shows 7 candlestick trades over the 3 months under consideration. Figure 4.27 DJ Euro Stoxx 50 chart from 0602 to 0802. Simulation of trading signals based on candlestick patterns daily L, entry long, S, entry short, XL, exit long, SL, stop loss. The large market swings in the DJ Euro Stoxx 50 index mean they work very well for analysis with candlestick charts. With smaller market swings, candlesticks do not work as well. The same holds true for Fibonacci analysis. Candlesticks and Fibonacci corrections have much in common. In both strategies, the core principle is a focus on investor behavior. Signal 1. The first signal is based on a Harami pattern and is confirmed in addition by a bearish engulfing pattern. The sell signal is at the low of the long white candlestick. Because the market opened with a price gap, the entry price is even lower than the low of the long white candlestick. Signal 2. The second trading signal is a long signal based on a bullish engulfing pattern. As there is no reversal signal, we get stopped out at the lowest low of the bullish engulfing chart pattern. Signal 3. The third signal is a perfect hammer pattern. The candlestick body is very small and the shadow is at least 3 times longer than the body. We buy at the opening of the day following the hammer candlestick pattern. Signal 4. After the long white candlestick body, we identify a Harami pattern. The bearish signal of the Harami pattern is confirmed by an inverted hammer pattern, with a long shadow on the top and a small body at the bottom. We sell at the opening of the day that follows the Harami pattern. Signal 5. We get a reversal buy signal based on a bullish engulfing chart pattern. We buy on the next day when the high of the candlestick with the long white body is broken. Signal 6. If we are a little flexible, we can see an evening star chart pattern in the sixth signal. It would be a perfect pattern if the body of the small white candle showed a gap to the candlestick bodies to the left and to the right. The sell signal is at the lowest low of the candlestick with the black body to the right. Signal 7. The seventh signal is based on a very rare candlestick pattern, a so-called tri-star bottom. Since it shows up so seldom, we did not describe it in our presentation of candlestick chart patterns. The tri-star bottom pattern looks very much the same as a morning star. The only difference is that all 3 candlesticks are dojis. We get a buy signal at the high of the right doji chart pattern. A tabular summary of the trading signals. Table 4.8 provides a summary of all 7 trading signals. Table 4.8 Trading signals. Profit. Loss in. Hash entry rule at exit rule at points. 1 sell short 3042.00 buy reverse 2828, 214.002 buy reverse 2828.00 stop loss 2612.00 216.003 buy long 2552.00 sell reverse 2661.00 109.004 sell reverse 2661.00 buy reverse 2612, 49.005 buy reverse 2612.00 sell reverse 2676, 64.006 sell reverse 2676.00 buy reverse 2708.00 32.007 buy reverse 2708.00 open. The ratio of 4 winning trades and 2 losing trades with one of the positions still open is a promising indication of how powerful candlestick chart patterns can be as standalone trading strategies. Summary. A major advantage of candlesticks is that they show the momentum of every day's price moves. They are definitive, easier to understand than bar charts, and especially helpful for short-term traders. The usefulness of candlesticks as standalone trading tools has to be judged carefully. Our own simulation on the DJ Euro Stoxx 50 index came up with a solid profit potential and a decent profit-loss ratio over a 3-month test period in mid-2002. However, negative test results were retrieved from Rogalski Trading, Germany, using the most common candlestick patterns on the DAX 30 futures index and the Euro Bund future over a longer time period. The test runs conducted by Rogalski Trading were based on the following parameters. DAX 30 futures index tested from March 1997 to February 2001. Euro Bund future tested from January 1994 to February 2001. Entry rule on stop at the candlestick pattern high price or low price, or market on open of the following trading day, whichever comes first. Exit rule market on the daily close after day 1 or on the daily close after day 3. Slippage and commission calculated as 2 basis points in both the DAX 30 futures index and the Euro Bund future. The test results by Rogalski Trading for selected candlestick chart patterns and based on the 1-day close and 3-day close exit rule lead to a profile that leaves some room for interpretation and speculation. Rogalski Trading have investigated 7 candlestick patterns. The findings for 4 of the patterns are summarized in Table 4.9. Table 4.9 Simulation of trading signals based on candlestick chart patterns daily B, bullish engulfing, MS, morning star, hum, hanging man, ha, hammer, BBMS MS hum hum ha ha 13131313. DAX 30 36,256 509 285 373 21042 342 Bund 1.74 0.34 1.74 4.25 4.67 6.72 1.33 3.14 Source Rogalski Trading by Andrei Rogalski, Berlin, Germany 2000. The 3 candlestick formations that are missing from the Rogalski Trading simulation in Table 4.9 are bearish engulfing pattern, evening star, and dark cloud cover. Figure 4.28 shows total profits and losses for all 7 candlestick patterns in the DAX 30 futures index and the Euro Bund future in a line and bar combo graph. The overall results lead us to conclude that candlestick chart patterns as standalone trading tools are not reliable enough for trading. Figure 4.28 DAX 30 futures index and Euro Bund future performance from 1997 and 1994 to 2001. Simulation of trading signals based on candlestick patterns daily. Source: Rogalski Trading, by Andrei Rogalski, Berlin, Germany, 2001. The only patterns with profit potential are bullish engulfing pattern, hammer, and hanging man on the DAX 30 futures index, but not on the Euro Bund future. Liquidating the position after a 3-day holding period is more profitable than after a 1-day holding period. Because the performance of the DAX 30 futures index is similar to that of the S&P 500 futures index, the test results can be related to the S&P 500 futures index as well. The same holds true for the relationship of Euro Bund future and US Treasury bonds. However, even though the candlestick chart patterns do not offer a big trading potential by themselves, they can be of high value for short-term traders by instantly alerting them when the momentum in a product or market is changing. In addition to the analysis conducted by Rogalski Trading, another study by Giovanni Maini * is from our point of view the best summary to be found in this field. In order to quantify the reliability of Japanese candlestick formations, Maini analyzed first 575 American stocks and bonds over a period of 15 to 20 years from the early 1980s to present using Metastock definition of candlestick patterns. Each candlestick formation observed the trend starting from the day after the formation occurred. He looked for about 40 patterns and tabulated each trend's subsequent rise, decline, or neutral movement. The goal was to get the statistical percentage on the most reliable formations. Maini found more than 6.14 million candlestick formations. This number may be unusually high, however, some of the simple formations such as the inverted hammer were counted twice if they became part of a multi-candlestick formation. Counting both simple and compound candlestick formations offers a complete, detailed, and effective analysis. The 10 most frequent and the 10 least common candlestick formations shall be displayed in tabular form. Information is presented for each candlestick formation on the percentage of the total found and the percentage of cases in which the candlestick formation preceded a rise, fall, or sideways movement on the following day. The most frequent patterns are white body, hammer, and black body. From figure 3.16 in the previous chapter, readers get an idea what white body and black body candlestick patterns look like. In each case it is the big white or black body with the small shadows at the top and at the bottom. The white body is the most common candlestick with more than 2 million occurrences. This represents 32.6% of the total. Second and third most common are the hammer and the black body, with 12.6% and 12.1% of the total. Among the least frequent candlesticks are morning and evening star doji, evening star, and morning star. Table 4.10. Giovanni Maini, how reliable are candlesticks? In Technical Analysis of Stocks and Commodities, November 2002 pp. 60-65. Further references will cite Maini. Table 4.10 Most frequent and least common candlestick chart formations % of day after. % up down equals. White body 2,003,843 32.60 44.02 43.85 12.12 hammer 776,772 12.60 40.86 45.71 13.42 black body 741,653 12.10 45.89 46 06 8.01 long upper shadow 531,103 8.60 44.45 41.60 13.94 inverted hammer 450,521 7.30 46.91 41.22 11.86 tweezer bottoms 255,034.20 39.92 40 08 20.00 tweezer tops 242,824 4 40.51 40.49 19.00 doji 171,945 2.80 42.28 42.48 15.22 long white body 139,147 2.30 45.90 46.25 7.83 spinning top 134,383 2.20 46.93 47.935 5.08 dark cloud cover 4,839 0. 08 48.75 44.31 6.90 bearish harami 3052 0.05 43.55 50.82 5.57 bullish harami 2162 0. 04 48.43 47. 09 4.49 long leg doji. 1318 0.02 42.15 41.93 15.853 White Soldiers 235 0 35.74 53.62 10.64 Morningstar Doji 205 0 48.78 43.90 7.32 Evening Star Doji 180 0 40.56 53.336.11 Evening Star 157 0 48.41 48.41 3.18 Morning Star 150 0 47.33 50.67 2.003 Black Crows 102 0 67.65 27.45 4.90 Source, Many p. 60. The last three columns in Table 4.10 show how many up, down, and neutral days followed a candlestick formation. In 44.20% of the cases, a white body anticipated a rising session, in 43.85% of the cases a decline occurred, and in 12.12% of the time the price did not change. The percentage of up days is almost the same as the down days. The most reliable patterns are 3 black crows, inverted black hammer, and inverted hammer. Many's findings are in line with our own results when he writes, for traders who are quantitatively based, candlestick patterns are not terribly useful, while they are very useful to those who are more visual in nature. Many, p. 65. A little later in his article, Maney continues, the distribution of candlestick patterns, at least for the most commonly occurring, has been consistent over time and through different markets. These three patterns are the white body, hammer, and black body. The analysis done in this article shows the reliability of these formations. When used in combination with indicators and other patterns, they can be a very powerful tool. Maney, p. 65. The biggest advantage for traders becomes obvious by combining candlestick formations with Fibonacci trading tools and regular 3-point chart patterns. Useful combinations of all three trading components are described in the final chapter of this book. 3-point chart patterns for trend reversals. The always hot and new question that analysts and traders ask themselves is when price moves come to an end and change direction. There are many ways to approach this problem with technical analysis. Traders have identified hundreds of chart patterns and formations. In this section, we concentrate on the ones that have at least 3 peaks or valleys on one side of the chart pattern. This restriction eliminates many of the popular formations, but it reduces the number of trades and makes it much easier to identify chart patterns. Our approach comes very close to the wave count from Elliott. In contrast to Elliott, however, who counted 3 impulse waves and 2 corrective waves in an uptrend or downtrend for a complete price move, we focus on the total number of 5 waves. It makes little difference whether the market moves up, down, or sideways. After 5 waves, the market price often changes its direction, no matter whether it is a trending pattern or a sideways pattern. The only difference is the profit potential. As long as traders rely on pre-calculated profit targets, a buy or sell signal at the end of a sideways pattern might even be safer than at the end of a 5-wave uptrend or downtrend. Even more important is that we can combine the 3-point chart patterns with Fibonacci trading tools or candlestick chart patterns. This combination separates our approach from many other strategies available in this field. Most knowledgeable books on the topic of pattern recognition were written decades ago. However, Thomas N. Bulkowski has written 2 books that go far beyond the content of competing books. The Thomas N. Bulkowski, Encyclopedia of Chart Patterns, New York, John Wiley & Sons, 2000. Further references will cite Bulkowski, Thomas N. Bulkowski, Trading Classic Chart Patterns, New York, John Wiley & Sons, 2002. Encyclopedia of Chart Patterns and Trading Classic Chart Patterns provide detailed computer studies for many chart patterns that were tested on 500 stocks and backward for 5 years. Bulkowski writes, to knowledgeable investors, chart patterns are not squiggles on a price chart, they are footprints of the smart money. The footprints are all they need to follow as they line their pockets with greater and greater riches. They are the one making the footprints. They are the smart money that is setting the rules of the game, a game anyone can play. It is called investing. Bulkovsky, p. 3. We recommend this book to anyone who is interested in chart patterns. In the following discussion of selected patterns, we refer to Bulkovsky's key studies. Applying 3-point chart patterns. This discussion of important price chart patterns is subdivided into reversal patterns and continuation patterns, but it is important to understand that these two categories might not always be correct. A head and shoulder formation is generally considered to be a reversal price pattern, but in rare situations it may show up as a continuation pattern. Traders have to be aware of this complication. Stop-loss rules. A general stop-loss rule applies immediately after market entry. It states that we place the stop-loss on a close above or a close below the highest peak, sell signals or lowest valley, buy signals of the chart pattern we are working with. Figure 4.29 illustrates the general stop-loss rule on a long and a short position. Figure 4.29 stop-loss rule. However, there are exceptions to this rule. These are described in the later discussion of specific chart patterns. Profit target rules. There are several ways to work with profit targets on long and short positions. Some basic calculations can provide easy-to-follow profit target rules that have proven to be successful in various market situations. Price projections based on Fibonacci ratios. Parallel trend lines. Total length of the first impulse wave with reference to the Elliott count. Doubling the total distance of the price pattern from highest high to lowest low. Figures 4.30a to 4.30d show the preceding options for predefining profit targets on a long entry. Figure 4.30a profit target rule ratios. Figure 4.30b profit target rule parallel lines. Figure 4.30c profit target rule impulse wave. Figure 4.30d profit target rule double distance from highest high to lowest low. Trailing stop rules. To protect open profits, we can apply trailing stops in different ways. As long as the market moves in a narrow trading range, we can protect small profits by working with a 3 to 4 day previous high, short positions or low. Figure 4.31. Figure 4.314 day breakout trailing stop rule out of a long position. Even though this approach is effective for the short term, large profits cannot accumulate in a single product, for we get stopped out too quickly. The most commonly used trailing stop rule is to work with previous peaks or valleys. This approach works less well when a product is in a trading range, but it opens up the opportunity for bigger profits in trending market situations. Figures 4.32a and 4.32b show the valley peak trailing stop rule out of a long and a short position. Figure 4.32a trailing stop rule on a valley out of long position. Figure 4.32b trailing stop rule on a peak out of short position. Examples with selected 3-point chart patterns. The chart patterns discussed in the following subsections are well known, and more importantly, they are highly relevant to combinations with candlestick patterns and Fibonacci trading tools. Our findings are in line with the results of Thomas Bulkovsky's computer test runs. In Chapter 6, we use the same examples to show how traders can modify our entry rules by integrating candlestick charts and Fibonacci trading tools. Head and shoulder formation. Head and shoulder formations are one of the best chart patterns for locating trend reversals. They often can be found on tops or bottoms, but there are exceptions. A head and shoulder top formation is sometimes at the end of a downtrend as well. Ideally, the right shoulder should be on the same level as the left shoulder. Figure 4.33 shows the German DAX member stock BMW. Figure 4.33 BMW chart from 12:00 to 07:01. Head and shoulder formation daily. On this chart, the neckline connects two valleys between the left and right shoulder of a head and shoulder top formation. At the bottom formation, the neckline connects the two peaks between the right and left shoulder. To complete the formation, the market price must break the neckline. Figure 4.34 shows a head and shoulder formation for Eastman Kodak from late in the year 2001. Figure 4.34 Eastman Kodak chart from 10:01 to 04:02. Head and shoulder formation daily. To successfully make trades based on price chart patterns, we need to check the profitability of our entry rules, stop loss rules, profit target, and trailing stop rules. Once the right shoulder is formed, we can buy or sell on a breakout of the neckline to the upside or to the downside. With the head and shoulder top formation, the success rate of this approach is 93% according to Bulkovsky's test results. The stop loss is placed just above short trades or below long trades the right shoulder. Setting the profit target to twice the distance of the price pattern from high to low leads to success rates of 83% for head and shoulder bottom formations and 63% for head and shoulder top formations according to Bulkovsky. In our experience, the peak or valley breakouts described here work best as profitable trailing stop exits. Triple tops and triple bottoms. Triple top and triple bottom formations are reliable 3-point chart patterns. All three of the tops or bottoms need to be placed almost on a horizontal line to show up as a valid triple top or triple bottom pattern. The three bottoms are usually large and well separated from each other. A triple bottom chart formation for Nokia as of mid-2002 appears in Figure 4.35. Figure 4.35 Nokia chart from 05:02 to 09:02. Triple bottom formation daily. In general, triple tops and triple bottoms are rare chart patterns. Figure 4.36 shows another of these unusual but profitable formations, an impressive triple bottom pattern on an IBM chart from mid-2002. Figure 4.36 IBM chart from 05:02 to 09:02. Triple bottom formation daily. To enter the market, prices must break out of the highest high or the lowest low over the time span of the development of the triple bottom or top formation. The stop loss point is set to the highest high for sell signals or the lowest low for buy signals of the chart formation. The profit target is defined by doubling the distance between the lowest low and the highest high of the chart formation. Using a similar profit target rule, Bulkovsky concludes that 73% of his pre-calculated price targets are reached out of triple bottoms, whereas only 47% of the targets are reached out of triple tops. As soon as profits start accumulating, a trailing stop rule can replace a profit target rule. Again, the simple rule of using the most recent peak in a profit on short signals or the most recent valley in a profit on long signals is a successful strategy. Rectangle formations. Rectangles can be at the top or the bottom. Prices oscillate between two horizontal trend lines before breaking out. Rectangle formations are very reliable. Bulkovsky found just 2 failures, losing trades, for rectangle bottoms out of 95 formations in his test runs. For rectangle tops, the ratio shows 5 failures in nearly 300 rectangles tested. If the rectangle is wide enough, trading countertrend within the rectangle can be a smart short-term strategy. Figure 4.37 depicts a chart of the Japanese yen cash currency against the US dollar. Figure 4.37. Figure 4.37 Japanese yen chart from 12:01 to 04:02. Rectangle formation daily. There is likely to be a pullback after the breakout from the rectangle. Should this happen, we can build up additional trading positions. This strategy works for rectangle bottoms and rectangle tops. Another picture book example of a rectangle formation is the Intel stock in July and August 2002. See Figure 4.38. Figure 4.38 Intel chart from 05:02 to 11:02. Rectangle formation daily. Since we cannot predict the breakout direction, we wait for the market price to close outside the rectangle trend lines and then trade in the direction of the main trend. The stop loss can be placed first at the median line of the rectangle. If the market price after we have entered a position forms a peak or valley inside the trend lines of the rectangle, this peak or valley is the indicator for the stop loss. We set our profit target by doubling the distance from highest high to lowest low of the rectangle. In results presented by Bulkovsky on a comparable exit rule, 93% of his predicted price targets for breakouts to the upside out of rectangle bottoms proved to be accurate. Breakouts to the downside reached the profit targets at a 65% rate. The figures for rectangle tops were 91% upside breakouts and 77% breakouts to the downside. Finally, we recommend using a trailing stop rule, defined simply as the most recent peak or valley in a profit. In the end, however, the investor's mentality toward risk will determine whether to use profit targets, trailing stops, or a combination. Key reversal days. Key reversal days often occur at the end of a fast-moving market, either up or down. We know from the analysis of the hammer candlestick chart pattern that the overall statistics are poor for that particular pattern, which is equivalent to a key reversal day. Nevertheless, we concentrate on those key reversal days that happen as third peaks or valleys within a chart pattern. A typical example can be seen in the daily chart of the largest European software company SAP. See Figure 4.39. Figure 4.39 SAP chart from 04/02 to 08/02. Key reversal day. Intel again provides an example. It shows a solid key reversal day pattern as a third peak in a triple top formation, this time late in August 2000. Figure 4.40. Figure 4.40 Intel chart from 03/00 to 12/00. Key reversal day. The entry rule depends to a high degree on the risk preference of the investor. An ideal pattern is the hammer candlestick chart formation, described in an earlier section. An easy rule of thumb is that the shadow of the hammer should be at least 3 times the length of the body. The stop loss is placed at the low of the key reversal day for a buy signal and at the high of the key reversal day for a short signal. Often on key reversal days, we are already in a trading range at the third peak or valley of a 3-point chart formation. For short-term trades, we take the opposite side of the trading range as our first profit target and double the distance of the trading range as our second profit target. Trailing stop rules are less important for key reversal days and short-term approaches to trading. 3 rising valleys and 3 falling peaks. 3 rising valleys and 3 falling peaks are among the most stable and reliable 3-point chart patterns. The general pattern consists of either 3 valleys with 2 peaks in between or 3 peaks with 2 valleys in between. In contrast to the other 3-point chart patterns described thus far in this section, 3 rising valleys and 3 falling peaks are trend-following patterns and do not indicate trend reversals. We get a short signal at the low of the lowest valley and a buy signal at the high of the highest peak. It is essential to keep in mind the distinction between 3-point chart patterns indicating trend changes and 3-point chart patterns indicating continuing trend movements. We refer to this distinction again in the following section on triangles. Figure 4.41 shows a 6-month bar chart of the Daimler-Chrysler stock. Figure 4.41 Daimler-Chrysler chart from 02/02 to 08/02. Chart patterns of 3 falling peaks and 3 rising valleys. The Japanese yen cash currency against the US dollar provides another chart example of 3 falling peaks as a solid basis for a short market entry. See Figure 4.42. Figure 4.42 Japanese yen chart from 02/02 to 06/02. Pattern of 3 falling peaks. For market entries, we sell at the lowest intermediate valley 3 falling peaks or buy at the highest intermediate peak 3 rising valleys of the 3-point chart formation. Reminder, the respective chart formations of falling peaks and rising valleys always consist of either 3 peaks and 2 intermediate valleys or 3 valleys and 2 intermediate peaks. The stop loss is placed at the most recent peak above, short positions, or at the most recent valley below, long positions, are entry point. The profit target works again as doubling the distance from highest high to lowest low of the 3-point chart formation. Our trailing stop rule also is the same one that we have already used several times in this chapter. We buy flat at the most recent peak in a profit, short positions, or sell flat at the most recent valley in a profit, long positions. Symmetrical, ascending, and descending triangles. Triangles are the final 3-point chart pattern in this discussion. In symmetrical triangles, support and resistance lines merge. Symmetrical triangle tops have prices that trend up to the formation, whereas bottoms have prices leading down. To cite Bulkovsky and his findings again, premature breakouts occur about 71% to 76% of the way to the triangle apex. A downsloping trend line drawn along the tops connects minor highs, while an upsloping trend line supports the minor lows. In Bulkovsky's test runs, there are twice as many triangles with upward breakouts as with downward ones. The Deutsche Telekom stock chart figure 4.43 shows a symmetrical triangle. Figure 4.43 Deutsche Telekom chart from 0701 to 0402. Symmetrical triangle. With this entry rule, we always wait for a breakout of the market. We check the price pattern for at least 3 peaks or valleys touched by the support or resistance line. The breakout has to occur right through either the support or the resistance line. If we see a breakout to the downside, short entry, we place the stop loss at the triangle high. If we see a breakout to the upside, we place the stop loss at the triangle low. Doubling the distance from highest high to lowest low of the symmetrical triangle once more facilitates the profit target rule. For the relevance of profit targets on a rule that is similar to the one used here, Bulkovsky reports a rate of 62% realized profit targets on downside breakouts and 81% realized profit targets on breakouts to the upside. Finally, for trailing stops, we buy flat at the most recent peak in a profit short positions or sell flat at the most recent valley in a profit long positions. Descending triangles, in contrast to symmetrical triangles, have a horizontal trend or support line and a downsloping resistance line. Ascending triangles have a horizontal resistance line and an upsloping trend or support line. Triangles of the ascending or descending kind are easy to identify. Following Bulkovsky, we find far fewer descending triangles than ascending ones. Almost 2 out of 3, 422 out of 689 triangles that Bulkovsky identified were consolidations of the current trend. This means that if the price trend is downward going into the triangle, it is still moving downward after leaving it. Furthermore, almost 3 out of 4 ascending triangles show a meaningful rise after an upside breakout. Again, we call this sort of 3-point chart pattern a continuation pattern. Breakouts of the support or the resistance line forming the triangle are indications of valid market entries. In all cases, we wait for the occurrence of at least 3 peaks on the resistance line or 3 valleys on the support line. The stop-loss point is marked by the support line on buy signals and by the resistance line on sell signals. As a rule of thumb, the line opposite to the direction of the market entry always marks the relevant stop-loss point. Profit target rules and trailing stop rules are similar to the ones for symmetrical triangles. For the profitability of profit targets, Bulkovsky reports 89% of ascending and 67% of descending triangles meet pre-calculated price targets. The chart of the German major bank Commerzbank in figure 4.44 shows the pattern of a descending triangle. Figure 4.44 Commerzbank chart from 1101 to 0602. Descending triangle. Summary. By design, 3-point chart patterns are useful for determining trend reversals. However, 3-point chart patterns of the continuation type also can provide valuable information. Chart patterns are among the most important investment tools available. They express investor behavior and provide a rare consistent element in the analysis of structures in price data. Valid chart patterns do not occur too often, and traders have to look for them. It takes great patience to work with 3-point chart patterns. On the other hand, traders have to act instantly on most breakouts, and executing trades based on 3-point chart patterns requires considerable experience. A few results of empirical research may be helpful in understanding chart patterns. We are grateful for the efforts of Thomas Bulkovsky in sorting chart patterns according to statistical criteria. Readers of his works will find a statistics summary that includes performance statistics for all of the chart patterns discussed in his Encyclopedia Bulkovsky pp. 654 to 657. In the following paragraphs, we refer to the findings of Bulkovsky for the 3-point chart patterns we have tackled and some of the candlestick patterns discussed earlier. Before showing the statistics in tabular form, we need to state Bulkovsky's criteria. Bulkovsky defines a failure rate, which is the percentage of formations that do not work as expected, including 5% failures. The numbers apply to formations once they stage a breakout confirming the formation. Bulkovsky also distinguishes between reversal or consolidation. The letter R appears if the majority of formations act as reversals of the price trend, and the letter C appears for consolidations or continuations, as we call them. If both R and C appear in an entry, then the chart pattern has no overriding majority of either type. Furthermore, Bulkovsky separates throwbacks from pullbacks. A throwback is an upside breakout that returns prices to the top of the formation or trendline boundary. A pullback is a downside breakout that returns prices to the bottom of the formation or trendline boundary. Both occur after a breakout and return within 30 days. The percentages for throwbacks apply to formations with upside breakouts only, pullback percentages apply to downside breakouts only. In addition, Bulkovsky provides a measure for average rise or decline. He typically measures the average rise or decline from the price on the breakout day, using the daily high or low that is closest to the formation. The ultimate high or low is the highest or lowest point before a significant change in trend, typically a 20% price change, which is measured high to low. From these figures, Bulkovsky computes a value for likely rise or decline and tabulates a frequency distribution of the results. The most likely rise or decline is the range with the highest frequency and usually excludes the rightmost column. Most important to our readership is Bulkovsky's rank by score. He separates the table entries into bullish 1 to 35 and bearish 1 to 32 formations and then ranks them by their score. The score is the average rise or decline times the most likely rise or decline divided by the failure rate. The best rank is 1. Bulkovsky used bull market data for the 5 years beginning in mid-1991. Table 4.11 lists the relevant, in the context of this book, 3-point chart patterns and related candlestick patterns in alphabetical order. Table 4.11 Summary of statistics for 3-point chart patterns and candlestick patterns. Failure reverend rank. Rate and/or by formation %. Cand. Score. Broadening wedge, ascending 6R13 broadening wedge, descending, down 41R25 broadening wedge, descending, up 41R25 double bottom 3R4 double top 17R21 hanging man, down breakout 22C27 hanging man, up breakout 67R33 head and shoulder, bottom 5R9 head and shoulder, top 7R11 key reversal day, bottom 17R29 key reversal day, top 24R26 rectangle bottom, down breakout 4C8 rectangle bottom, up breakout 0R32 rectangle top, down breakout 0R31 rectangle top, up breakout 2C1 triangle, ascending 2C3 triangle. Descending 4C6 triangle, symmetrical, bottom, down 2C2 triangle, symmetrical, bottom, up 3R5 triangle, symmetrical, top, down 6R10 triangle, symmetrical, top, up 5C11 Source, Trading Classic Chart Patterns, by Thomas N. Bulkovsky, New York, Wiley, 2002 pp. 655 to 657. Reprinted by permission of the author. The table indicates that some of the chart patterns we have stressed do well and prove reliable in practical trading, at least according to Bulkovsky's rank by score. The greatest advantage of working with chart patterns is that skilled traders can execute them without elaborate computer programs. Although the 3-point chart patterns may look somewhat old-fashioned, they are powerful trading tools. 5 channel applications. Investors' behavior is expressed not only in chart patterns, trend formations, or sideways markets, but also in peaks and valleys. Every peak or valley is an indication of what the majority of investors expect at any moment in time. Intraday peaks or valleys, however, are not as meaningful as those on daily or weekly charts. Our analysis, therefore, focuses on daily data, but it may easily be extended to sets of weekly data. Whenever traders are looking for a good entry point to buy long or sell short, they want to come as close as possible to important turning points in the market. If they stay close enough to the market action, the stop-loss level is not too far away from the entry point. On the other hand, the profit potential is big enough to participate in longer. Market trends. Trading rules. Significant peaks and valleys in the markets are much more relevant than often assumed. Trend channels are generated by establishing major peak-to-peak and valley-to-valley connections out of regular 3-wave or 5-wave market moves. This is why trend channels should be the primary step when analyzing markets. Phi channels are improvements over regular trend channels and are generated slightly differently. A Phi channel analysis works with baselines as connections of significant high to low and low to high formations. See Figure 3.34 for a recap. Phi channels can be drawn either from impulse waves or from corrective waves by determining the outside parallel line of a Phi channel on the basis of the next significant peak or valley to the right of the baseline. As soon as a Phi channel has been established, the width of the Phi channel measured as the distance from baseline to parallel line can be multiplied by the ratios 0.618, 1.000, 1.618, 2.618, 4.236, and so on as shown in Chapter 3, Figure 3.35. Depending on whether the baseline of the Phi channel is trend following, running from valley to peak, or countertrend connecting peak with valley, it is possible to draw Phi channel trend lines or Phi channel resistance lines in various distances from the outside parallel line of the Phi channel. Combinations of Phi channel trend lines and Phi channel resistance lines create a spiderweb design for mapping market price action and predicting future market moves. In a trending market with more than 3 waves upward or downward, the baseline is adjusted to the most recent high in an uptrend or the most recent low in a downtrend. The outside line has to be adjusted to the peak or valley on the right side. Entry signals on Phi channels are generated when the outside line of the Phi channel and the most recent peak or valley are broken. Figure 4.45. Figure 4.45 Entry rule to establish a short position. This simple concept works well to define long or short market entries in many markets and products because the entry signals are generated after a failure in the price move. The peak or the valley that turns out to be a failure can occur either before or after the outside line of the Phi channel is broken. We receive a valid entry signal in both cases. The stop-loss level, as discussed throughout this chapter, is the most recent peak or valley in a loss after the sell signal or buy signal has been generated. This rule is illustrated on a short position in Figure 4.46. Figure 4.46 Stop-loss rule on a short position. Once we are stopped out, we have to wait for a new entry point. Figure 4.47 illustrates how to re-enter the market. Figure 4.47 Re-entry rule out of a flat position after a stop-loss. Most signals are reversal signals. Once we get stopped out, we have to wait until the market moves out of the trading range. We buy or sell as soon as the closing price trades above or below the peak or valley that marks the upper or lower border of the trading range. The trailing stop is again easy to explain and easy to understand. We work with the most recent peak on short positions or valley on long positions in a profit. After the trailing stop is triggered, we have to wait for a new Phi channel and a failure to get an entry signal. For a trading example that is a convincing application of the Phi channel rules, we have chosen the S&P 500 index over more than a year, between July 2001 and November 2002. Using just 16 months and only one product provides a limited sample for generalizations about the quality of the trading approach. However, the tested time frame contains uptrends, downtrends, and sideward markets and, therefore, it clearly indicates the trading potential of the Phi channel. Approach. Trading example. Trading Phi channels is appealing because they always stay close to the market action. Phi channels work best on volatile products such as stock index futures, financial futures, cash currencies, or volatile commodities. The approach is easy to follow, but traders must be disciplined to execute the trading signals. Figure 4.48 shows 12 relevant trading signals in the S&P 500 index for the period from July 2001 to November 2002. Figure 4.48 S&P 500 chart from 0701 to 1102. Simulation of trading signals based on 5 channels daily: L, entry long, S, entry short, XL, exit long, XS, exit short, stop loss. When there is no peak or valley after the entry, we have to work with a big stop loss, as seen after the long entry EL8 in figure 4.48. On the other hand, big trend movements are caught as well. When using this trading approach, we recommend starting with only a moderate leverage. The main reason we show a Fibonacci-related trading approach based on 5 channels is that later in the book we work with a similar concept when dealing with 5 ellipses. To limit the number of lines in the chart in figure 4.48, we show only the baselines of the 5 channels for each 3-wave price move and omit the outside lines parallel to the respective baselines. Table 4.12 summarizes the profits and losses on the sample trades. Table 4.12 Trading Signals. Profit. Loss in. Hash entry rule at exit rule at points. 1 buy long 1113.00, sell reverse 1131, or 18.002, sell reverse 1131.00, stop loss 1145.00, 14.00, 3 sell short 1136.00, buy reverse 1101, or 35.004, buy reverse 1101.00, sell reverse 1133, or 32.005, sell reverse 1133.00, buy reverse 1089, or 44.006, buy reverse 1089.00, sell reverse 1076.00, 13.007, sell reverse 1076.00, buy reverse 1040, or 36.008, buy reverse 1040.00, stop loss 980.00, 60.009, 9 sell short 975.00, buy reverse 912, or 63.0010, buy reverse 912.00, sell reverse 931, or 19.0011, sell reverse 931.00, buy reverse 866, or 65.0012, buy reverse 866.00, open. 5 channels can serve as trend lines and resistance lines depending on whether we work with peak to valley formations countertrend lines or valley to peak formations trend lines in an uptrend, vice versa in a downtrend. The S&P 500 index chart is an example of perfect symmetry in market action, which can only be captured by working with the Fibonacci summation series and the ratios from the Phi series. In Chapter 5, we present more Fibonacci-based market symmetry in the discussion of Phi ellipses as Fibonacci trading tools. Summary. Since this book is purely educational, we limit the analysis to one product and do not use time frames beyond the years 2001-2002. The results are convincing and leave plenty of room for creative readers to fine-tune and to cross-examine our example for alternative, and perhaps even more productive, Phi channels. Once Phi channel trend lines and Phi channel resistance lines are triggered, they are indicators of forthcoming market action. They do not have immediate forecasting value, but they can be important support or resistance levels for market trends. The S&P 500 index demonstrated that Phi channel lines drawn weeks or months ahead do not lose any degree of quality. The biggest limitation of Phi channels lies in the ratios of the Phi series, which quickly get too big to create meaningful Phi channel lines for the future. To solve this problem and to stay close to the markets, we have to work with every significant peak or valley in sequence. Newcomers to Fibonacci tools and graphic means of market analysis often find it difficult to correctly detect Phi channel baselines and the peaks and valleys through which to draw the outside parallel lines. Almost all traders, at first, make the mistake of overlooking the most significant peaks or valleys and, instead, choose smaller ones that bring Phi channel lines closer to the markets. How can traders distinguish correct phi channels from false ones? A correct phi channel is identified by looking at whether the first major turning point in the market after the phi channel is drawn finds its support or resistance in the first phi channel trendline or resistance line drawn at a ratio 0.618 or 1.000 at most. Once this condition is met, we can be sure that the following phi channel lines drawn at higher ratios from the phi series will be important support or resistance lines as well. Phi channel lines can be drawn exclusively with the OUTCOME.PLEASE software. Readers should check the user manual for instructions on quickly and easily getting to phi channel trend lines and phi channel resistance lines. The example in this chapter and additional sets of sample market data are included in the OUTCOME.PLEASE program. Phi channel lines are terrific tools to map out price action and to make investor behavior visible. Market swings can be followed up and down like a roadmap, as long as traders select the correct phi channel lines. Our findings are a strong indication that market price action is not random, but symmetrical. Just as Elliott realized, market price movements are like the tide, smoothly swinging forward and back again. 5. Phi ellipses. Because swing formations are easy to identify and integrate into computerized trading environments, traders or managers investing with smaller accounts often use peak and valley formations. Many profitable trades are possible as long as there are regular wave patterns and each impulse wave defines new highs or new lows by a wide margin. In multiple corrections with many false breakouts, swing systems are of little use since they are based solely on price analysis. When we add the time element to the market analysis, it filters noise out of the market moves and brings more stability into investment strategies. This is where phi ellipses come in. Working with phi ellipses is not easy. Their basic structure is simple, but because price patterns may change over time, the final shape of a phi ellipse that circumvents a price pattern may also vary. Initially, the application of phi ellipses may seem confusing because there are different forms and wave structures within a phi ellipse. In addition, phi ellipses can sometimes be linked together. Both skill and imagination are necessary to use phi ellipses as investment tools. 115. To deal with this complexity, we first describe the basic features and parameters of phi ellipses in detail. We then present examples that illustrate how to apply phi ellipses as Fibonacci devices to real time trading. Basic features and parameters of phi ellipses. The phi ellipse is a unique Fibonacci trading tool that can only be drawn by a computer. As mentioned in Chapter 3, phi ellipses identify underlying structures of price moves and circumvent price patterns. When a price pattern changes, the shape of the phi ellipse circumventing the respective market price pattern changes too. Nearly all market price moves follow the pattern of a phi ellipse. Phi ellipses are related to the Fibonacci ratio phi in a similar way as the Fibonacci summation series, as well as corrections and extensions, see Chapter 4. Generally speaking, the ratio of major axis A to minor axis B defines the shape of an ellipse. Ellipses are turned into phi ellipses in all cases where the ratio of major axis to minor axis AX equals A divided by B is a member number of the phi series. To make phi ellipses work as tools for chart analysis, we have applied a proprietary transformation to the mathematical formula that describes the shape of the ellipse. We still consider the ratio of major axis A to minor axis B of the ellipse, but in a Fisher transformed way, in mathematical terms AX equals A divided by B. We introduce phi ellipses as instruments for investments countertrending to market action. We observe whether a price move stays within a phi ellipse and invest accordingly if a price move breaks out of a phi ellipse at the very end. Historical charts show that almost all price moves in commodities, futures, stock index futures, or stocks can be circumvented with a phi ellipse. However, finding the correct phi ellipse is an art. It takes skill, experience, patience, and trust in the analysis to effectively use phi ellipses as Fibonacci investment tools. It is impossible to forecast the final shape of a phi ellipse at the beginning of a price move. As we later prove on various examples, phi ellipses may follow one after the other symmetrically. Small phi ellipses may be followed by long phi ellipses, or phi ellipses may be connected with each other, and so on. The challenge is to correctly interpret price moves and select phi ellipses accordingly. Once investors learn how to identify the appropriate market pattern, working with phi ellipses becomes easier. The remainder of this section is divided into two parts. We first examine the shape and the slope of phi ellipses, and include approaches for attaching and overlapping phi ellipses. In the second part, we address entry and exit rules for the generation of trading. Strategies from phi ellipses. Typical features of phi ellipses. Dealing with chart patterns depends a lot on the definition of swings, just as it depends on controlling impulse waves and corrections without losing sight of the main trend picture. The strength of phi ellipses, in this respect, is that no matter how many waves or subwaves are in a price pattern, we receive a solid overall picture of the total price pattern as long as a phi ellipse can circumvent it. Even if we reduce the analysis to a simple three-swing pattern, an indefinite number of combinations of impulse waves and corrections will be possible. Impulse waves are fairly simple to handle, whereas dealing with corrections and long sideward periods in the markets can be very tricky. Traders and analysts call these periods noise in the markets. Phi ellipses are ideal geometrical trading tools for coping with noise and analyzing price moves over time without having to focus too much on every intermediate minor peak or valley between the starting point and the ending point of the price pattern. The best way to demonstrate the generation of phi ellipses is by starting with a circle and then turning the circle into phi ellipses. A circle is a special kind of phi ellipse because the ratio of the major and minor axes is 1.000 from the phi series. Figure 5.1 shows the process of generating phi ellipses. From the circle, ongoing phi ellipses can be drawn at alternative axis ratios 1.618, 2.618, 4.236, 6.854, 11.090, 17.944, 29.034, and so on, from the phi series. According to the mathematical formula. Figure 5.1 generation of phi ellipses using different ratios from the phi series. From top left to bottom right, ratio 1000 circle, ratio 1.618, ratio 4.236, ratio 6.854, ratio 11.090, ratio 17.944. 118. For Fisher transformed phi ellipses, the length of the major axis remains unchanged. The minor axis thereby gets shorter and shorter. The resulting phi ellipses become narrower and narrower and finally perfectly enclose the entire price move. It is evident from the sample charts that because ellipses have such special structures, they can only be used on computers and with particular software packages. Fisher transformed phi ellipses, moreover, are unavailable elsewhere and can only be generated by running the WINPHI graphics software that accompanies this book. Phi ellipses are interesting graphical trading tools because their very structure is founded on a three-wave pattern, as shown in Figure 5.2. Figure 5.2 General structure of a three-wave pattern. Once we have identified the 3 points A, B, and C in the idealized three-wave swing, we can position the phi ellipse around these 3 points. Wave 1 from A to B is an impulse wave. Wave 2 from B to C is the corrective wave to the impulse wave. For wave 3, we expect a second impulse wave in the direction of the first impulse wave. The fundamental structure of the phi ellipse provides another way to analyze price moves. Because it is dynamic over time and follows price patterns as they develop, we must be patient and wait, from the very beginning to the very end, until a price move stays within the phi ellipse. As soon as the market price moves out of the phi ellipse, action is possible, but only if a price pattern runs completely inside a phi ellipse until reaching the final point. As a general rule, if the angle of a phi ellipse is sloping upward, we can sell at the end of the phi ellipse. If the slope of the phi ellipse is downward, we can buy at the end of the phi ellipse. The exceptions to this rule are described later. It is important to remember that phi ellipses are not means of forecasting market moves. We will never know in advance whether a price move will stay within the phi ellipse and reach its end so that we can take action. We must always wait to see if a price move stays inside the borders of the phi ellipse, and we cannot take action unless the move meets the final point of the phi ellipse. The rationale behind this waiting principle becomes clear in the examples later in this chapter. Working with phi ellipses means watching price action as it progresses. Price action starts with the impulse wave 1 from A to B in figure 5.2, followed by the correction from B to C in the discussion of corrections and extensions in Chapter 4. Elliott's wave principles helped us determine that the corrective move was not expected to go lower than the low at the beginning of wave 1. Only in exceptional cases did we consider bull traps and bear traps. With phi ellipses, however, we consider all sorts of three-wave moves as long as we can put a phi ellipse around them. See Figure 5.3. Figure 5.3 Phi ellipse circumventing a three-wave price pattern. The three-swing pattern in Figure 5.3 is an ideal picture of a price move, but in reality, waves within a phi ellipse may take many forms and magnitudes. As price action progresses, peaks and valleys may touch the outside of a phi ellipse several times without destroying the pattern. We have analyzed and worked with phi ellipses for many years, and have found it fascinating to observe the different kinds of price action within phi ellipses. Based on the developing price action, phi ellipses might need adjustment, which is why working with them takes such discipline. But once investors get used to them, they realize that phi ellipses are amazing Fibonacci-related trading tools. There are many possible price behaviors within phi ellipses. According to the appropriate ratio for drawing a phi ellipse chosen from the phi series, see Figure 5.1, phi ellipses may be fatter or thinner, longer or shorter. But these facts do not have to worry investors too much, because price action itself shows up before the final structure of the phi ellipse. Investors must have tremendous patience and flexibility to wait until market pricing reaches the end of the phi ellipse. However, the dynamism and flexibility of phi ellipses can also be an investor's strength, because no other investment tool can make price patterns as graphically visible. There is no guarantee, only a high probability, that the end of a phi ellipse will ever be reached. If the final point of a phi ellipse is not reached and market pricing leaves the borders of the phi ellipse prior to the end, then we have to reevaluate price action and start looking for the next phi ellipse that unfolds. Figure 5.4 shows two typical price movements that do not reach the final points of the phi ellipses. Figure 5.4 Price movements not reaching the final points of phi ellipses. We cannot define a standard phi ellipse that suits every product. To work properly with phi ellipses as investment tools, we must identify the minimum length and the minimum thickness of relevant phi ellipses for every product that we trade. Each product reveals its characteristic price behavior in typical price patterns that we can identify only with historical charts. The attached WINPHI software package is designed to backtest Fibonacci tools on historical data. It would not be enough to analyze any kind of historical data. It is important to analyze all of the historical data with the same price scale. A phi ellipse specific for a certain product can be identified only when the price scale over the test period remains the same. This identification routine has to be done by hand with the aid of computer graphics capabilities. Once the length and thickness of a typical phi ellipse for any given product are identified over 10 years or more with a constant price scale, the probability is high that investors can use this phi ellipse for future trading. Phi ellipses tell us where we are in the market price action at any point in time. Whenever a market trend reverses at the end of a phi ellipse, we can take the final point of an old phi ellipse as the beginning of a new one. See Figure 5.5. Figure 5.5 Attaching phi ellipses. New phi ellipses often start to develop as soon as price patterns reach the end of old phi ellipses. This occurs especially when phi ellipses have a steep upward or downward angle. Since phi ellipses work best as countertrend investment tools, sideward markets provide the most favorable price patterns. whenever market price action moves out of a phi ellipse before reaching the final point of the phi ellipse, either to the upside or to the downside, we can assume a new market price pattern as beginning that might fit into a new phi ellipse. In addition to attaching phi ellipses, we may also find overlapping phi ellipses as shown in Figure 5.6. Figure 5.6 Overlapping phi ellipses. The slope of a phi ellipse is another parameter that traders must not underestimate. This slope determines the profit potential of countertrend trading signals from market entry point to profit target. See Figure 5.7. Figure 5.7 Profit potential based on the slope of phi ellipses. The slope of a phi ellipse often is small, as can be expected in sideways markets. In these cases, the beginning of a new phi ellipse and the end of an old phi ellipse are likely to overlap, as can be seen in Figure 5.6. Monitoring the slope of a phi ellipse is important. Like the countertrend moves at the end of extensions, see Chapter 4, retracements of 38.2% or 61.8% at the points of major trend changes in the markets should go back in the direction of the initial impulse wave. The steeper a phi ellipse develops, the larger the distance becomes from wave 1 to the final point of the phi ellipse. The greater the distance becomes from wave 1 to the final point of the phi ellipse, the larger the profit potential in points on 38.2% or 61.8% retracements to this distance. In addition to circumventing chart patterns in an actual or short-term trend, phi ellipses may also circumvent the bigger picture from a long-term perspective. This might include a couple of smaller trend changes, see Figure 5.8. Figure 5.8 Long-term phi ellipse circumventing short-term phi ellipses. Investors who use phi ellipses must monitor price moves consistently. This is a minor problem on weekly and daily data, but on intraday data, there is a lot of pressure to identify and to wait for the end of a phi ellipse. Therefore, phi ellipses on an intraday basis have to be handled with care and can only be recommended for experienced Fibonacci traders. Simultaneously analyzing the same product on weekly and on daily data often benefits the outcome of the analysis. For example, recognizing a phi ellipse with a strong uptrend from weekly data will help to identify the correct trading signals in daily data. Figure 5.9 illustrates the latter notion. Figure 5.9 Simultaneous analysis on weekly and daily phi ellipses. To identify the best average phi ellipse for any given product requires a software package like our WINPHI program, which allows investors to draw any phi ellipse desired on sets of historical data and on a constant price scale. Once traders have identified the phi ellipse for any particular product, they can apply it to real-time trading. Identifying specific phi ellipses is like pattern recognition in the markets. Pattern recognition has an advantage, however, because stable price patterns detected on historical price moves have a chance of repeating and can become trading indicators for the future. Entry rules and exit rules. The basic strategy for trading the markets using phi ellipses is, first, to wait for a price move to develop inside the borders of a phi ellipse and, second, to act counter to the main trend direction as soon as the end of the phi ellipse has been reached and market pricing leaves the phi ellipse. Catching the rhythm of market moves by attaching phi ellipses and adding countertrend trades to each other is illustrated in Figure 5.10. Figure 5.10 Basic scheme of investment by using phi ellipses. We recommend selling at the end of a phi ellipse when it has an upward slope and buying at the end of a phi ellipse when it has a downward slope. An entry rule confirms trend reversals to the upside or to the downside at the end of a phi ellipse. The rule is set to the lowest low of the previous 1, 2, 3, or 4 days for sell signals, and the highest high of the previous 1, 2, 3, or 4 days for buy signals. See Figure 5.11. The choice of entry rule depends on the investor's risk preference and time frame for entry. Figure 5.11 4-day lowest low entry rule. As soon as we are invested on a short position, we define a stop or a stop reverse point at the highest high of a price bar within the previous phi ellipse. If we are invested long, we protect our position with a stop loss set to the lowest low of a price bar within the previous phi ellipse. Figure 5.12 illustrates a stop-loss protection on a short position. Figure 5.12 stop-loss protection on a short position. For an alternative entry point, we may consider the trend channel that touches the relevant phi ellipse on either side. See Figure 5.13. Figure 5.13 short entry on a combination of phi ellipse and trend channel. By choosing the conservative option of a double confirmation by phi ellipse and trend channel, we accept that we may sacrifice some of the profit potential that could have been realized with a more sensitive entry rule. On the other hand, we may avoid a number of losing trades in strong trending market conditions by staying in the trend channel as long as it lasts. If the market price leaves the phi ellipse at the very end and immediately rises to new highs, we get a buy signal at the level of the highest high made within the phi ellipse. Figure 5.14 illustrates our strategy for dealing with runaway markets. For sell signals, the correct entry point runs vice versa. Figure 5.14 long entry on a runaway market. The stop-loss a stop reverse level on this buy signal is set to the lowest low of the previous 3 days, starting on the day when the market price reached the end of the phi ellipse. See Figure 5.15. On sell signals on runaway markets, the stop-loss a stop reverse level is the opposite. It is set to the highest high of the last 3 trading days inside the phi ellipse. Figure 5.15 stop protection on runaway long entry. If a market position is established and the market price moves in the anticipated direction, the investor must decide when to take profits. Several options are available to the investor: trailing stop exits, profit target exits, exits on extensions, time exits based on the Fibonacci summation series, and exits on the end of a phi ellipse. The most conservative strategy is to work with a trailing stop set to the high of the previous 4 days on sells, vice versa on buy signals. In most cases, this option protects at least part of the profits, but it also means giving away open profits already accumulated. See Figure 5.16. Figure 5.16 trailing stop exit on previous 4-day high breakout. If we do not want to give up any of our accumulated profits, we can take the risk that the market might move in the direction of our signal after we get stopped out in a profit. In this case, we should predefine a fixed profit target level to cover a position. We select profit target levels that can be derived from the phi series introduced in Chapter 4. The levels we work with are 38.2%, 50.0%, and 61.8% of the total preceding market move, which is the distance from bottom to top of the phi ellipse that generated our entry. See Figure 5.17. Figure 5.17 profit target levels are 38.2% and 61.8%. The profit target level that an investor favors depends not only on the risk preference of the investor, but also on the amplitude of the preceding phi ellipse. If the initial move inside the phi ellipse is smaller than a sample 200 ticks in the Japanese yen cash currency, e.g., from 110.00 to 112.00, a larger profit target level of 61.8% is preferable, otherwise, the profit potential is too small. On the other hand, if the total amplitude of the underlying move is 10 full points, e.g., from 110.00 to 120.00 in the Japanese yen cash currency, a profit target level of 38.2% might be good enough for an investor to minimize risk. In addition to trailing stop exits and profit target exits, we can wait for a 3-wave swing in the direction of our signal and an extension out of this 3-wave swing. As explained in Chapter 4, we precalculate the size of an extension by multiplying the amplitude of wave 1 by the Fibonacci ratio 1.618. We liquidate a position as soon as the profit target level in the direction of our signal has been reached at 1.618 times the amplitude of wave 1. See Figure 5.18. Figure 5.18 profit target exit on an extension out of a 3-wave move. Price targets are a solid way of exiting positions, but we can also define targets in time to protect accumulated gains. To establish the average standard length of phi ellipses on any product based on numbers of the Fibonacci summation series, we can use historical data along with the constant scale supplied by the WINPHI software and conduct test runs. If we then find out, for a certain product, that the average length of phi ellipses is 21 days, we can exit positions that have not been stopped out after 21 days given that they trade in a profit. The total move in the direction of our signal might continue, but we are content with the profit that we have realized with the Fibonacci count. Two additional conditions are that there has to be at least one three-wave move within the 21 days and that the price move must stay within the shape of a phi ellipse. See Figure 5.19. Figure 5.19 Profit target exit on a Fibonacci count of 21 days. If the price move on our established position follows the shape of a phi ellipse, a fifth exit rule must be considered. We can wait until the market price reaches the end of the new phi ellipse and exit the position at the end of the phi ellipse. This exit rule requires the most patience and the strongest discipline, but it has the biggest profit potential of all 5 exit rules in our analysis of phi ellipses. Figure 5.20 illustrates how to exit a position on the end of a phi ellipse. Figure 5.20 Profit target exit on the final point of a phi ellipse. Attaching phi ellipses, as explained in the final exit rule, is the perfect approach for catching the rhythm of markets, but of course, market rhythms are not always ideal and perfect. The following section explains how to work with phi ellipses as geometrical Fibonacci trading tools. Working with phi ellipses on daily data. Working with phi ellipses is easy if we understand the rationale behind them. Phi ellipses develop over time. The magic of phi ellipses is that the perfect form exists inherently from the beginning, but as users and investors, we only recognize the phi ellipses at their very end. Although all phi ellipses share a common key structure, their final forms vary, becoming thick or thin, long or short. They are individual manifestations of smaller trend moves or part of the bigger picture of a circumventing major trend. The high in downtrends and the low in uptrends of the correction wave 2 in our wave count determine the slope of a phi ellipse. Because we always need 3 points to draw the first picture of a phi ellipse, we then have two possibilities. In the first case, the low of the correction in wave 2 in an uptrend is above the bottom of wave 1, vice versa for highs instead of lows in downtrends. Depending on whether we have a 38.2%, 50.0%, or 61.8% correction, the slope of a phi ellipse will be bigger or smaller. See Figure 5.21. Figure 5.21 Slope of phi ellipse is upward in relation to correction levels. The second possibility is that the correction wave 2 goes below or above the starting point of wave 1 in an uptrend or downtrend. In this case, the slope of a phi ellipse could turn out very small. As shown in Figure 5.22, a small phi ellipse slope indicates a sideward market. Figure 5.22 Slope of a phi ellipse is an indicator of a sideward market. Phi ellipses work on monthly, weekly, and daily charts, and those are the data compression rates on which we have conducted our analysis. When it comes to intraday charts, phi ellipses will also work on hourly charts. However, to avoid complicating the analysis at this point, we defer the description of intraday samples until later in this chapter. The length of the correction in wave 2 after the first impulse wave often determines the length of a phi ellipse. We cannot know in advance how long the formation of wave 2 will last, however, so we do not recommend trading if the formation of a phi ellipse is in progress. Wave 3, as the second impulse wave in our count, must be at least as long as the first impulse wave. Therefore, we have to adjust the width of phi ellipses on multiple sideward patterns. See Figure 5.23. Figure 5.23 Adjustment of phi ellipses based on the duration of corrections. We now focus our analysis on sets of daily charts of the Japanese yen cash currency and the S&P 500 index. As mentioned, we have selected these products for their public interest, volatility, and liquidity, and because they especially represent investors' behavior, which is the underlying maxim of Fibonacci analysis. In principle, of course, phi ellipses can be applied to every product traded. We rely on only an 8-month time span for each of the two products, and during that time not one phi ellipse is like the other. This is similar to the work we have done with extensions and corrections. Even though we apply the ratio 1.618 to different price moves, the size of every price move results in the precalculation of different price targets. The same result occurs when we work with phi ellipses. We do not analyze a single swing pattern, but rather, a complete set of swings, smaller ones and bigger ones. Therefore, a major phi ellipse will circumvent the complete and much bigger price pattern with sometimes many or sometimes very few smaller price patterns in between. Phi ellipses have their roots in the Fibonacci ratio phi in the ratios from the phi series. We can combine phi ellipses with other Fibonacci tools, such as the Fibonacci summation series, extensions, and corrections. Doing so gives us an early indication where a phi ellipse might end. Because phi ellipses develop over time, the combination of Fibonacci tools is helpful to confirm multiple phi ellipses in progress. Based on the knowledge we accumulated from the analysis of extensions using the Fibonacci ratio 1.618, we can precalculate a price target from the amplitude of the first impulse wave inside the phi ellipse. Independent of any future market move patterns, we can then assume that if the market price ever reaches the precalculated price target, it might also mean the end of the progressing phi ellipse in price and time. Phi ellipses on Japanese yen cash currency sample data. To begin our discussion of applications of phi ellipses to market data, we first show a daily chart of the Japanese yen cash currency with no added tools. In figure 5.24, the plain chart represents just the data stream and enables the analyst to see how phi ellipses will later fit into the overall picture. The second chart in figure 5.24 contrasts the set of OHLC open high-low close data by integrating phi ellipses, which serve as the backbone of our analysis of the relevant market moves. Figure 5.24 Japanese yen chart from 0200 to 0201. Plain OHLC price move and price move with phi ellipses PHI01 to PHI08. The relevant phi ellipses have been numbered PHI01 to PHI08 in figure 5.24. We refer, consecutively, to all 8 phi ellipses and demonstrate in depth how they were generated. The basic structure of phi ellipses is always the same. When drawing a phi ellipse, its borders must define and touch at least 4 points. The 4 points are 1. Starting point of the phi ellipse, 2. Left side, 3. Right side, and 4. Bottom of the phi ellipse. The starting point is usually the highest or lowest point in a price move. But there are exceptions in patterns such as irregular tops or bottoms, overlapping phi ellipses, or very small angles in a phi ellipse. Phi ellipse PHI01 isolated in figure 5.24 consists of a simple 3-wave pattern that should, by now, be familiar to readers. See figure 5.25. Figure 5.25 Japanese yen chart from 0400 to 1100. Phi ellipse PHI01. The starting point in PHI01 is A, and the first of the two side points is B. We can already draw a phi ellipse through the peak at point C, but to complete a phi ellipse in a 3-wave pattern, the third wave has to go lower than point B. The price move does not go lower than point B after reaching C. Instead, it makes a higher high than C, changing the side point from C to C1. This may happen at any time when we work with phi ellipses. From C1, the price move goes quickly to point D. However, at valley D, we do not know whether this is the low to watch, for even though we can draw the phi ellipse through point D in its final form, we have to wait for the market price to go outside the phi ellipse at point F. A Fibonacci count can be used as an additional indicator to determine whether point D is actually a significant low point. Valley D occurs one day after number 21 of the Fibonacci summation series, the count beginning once starting point A has been reached. The number 21 is a very important Fibonacci count that is always worth checking. At point F, where the market price move leaves phi ellipse PHI01, a trading signal is generated and executed based on the following 3 parameters. 1. Entry market as soon as the border of PHI01 is broken. No further entry rules apply because the entry level is already far above the previous 4-day high. 2. Stop loss protection set to the value at point D, which is the lowest low inside PHI01. 3. Trailing stop to protect profits, defined as a breakout of a previous 4-day low. The trailing stop formation is triggered at point G. The simple phi ellipse PHI01 is a convincing example of how successful signals can be derived straight from the core application of this trading tool. From this basic example, we can proceed to much more complex formations that are also subject to analysis on the basis of phi ellipses. PHI02 has a much thinner and longer form than PHI01 because the price pattern is not a 3-wave move, but a 5-wave move. The first swinger to B and back to C is established quickly, but a phi ellipse drawn around these swings has no stability. After the following waves to the valley at point D and the peak at point A have established side points determining the final shape of PHI02, we will then be able to correctly draw PHI02 to generate a trading signal. See Figure 5.26. Figure 5.26 Japanese yen chart from 0400 to 1100. Phi ellipse PHI02. In addition to noting the shape of PHI02, it is important to measure the underlying 5-wave swing based on extensions of wave 1 and also wave 3. The amplitude of wave 1, multiplied by the ratio 1.618, and the amplitude of wave 3, multiplied by the ratio 0.618, both point closely to valley F, which then marks the final point of PHI02. Readers who get confused here, please review the Chapter 3 discussion of extensions in 5-wave patterns. The day of the lowest low is day 32 counted from the high of the first impulse wave of the price move at point A, which is too close to the Fibonacci count of 34 to ignore. The turning point in the Japanese yen cash currency market just below 104 Japanese yen is confirmed through 4 methods. 1. Elliott 5-wave count. 2. The ratio 1.618 on wave 1. 3. The ratio 0.618 on wave 3, and 4. Phi ellipse PHI02. Here, aggressive investors find 4 good reasons to buy US dollars and sell Japanese yen immediately at a level of 104.00. Somewhat conservative investors, however, should wait to get the final confirmation at the point where the market price moves out of the sideline of PHI02. The second approach leads to the following trading outcome. Entry on a breakout of a previous 4-day high after PHI02 is left by the price move. Stop loss protection set to the valley at point F, which is the lowest low inside PHI02. Trailing stop to protect profits, defined as a breakout of a previous 4-day low. The trailing stop formation is triggered at point G. As mentioned, a minimum width is necessary to work properly with phi ellipses as trading tools. The smaller phi ellipses become, the higher the ratios from the phi series must be to draw phi ellipses around price moves. PHI03 is a typical example of a very narrow phi ellipse. See Figure 5.27. Figure 5.27 Japanese yen chart from 0400 to 1100. Phi ellipse PHI03. Analyzing the 3-wave move from A to B back to C shown in Figure 5.27, we find that it takes only 5 days to complete the entire swing before the market price accelerates sharply above the significant peak at point B of the swing. Although PHI03 can be drawn after the side points D and A have been established, we do not invest in such phi ellipses because the width is too narrow. PHI03 is drawn at a ratio 46.979 from the phi series. This ratio is far beyond the limit of a ratio 17.944, which is the highest ratio from the phi series that is appropriate for an application to phi ellipses. See Figure 5.1 for a recap. The same holds true for PHI04, which is drawn at ratio 29.034 from the phi series PHI04 as part of the overall picture in Figure 5.24. The first 4 examples were selected to introduce trading decisions based on phi ellipses. PHI05 shows that making trading decisions is sometimes difficult because various options exist on the entry side as well as on the exit side. See Figure 5.28. Figure 5.28 Japanese yen chart from 0400 to 1100. Phi ellipse PHI 05 in combination with the narrow phi ellipse PHI 04 for the exit rule. PHI 05 begins with a strong first wave from starting point A to point B. Point B is part of the A, B, C correction in the second wave and does not touch the outside line of the phi ellipse. Point C becomes the second side point of PHI 05 as soon as the market price moves lower than point B. The third wave of the price move goes very quickly from point C to D. Point D is the end of the price move. Market pricing reverses at point D for two possible reasons. 1. Point D does not go lower than the bottom of the phi ellipse. 2. Point D is almost exactly the price target of the extension calculated from impulse wave 1, which goes from point A to point B. Even though point D is confirmed by multiple Fibonacci tools, before we can invest, we need a confirmation of a trend reversal. Two options exist for a buy signal. The first option has the following parameters. No waiting for PHI 05 to be broken to the right side and entry to the market on a breakout of a previous 4-day high. This entry rule is filled at point F in figure 5.28. Stop loss protection set to the value at point D. Trailing stop to protect profits defined as a breakout of a previous 4-day low. The trailing stop formation as triggered at point G. The second of the two options for entering the Japanese yen cash currency market long works with a different set of parameters. Initial buy when the sideline of PHI 05 is broken at point L, which is also higher than the previous 4-day high. Stop loss protection set to the swing low at point H. Trailing stop to protect profits defined as a breakout of a previous 4-day low. The trailing stop formation as triggered at point J. Using the second option, we can close out the position by combining PHI 05 with PHI 04, which is the one we do not consider on the entry side because it is drawn at too high a ratio from the phi series. We exit our position at point K, figure 5.28, when the market price breaks through the sideline of PHI 04. Phi ellipse PHI 06 is an example of capturing a medium-term 3-wave uptrend over 3 months and generating a short signal from it. See figure 5.29. Figure 5.29 Japanese yen chart from 0400 to 1100. Phi ellipse PHI 06. PHI 06 is based on the symmetrical price move from points A to B to C to D. The 3-wave swing has an ABC correction in wave 2, which at the same time gives shape to PHI 01. See figure 5.25. Our basic investment decision is countertrend at point D to price goals X and X1 confirm the trend reversal at point D. We reach goal X by multiplying the amplitude of the price move from A to A1 by the Fibonacci ratio 1.618. Price goal X1 is defined by multiplying the amplitude of the market move from point A to point B by the ratio 0.618. Both price targets X and X1 are close enough together to lead to strong resistance at these price levels and a high probability of a trend reversal as soon the target prices are triggered on the uptrend. To invest on PHI 06, we have two more options. The relevant factors of the first option are immediate entry short at point D on a previous 4-day low, due to the confirmation of the trend reversal by the price goals X and X1, even if PHI 06 has not been broken. The entry rule is filled at point E. Stop loss protection set to the highest high at point D. Trailing stop to protect profits defined as a breakout of a previous 4-day high as long as the short position has not been stopped out in a loss. Definition of profit target levels are 38.2%, 50.0%, and 61.8% of the distance measured from points A to D, alternatively to the trailing stop exit rule. The second option runs a little differently and delays the entry. This is because we wait conservatively for the final point of PHI 06. We use the following set of parameters. Entry short on a previous 4-day low after the market move left PHI 06. Stop loss protection set to the highest high inside PHI 06. Trailing stop to protect profits, defined as a breakout of a previous 4-day high as long as the short position has not been stopped out in a loss. Definition of profit target levels are 38.2%, 50.0%, and 61.8% of the distance measured from points A to D, alternatively to the trailing stop exit rule. It depends on the risk preference of investors whether an entry on the double confirmation of the trend reversal by 2 Fibonacci extensions is solid, or whether sticking with the overall rule of first waiting for the final point of PHI 06 remains preferable. With PHI 07, the perspective once again broadens and shifts from midterm to long-term analysis. PHI 07 is a splendid example of how investors can identify patterns with phi ellipses and use pattern recognition over the short-term, midterm, and long-term. Investors' behavior is expressed in both small and big patterns, which in the end are all integrated into the same picture, as shown in Figure 5.30. Figure 5.30 Japanese yen chart from 0400 to 1100. Phi ellipse PHI 07. PHI 07 circumvents 5 of the 6 phi ellipses discussed thus far. Only PHI 02 is not circumvented by PHI 07. As mentioned, phi ellipses develop over time, and it is important to be patient and wait until the total picture reveals itself. The first critical point in the development of PHI 07 is point X as the side point of the three-wave pattern from A to F and back down to X. Figure 5.30. The side point X changes to side point Y at the same moment that PHI 01 reaches its final point. The final shape of PHI 07 is realized when the side point changes from X to Y and when the final point of PHI 06 is reached, merging with the final point of PHI 07. Such a phenomenon seldom occurs, and is only documented in a long-term analysis with multiple phi ellipses. Our findings demonstrate how important it is to combine the short-term and long-term perspectives of investment strategies. The beauty of Fibonacci trading tools is that they work perfectly together. According to the general investment rules on phi ellipses, the final points of PHI 06 and PHI 07 provided opportunities for establishing a short position. However, the market in Japanese yen cash currency did not go lower, as assumed, but higher. See Figure 5.31. Figure 5.31 Japanese yen chart from 0200 to 0201. Phi ellipse PHI 08. A pattern like the one shown in Figure 5.31 is a rare exception, but it confirms that the end of a phi ellipse is either an indication of a trend change in the opposite direction or a breakout in the main trend direction. In most cases, the market price reverses at the final point of a phi ellipse. But the long-term picture in the Japanese yen cash currency reveals that after selling short at the end of PHI 06 or PHI 07 and getting stopped out of the short position, it is wise to reverse the position to the long side. There is enough trading potential to the upside, represented by PHI 08, which is well established and defined by the starting point and two side points. Examples like the short trades on PHI 06 and PHI 07 make it clear that Fibonacci tools are ordinary trading tools. This means that even on the best-looking patterns, trades might turn out to be losing. As long as traders work with a solid stop-loss rule, any harm done by losing trades remains under control. To increase the profitability of investments, we recommend combinations of Fibonacci trading tools, candlesticks, and chart pattern recognition. Phi ellipses on S&P 500 index sample data. Trading the phi ellipse is the sort of improved trading approach that was described in Chapter 4. This approach works on every product, stocks, stock indexes, financial futures, or commodities. We do not think that trading signals with phi ellipses can be computerized, since the strength of the phi ellipse, adjusting dynamically to every price move, is very difficult to program. However, the sophisticated trader who has learned to adjust the phi ellipse to different price moves can easily trade it by hand. Our website, OUTCOME, provides a model portfolio with advice on how to trade the markets using the phi ellipse. In most cases, trading with the phi ellipse means trading counter to the market trend direction, but occasionally the trades go in line with the trend direction. In our long-term example on the S&P 500 Futures Index, we show some of these trades as well. To trade systematically with the 5 ellipse, we have to introduce an entry rule, a stop loss rule, and a trailing stop rule. Under normal circumstances, we enter the markets counter to the main trend direction. The entry rule is filled when the outside line of the 5 ellipse and the most recent peak or valley are broken. The peak-valley breakout condition is an amendment to the entry rule described in Figure 5.13. The reason for introducing the peak-valley breakout as an amendment to the general rule is that the entry signals are often generated after a failure in the price move. The peak on short entries or valley on long entries may show up before or after the market price move breaks the outside of the 5 ellipse that we are watching for our market entry. The stop-loss level on countertrend entries as the most recent peak or valley generated after the sell or buy order was filled. See Figure 5.32. Figure 5.32 stop-loss on a recent peak breakout on a short position. Once we are stopped out, we have to wait for a new outside line of the 5 ellipse to be broken in accordance with our entry rule. In 2 exceptional cases, we enter the market in line with the major trend direction. The first case is the sideward market manifested in a horizontal 5 ellipse as illustrated in Figure 5.33. Figure 5.33 establishing a short position on a horizontal 5 ellipse. In a sideward market, there is no major trend direction. We enter the market short or long in line with the short-term trend as soon as the outside line of the horizontal 5 ellipse and a valley or peak are broken. When we buy or sell at the end of a 5 ellipse, we rarely get stopped out. If we find the scenario of a runaway market, we reverse our position at the stop-loss level. See Figure 5.14 for a recap. To exit our positions, we apply trailing stops and define them as the most recent peaks on short positions and valley on long positions in a profit. This is a slight modification of the 4-day high-low breakout trailing stop rule from Figure 5.16. The peak and valleys used as trailing stops should not be defined in a too sensitive manner. They should consist of at least 2 lower highs for peaks or 2 higher lows for valleys on either side of the highest high or lowest low. In our S&P 500 index trading example on daily data, we show a total of 15 signals between February 2001 and November 2002. See Figure 5.34. Figure 5.34 S&P 500 chart from 0201 to 1102. Simulation of trading signals based on 5 ellipses daily. L, entry long, S, entry short, XL, exit long, XS, exit short, stop loss, as, trailing stop. Generalizing the quality of this trading approach is impossible with a time period of just 22 months and signals for only one product. Nevertheless, because the test period includes uptrends, downtrends, and sideward market conditions, it clearly indicates the potential of trading 5 ellipses. To avoid complicating the chart with too many outside lines, we show only the relevant 5 ellipses and omit the outside lines of the 5 ellipses. Interested readers can work with the WINPHI program and the data on the CD-ROM to generate the same signals and study the concept. Profits and losses can be checked trade by trade according to Table 5.1. Table 5.1 Trading Signals. Profit. Loss in. Hash entry rule at exit rule at points. 1 buy long 1165.00 trailing stop 1244.79.002 sell short 1248.00 buy reverse 1228.020.003 buy reverse 1228.00 stop loss 1202.00 sell short 1174.00 buy reverse 1087.087.005 by reverse 1087.00 stop loss 1073.00 14.006 by long 1115.00 trailing stop 1131.16.007 sell short 1117.00 by reverse 1102.15.008 by reverse 1102.00 trailing stop 1154. 52.009 sell short 1134.00 trailing stop 1132, 2.0010 buy long 1092.00 sell reverse 1077.00 15.0011 sell reverse 1077.00 trailing stop 1040, 37.0012 sell short 975.00 buy reverse 912.00, 63.0013 buy reverse 912.00 sell reverse 932, 20.0014 sell reverse 932.00 buy reverse 866, 66.0015 buy reverse 866.00 open. This trading approach always stays close to the market action. It works best in volatile products such as stock index futures, financial futures, cash currencies, or volatile commodities. It is easy to follow, but it takes discipline to execute the trading signals. There might be times when there is no peak or valley close enough after the entry and, therefore, the original stop loss might be far away. But in general, V-turns after an entry are rare. In all of our sample signals, reasonable peaks or valleys are formed by the price action after the entry, thus reducing the original stop loss risk substantially. On the other hand, the trading approach catches major market trends as well. However, when running this concept as a trading approach, it is best not to start with too much leverage. 5 ellipses on constant scales. The 5 ellipses work equally well on daily, weekly, and monthly charts. Hourly charts are interesting for analysis on intraday data, for they show a very short-term picture. The problem with intraday charts is that entry rules, profit targets, and stop-loss rules may leave investors with small profit potentials. On the other hand, the overall risk per trade also is limited. The risk level is one of the reasons we enjoy working with cash currencies on a daily basis. Cash currencies trade 24 hours a day without gap openings and other inconveniences that may dilute the performance profile. Long-term historical test runs are necessary to judge the quality of 5 ellipses for products to be traded. A feature for plotting historical data to charts with a constant price scale has been integrated into the OUTCOME.PLEASE software. 2 or 3 years of daily OHLC data are impossible to plot to the width of one screen, and when scrolling the screen, the price scale usually varies according to the highest high and the lowest low of the data. The OUTCOME.PLEASE constant scale feature is a key element, because scaling to screen height would otherwise distort the angles of 5 ellipses applied to market moves. 5 ellipses on constant scales in the Japanese yen. Cash currency. We have analyzed more than 2 years of the Japanese yen cash currency daily bar data from September 1998 to December 2000 and have backtested the 5 ellipses. The total stream of data over 27 months is divided into 2 charts. By choosing a set of appropriate 5 ellipses and waiting for market pricing to move out of them at their final points, our sample investments follow the price pattern in the Japanese yen cash currency with very few exceptions. See Figure 5.35. Figure 5.35 Japanese yen chart from 0998 to 1200. Attached and overlapping 5 ellipses on a constant scale. Working with the constant scale feature is the only way in geometrical chart analysis to achieve an undistorted picture over such a long period. It is often difficult to believe in the power of the 5 ellipse. Trading with 5 ellipses on daily data generates about 1 trade per month, depending on whether inside 5 ellipses are found. The pattern of inside 5 ellipses can be seen in the time period from September 2000 to December 2000 in Figure 5.35, where 3 small 5 ellipses are contained within one bigger 5 ellipse. When we look at the charts, we realize it is necessary to adjust 5 ellipses dynamically to market price action. 5 ellipses are unique, not one 5 ellipse is exactly like another even though the shape is always the same. All 5 ellipses in our sample calculation have 2 elements in common. 1. Both sides of all 5 ellipses are touched, at least once during a price move, so that there is always a 3-wave pattern. and 2. All phi ellipses are at least 21 days long and are drawn at a ratio smaller than 17.944 from the phi series. In addition, most phi ellipses start at the end of the preceding phi ellipse. Only in an exceptional case, see April 1999, in Figure 5.35 does a phi ellipse start when the previous phi ellipse is only half finished. Keeping in mind constant scales and the long-term picture of market price patterns, we now move to the second sample, the S&P 500 index. Phi ellipses on constant scales in the S&P 500 index. If we can demonstrate that phi ellipses work with many products over a longer period, we can be confident in our investments. It is only on constant scales that we see the similarities of different phi ellipses. Each phi ellipse varies in shape, length, or width, but the underlying principles based on the Fibonacci summation series and the ratios from the phi series never change. There is no standard phi ellipse that is the average fit for every price move. However, the magic of phi ellipses lies in their ability to dynamically adjust to ever-changing price patterns in the markets. We have analyzed more than 2 years of S&P 500 index daily bar data from December 1998 to December 2000 and have backtested the phi ellipses. The total stream of data over the 25 months is separated into 3 charts as shown in Figure 5.36. By choosing a set of appropriate phi ellipses and waiting for market pricing to move out of the phi ellipses at their final points, our sample investments follow the price pattern in the S&P 500 index with few exceptions. Figure 5.36 S&P 500 chart from 12 to 98 to 1200. Attached and overlapping phi ellipses on a constant scale. Taking into account the 15 attached and overlapping phi ellipses analyzed in the previous section on daily bar data in the S&P 500 index and the total 23 phi ellipses shown in Figure 5.36, the dynamic nature of phi ellipses becomes evident. Phi ellipses on constant scales in the DAX 30 index. The total stream of market data over 27 months from September 1998 to December 2000 in the DAX 30 index is shown on constant scales on the 2 charts in Figure 5.37. Figure 5.37 DAX 30 chart from 0998 to 1200. Attached and overlapping phi ellipses on a constant scale. Once again, we must find a set of appropriate phi ellipses and wait for market pricing to move out of the phi ellipses at their final points. Phi ellipses overlap or are attached to each other and follow the market price pattern in the DAX 30 index. The change in shape of the phi ellipses depends greatly on whether the basic underlying market pattern is a 3-wave move or a 5-wave move. Properly distinguishing between 3-wave swings and 5-wave swings was the key problem that Elliott and his followers were never able to solve. Phi ellipses as Fibonacci trading tools solve this problem. It does not matter whether we deal with a 3-wave pattern or a 5-wave pattern, for the final point of a phi ellipse tells us where we are in the market. Working with phi ellipses on intraday data. To get a more stable equity curve, many traders rely on intraday data. The goal is to participate on small price swings with a high number of profitable trades at very low risk. However, inexperienced traders often quickly learn that faster trading not only means higher slippage and commission, but also requires greater discipline in executing trading signals. Traders who do not have systematic rules for trading intraday should be very careful. The best strategy is to start with paper trading and work with different products and time intervals. There are many possibilities for intraday trading. In this discussion, we focus on 15-minute data, for this is the data compression we offer on our online trading platform. Phi ellipses can be traded very successfully on 15-minute data. We use DAX 30 futures index data in this section because this is the product we trade for ourselves. But DJ Euro Stoxx 50 Futures Index, S&P 500 Futures Index, Nasdaq 100 Futures Index, and Dow Jones Futures Index are also excellent trading instruments on intraday data in combination with phi ellipses. Trading rules. The phi ellipse can be used on any kind of intraday data, 60-minute, 30-minute, 15-minute, 10-minute, or 5-minute data, since investor behavior expressed through the phi ellipse does not change. As mentioned, other charting programs have ellipses as well. We have worked with phi ellipses for more than 20 years in real-time trading and had to transform the underlying formula for the regular ellipse into the phi ellipse formula to make this trading tool work. The main difference between the phi ellipse and other ellipses is that the phi ellipse keeps its shape much longer. In addition, phi ellipses always integrate a Fibonacci ratio, other ellipses do not do this. Entry rules. When we generate trading signals with the phi ellipse, our entry signal is the outside line of the phi ellipse, which is the parallel to the median line of the phi ellipse. Alternatively, conservative traders should wait until a price bar breaks the outside line of the phi ellipse. The high or low of the price bar at which the breakout occurred is then the entry point. See Figure 5.38. Figure 5.38 Entry rule on a short position. This additional requirement means that we will always be a little bit later in the market than if we had bought or sold immediately on the breakout, but on the other hand, we eliminate a lot of false signals. Stop loss rules. Every product has its own volatility and, therefore, requires a different stop loss rule. In general, if we work with a horizontal phi ellipse, the stop loss can always be the median line of the phi ellipse. As an option, we can work with a stop loss expressed in basis points. For example, in the DAX 30 index, we recommend a stop loss of 30 basis points. The third option would be to start with the stop loss at the median line and wait to see whether the market price reaches a new peak on short positions or valley on long positions. We then reduce or raise the stop loss to this new level, as illustrated in Figure 5.39. Figure 5.39 Stop loss rule on a short position. Profit target rules. The best way to define a profit target is to wait after the market entry until near the end of the trading session, and then close the position 5 minutes before the end of the session. As an alternative, we can close the position when the market price reaches a profit target that, point-wise, is as big as the height of the phi ellipse that generated the trading signal. See Figure 5.40. Figure 5.40 Profit target rule on a short position based on the initial width of the phi ellipse. The advantage of this strategy is that the profit target will always be dynamically adjusted to the volatility of the market swings by the time the signals are generated. Phi ellipses and symmetry in price patterns. Market price patterns develop based on investor behavior. It is a general belief that investor behavior is an irrational parameter that cannot be analyzed. We have a different opinion. Certain price patterns in each price move are very repetitive and can be used for the analysis if the trader is patient enough to wait for them. The phi ellipse can identify those symmetrical price patterns to use as trading information. In Figure 5.41, we present a pair of examples of symmetrical price patterns on the DAX 30 index. In both examples, the low point of the price pattern within the phi ellipse is located almost in the middle between the peaks on the right and left side. The phi ellipse runs almost horizontal. Figure 5.41 Symmetry in price patterns. It is essential for the two peaks to touch the outside line of the phi ellipse, for otherwise the phi ellipse would not have a stable form. Creating the charts is possible only because phi ellipses can be dynamically adjusted to different market price patterns. The quality of the phi ellipse is based on its capability for change according to the Fibonacci ratios. Phi ellipses as Fibonacci trading tools are part of the WINPHI software on CD-ROM and can also be found as online trading tools at. In a second pair of charts, there is also some recognizable symmetry of investor behavior. In contrast to the first examples, the peaks on the right side do not reach the upper borders of the phi ellipses. See Figure 5.42, again on the DAX 30 index. The phi ellipses in these examples do not need the second peaks on the right, because they get their stability through the peaks and valleys that touch the respective median lines. Figure 5.42 Symmetry in price patterns with peak on the right not reaching the upper border of the phi ellipse. 3 peaks, valleys, at the upper, lower borders of phi ellipses. Most trading signals generated with phi ellipses on intraday data occur when three peaks or valleys are formed at the upper or lower border of the phi ellipse. When three peaks have been established at the upper border of a phi ellipse and the parallel to the median line is broken to the downside, we immediately get a sell signal. The opposite strategy holds true for buy signals based on three valleys at the lower border of a phi ellipse. Figure 5.43 shows four examples of short trades with three peaks established at the upper borders of the underlying phi ellipses. Figure 5.43 short entries on three peaks at the upper borders of phi ellipses. Once a trading signal is executed, we place a stop loss and a profit target according to the rules previously described. Trades are closed out by the end of the day. Breakouts of phi ellipses in the direction of the main trend in strong market trends intraday, we may get a buy signal on a breakout of the top or bottom at the end of a phi ellipse. Requirements for a valid exceptional trading signal in the direction of the main trend are: the slope of the phi ellipse is very steep. The market price move has touched the phi ellipse twice on each side, meaning that the phi ellipse has a very stable form and the breakout occurs at the very end of the phi ellipse. The entry point for a buy signal is the high of the price bar that broke out of the phi ellipse, vice versa for a sell signal. Figure 5.44 shows examples of a short trade and a long trade in the direction of the main trend at the end of a phi ellipse. Figure 5.44 market entries in the direction of the main trend at the final points of phi ellipses. As before, once a trading signal is executed, a stop loss and a profit target are placed according to the rules previously described. Trades are closed out by the end of the day. Phi ellipses and false breakouts intraday. False breakouts are important chart patterns, and phi ellipses are reliable trading tools to analyze false breakouts on an intraday basis as well on daily data. Requirements for a short signal are: the slope of the phi ellipse has to be modest. The false breakout has to be higher than two previous peaks. The market price has to drop below the support line, outside line of the phi ellipse that runs parallel to the median line. These entry rules run vice versa for buy signals. Figure 5.45 shows a pair of sample sell signals from the DAX 30 index. Figure 5.45 market entries short on false breakouts intraday. Once again, it is important to place a stop loss and a profit target immediately after market entry. Reliability of phi ellipses reconsidered. To summarize our findings on phi ellipses as Fibonacci trading tools, we reconsider the reliability of phi ellipses in the various fields in which they can be applied to chart analysis. Phi ellipses as investment devices are special because they make chart patterns visible. When working with phi ellipses, investors always know what to look for in the markets, no matter how confusing daily, weekly, or monthly charts may appear. With modern computer technology at investors' fingertips, phi ellipses become very valuable. The basic structure of a phi ellipse is simple. Phi ellipses circumvent a minimum three-wave swing. To calculate phi ellipses, 3 points are needed: a starting point and 2 side points. The final point of a phi ellipse projects a future market move as the phi ellipse develops. The final point of a phi ellipse is the decisive point to watch. In the application of phi ellipses, investors are able to master trend patterns and sideward patterns. Phi ellipses consist of three trading dimensions: price, time, and angle, that are seldom found in a single trading tool. When a solid analysis of all three dimensions precalculates the same turning point in a market, we may invest with confidence. To make our entry signals safer, we must filter out entry points with a high success rate. This does not mean that every trade will turn out as a winning trade. Getting stopped out on stop losses and re-entering a market while sticking to strict entry rules, stop loss rules, and re-entry rules are all part of using Fibonacci tools in volatile markets. The best entry point on phi ellipses with the highest rate of profitable trades only happens at the very end of a phi ellipse. The investor should then enter the market counter to the main trend direction. By generating trading signals based on the end of a phi ellipse, we sell high or buy low. A countertrend approach requires considerable discipline, since there is not much support in the markets when a trading signal appears. We will never know whether we meet the highest high or the lowest low at the time we establish a position in a market, but our chances for profitable decisions will be good, at least as far as the historical test runs shown in the preceding sections are concerned. In the end, the slope of a phi ellipse determines whether we receive a trading signal. We will get sell signals as long as the slope of a phi ellipse points upward. We will get buy signals countertrend as long as the slope of a phi ellipse points downward. In some cases, we will get trading signals in straight sideward markets when a phi ellipse runs mainly horizontally. It boosts our confidence if other Fibonacci trading tools confirm trend reversals derived from phi ellipses. These confirmations come either from price analysis based on corrections and extension or time analysis based on the numbers of the Fibonacci summation series. Valuable confirmations can also come from the application of trend channels. Phi ellipses perform well on every product traded as long as there is enough volatility, volume, open interest, and liquidity. For a serious analysis based on phi ellipses, we must have an appropriate sample of products in which the international community of investors shows a lot of interest. If investors are interested in a product, it is likely that the product's market patterns will directly reflect investor behavior. We are always as precise and complete as possible in describing and analyzing trading tools and in applying them to sets of sample market data. We introduce entry rules and exit rules, stop loss rules, trailing stop rules, and rules for profit targets. However, no matter how much detail we provide, we cannot cover the whole spectrum of opportunities and variations that the analysis of phi ellipses implies. To explain how phi ellipses can be applied to real-time trading, we have presented trading signals on daily data of the S&P 500 Futures Index between February 2001 to November 2002. Even though the results look promising, there may be future periods where the signals do not turn out so well. To prove that phi ellipses can be applied to intraday data as well, we have presented some examples on 15-minute price data on the DAX 30 Futures Index. Phi ellipses have the very best trading potential on intraday data. Although it takes great discipline and accuracy to execute signals, every successful trader has these abilities and can learn how to use this new trading tool. Phi ellipses work, we use them for our own trading. We do not believe that the entire spectrum of system design and the development of trading strategies founded on phi ellipses can ever be fully automated and computerized. The dynamics of phi ellipses and the three dimensions of price, time, and angle would surely be too problematic for programmers. But there is no need for fully computerized trading signals. Phi ellipses in combination with other Fibonacci trading devices, candlestick patterns, and three-point chart patterns open the door for skillful, interested, patient, and determined investors who need basic and reliable trading tools that are guaranteed to work, if handled properly. Generations of investors have tried to apply Elliott's wave principles to successful real-time trading. To the best of our knowledge, no trader has ever succeeded over a long period of time because Elliott's wave count is not stable. We admire Elliott for his work. His innovative ideas enlightened us and provided the foundation for our own research. With computer technology and our accumulated experience over the past 20 years, we strongly believe that we have raised pattern recognition to a higher level. 6. Merging candlesticks, 3-point chart patterns, and Fibonacci tools. Can we improve the trading strategies based on candlestick chart patterns, 3-point bar chart patterns, and geometrical Fibonacci trading devices if we combine them? Can Fibonacci trading become even safer and more profitable? These are the key questions we consider in this chapter. Timing is the most crucial element in trading. It is important to know what to buy, but it is even more important to know when to buy. The candlesticks, 3-point bar chart patterns, and Fibonacci trading tools described in the previous chapters can serve investors as profitable standalone trading solutions. All trading signals result from special interpretations of market price patterns. All geometrical Fibonacci trading devices as well as candlestick patterns and 3-point chart patterns are based on the core understanding of investor behavior expressed in peak and valley formations. Working with our Fibonacci trading tools takes nothing more than swing highs or lows in the Fibonacci ratio or the ratios from the Phi series. The greatest difficulty for traders is choosing correct swing highs or lows. On weekly price data, we cannot always apply Fibonacci trading tools because there are insufficient valid swings from 167, which to calculate turning points. On daily data, in contrast, we receive enough swing highs and swing lows, but we may get too many signals. The number of trading signals can be even greater for intraday data. Using the Fibonacci tools in combination with candlesticks and 3-point chart patterns will not assure that we never suffer losing trades, but we can expect the majority of trades to be profitable as long as we apply the tools correctly. Using our trading devices requires patience and discipline as well as computer skills because our WINPHI software package is essential for applying the tools. The user manual in the appendix instructs readers in operating the computer program. Fibonacci price correction levels. Whenever discussions among traders focus on correction levels, the Fibonacci ratios 38.2%, 50.0%, and 61.8% come up. As explained in chapters 3 and 4, we favor the correction level 61.8% for the risk-reward ratio as being the best compared with the alternative ratios. With this approach, however, we might miss all those trades where the market does not correct as low as 61.8%. Traders can solve this problem by combining the Fibonacci ratios with other trading tools such as candlesticks or regular 3-point chart patterns. We first present trading signals generated simply with the Fibonacci ratio 61.8% as our initial price correction level. Then we show how the trading signals change on the same data series when we merge candlesticks and 3-point chart patterns into the strategy. Standalone Fibonacci correction level 61.8%. In our first example, we apply Fibonacci corrections to S&P 500 index data ranging from December 2001 to April 2002. We use the following parameters. Swing size of 30 basis points, no entry rule, that is, immediate countertrend entry as soon as the correction level is reached. Stop loss point at swing high, sell signals or low buy signals. Daily data, slippage and commission excluded. Figure 6.1 and Table 6.1 show the resulting sample trading signals. Figure 6.1 S&P 500 chart from 1201 to 0402. Simulation of trading signals based on plain price corrections daily L, entry long, S, entry short, XL, exit long, XS, exit short, stop loss. Table 6.1 Trading Signals. Profit. Loss in. Hash entry rule at exit rule at points. 1 sell short 1149.00 stop loss 1174.00 25.002 buy long 1138.00 stop loss 1115.00 23.003 sell short 1117.00 buy reverse 1099. 18.004 by reverse 1099.00 stop loss 1081.00 18.005 sell short 1106.00 by reverse 1097 9.006 by reverse 1097.00 stop loss 1076.00 21.00 7 sell short 1105.00 stop loss 1125.00 20.00 8 sell short 1121.00 stop loss 1133.00 12.00 9 buy long 1113.00 stop loss 1100.00 13.00. The results of the simulation look discouraging. The main reason for the high number of losing trades is the immediate market entry any time that a 61.8% retracement level is reached. Our analysis shows that the probability for a trend change at the retracement level is not high enough for trading this strategy. Nevertheless, it is important to note that earlier investments at retracement levels of 50.0% or 38.2% would have worsened the picture because the stop-loss points would have been farther away from the entry levels. To tackle the problem, we combine a Fibonacci correction level 61.8% and candlestick chart patterns. Fibonacci retracement 61.8% and candlestick patterns 7 sample trading signals can be found in the S&P 500 index, again between December 2001 and April 2002, see Figure 6.2. Figure 6.2 S&P 500 chart from 1201 to 0402. Simulation of trading signals based on plain price corrections daily in combination with candlesticks L, entry long, S, entry short, XL, exit long, XS, exit short, stop loss, as, trailing stop. The trading signals in Figure 6.2, as combinations of Fibonacci price corrections and candlestick chart patterns, are based on a simple set of parameters. Swing size of 30 basis points. Entry rule based on candlestick chart patterns after the Fibonacci correction level 61.8% is reached. Stop loss point at previous swing high or low. 3-day high or low trailing stop. Daily data, slippage and commission excluded. The profits and losses for corrections and candlesticks in combination look a bit more promising compared with the results of Fibonacci price corrections as a standalone strategy. All 7 trades are shown in Table 6.2. Table 6.2 trading signals HA, Harami pattern, N, engulfing pattern, DC, dark cloud cover, BH1, bullish belt hold, BH2, bearish belt hold, PP, piercing pattern, S, evening star, profit. Loss in. Hash entry rule at exit rule at points. 1 sell short HA 1138.00 stop loss 1152.00 14.002 buy long and 1137.00 stop loss 1115.00 22.003 sell short DC 1118.00 buy reverse 1098 19.004 buy reverse BH11 98.00 sell reverse 1098 0.005 sell reverse BH21 98.00 buy reverse 1101.00 3.006 buy reverse PP 1101.00 trailing stop 1157 56.007 sell short S 1109.00 open. The main reason for the improved outcome of the simulation is the change in the entry rule from entering the market immediately on reaching the Fibonacci correction target to waiting for a candlestick pattern that confirms the trend direction. The number of stop losses is reduced and the total number of trades is down from 9 to 7. Another way of merging pattern recognition into price corrections as Fibonacci trading tools is to combine the 61.8% retracement level with 3-point chart patterns. Fibonacci retracement 61.8% and 3-point chart patterns. The biggest problem in trading corrections is to stay close enough to the fast-moving trend changes while waiting long enough for confirmation of the trend change. Candlesticks have shown a positive effect on the total performance of the trading strategy. How far the integration of 3-point chart patterns leads to a similar effect can be estimated for the S&P 500 index according to the trading signals in Figure 6.3. Figure 6.3 S&P 500 chart from 1201 to 0402. Simulation of trading signals based on plain price corrections daily in combination with 3-point chart patterns L, entry long, S, entry short, XL, exit long, XS, exit short, stop loss, as, trailing stop. The underlying relevant trading parameters for generating entry and exit signals are: swing size of 30 basis points, Fibonacci correction level 61.8%. Market entry on 1-day high, low backward look after the correction level is reached. Stop loss point at previous swing high or low, re-entry after being stopped out. 3-day high, low trailing stop. Daily data, slippage and commission excluded. 9 trading signals can be found for the S&P 500 index between December 2001 and April 2002 as shown in Figure 6.3. They are summarized in Table 6.3. Table 6.3 Trading Signals. Profit. Loss in. Hash entry rule at exit rule at points. 1 sell short 1140.00 stop loss 1152.00 12.002 resell short 1163.00 buy reverse 1146 17.003 buy reverse 1146.00 stop loss 1124.00 22.00 4 sell short 1118.00 by reverse 1094, 24.005 by reverse 1094.00 sell reverse 1112, 18.006 sell reverse 1112.00 by reverse 1101, 11.007 by reverse 1101.00 trailing stop 1156, 55.008 resell short 1161.00 trailing stop 1153, 8.009 sell short 1123.00 open. Working with an entry rule and re-entry rule improves the trading results to an acceptable level. The entry rule ensures that we receive a short-term confirmation of a trend change. The re-entry rule comes into effect after swing highs or swing lows are broken and the market price moves back into the trading range. Looking back to the immediate entries on price corrections in the first example of the section, Figure 6.1 and Table 6.1, we can now re-examine the trading signals according to underlying price patterns that would have prevented us from entering the market too early. Signal 2 failed when the market price formed a double top. Signal 4 failed when the market price formed a double bottom. Signal 7 failed when the market price formed a triple bottom. Signal 8 failed based on a quadruple top. The low of signal 9 followed a triple top. The integration of 3-point chart patterns and a backward look entry rule have a positive effect on the trading results in combination with Fibonacci price corrections of 61.8%. The 3-point chart patterns are a stable element of trading the markets and should be watched carefully, whereas swing size and re-entry rule may vary from product to product. Hardly any other investment tool can monitor the investor behavior as accurately as regular 3-point chart patterns. Now that we have discussed the S&P 500 Futures Index on 3 different approaches to analyze the Fibonacci retracement level 61.8%, we want to add 2 stocks, Microsoft, member of the Dow Jones 30 Index, and Alliance, member of the DAX 30 Index. In contrast to Microsoft, which moves in a trending pattern, Alliance is stuck in a sideward market. Not surprisingly, the number of trades is much smaller in a trending market. Microsoft shows 6 trades in 12 months, whereas Alliance comes up with 12 trades in just 6 months. The latter finding is typical of the kind of strategy we present. Because we never know future market patterns in advance, we have to take every trade. As discussed in chapters 3 and 4, the most crucial parameter, in addition to the 61.8% retracement level, is the swing size. The swing size of a trading product can only be determined from test runs on historical data. However, conducting test runs is not difficult and can be done by every trader. Knowing the price level a product is trading at is less important than knowing its most common swing size. Every trading vehicle that we analyze has a different volatility. In contrast to the S&P 500 index, which shows a trading range between less than 800 points and somewhat above 1,200 points over the past year, Microsoft trades at price levels between $40 and 70, and Alliance trades at price levels between €230 and 290. Traders have to keep in mind that the smaller the swing size is, the more trades we get. If the swing size selected is too large, we might not get a trade at all. The easiest way to find a good swing size is to look at historical data on the longest lasting sideward pattern to find the best average swing size value. Figure 6.4 contains the chart example of Microsoft over 1 year. Figure 6.4 Microsoft chart from 1101 to 1102. Simulation of trading signals based on plain price corrections daily in combination with 3-point chart patterns L, entry long, S, entry short, XL, exit long, XS, exit short, stop loss, AS, trailing stop. Figure 6.5 shows the same trading approach applied to the Alliance stock late in 2001 and early in 2002. Figure 6.5 Alliance chart from 1001 to 0402. Simulation of trading signals based on plain price corrections daily in combination with 3-point chart patterns L, entry long, S, entry short, XL, exit long, XS, exit short, stop loss, AS, trailing stop. Having explained in detail the Fibonacci ratio 61.8% in combination with candlesticks and 3-point chart patterns, it is pertinent to mention the alternative to Fibonacci related key ratios. 38.2% and 50.0%. Additional Fibonacci correction levels. Do 38.2% and 50.0% Fibonacci correction levels require different rules from the ones described thus far in this chapter? This question is important because nothing is more frustrating for a trader than to wait for the Fibonacci retracement level 61.8%, and then shortly before it is reached, to have the market turn with no trade done. The dilemma of making the right decision at the right time based on Fibonacci price corrections becomes obvious when we look at the DAX 30 index in Figure 6.6. Figure 6.6 DAX 30 chart from 0802 to 1002. Fibonacci correction levels. A strong rally is followed by a price correction to the first Fibonacci retracement level of 38.2%. At this point, when almost all information services, market letters, and media representatives call for new lows, the trader must decide whether to wait for the 61.8% retracement level or to risk executing a long trade in the DAX 30. What we need and are trying to find here is additional support that makes the decision a little easier. A tool that could help us consider the final strength of the price correction would be ideal. One tool that has proven reliable already when used in combination with the 61.8% Fibonacci correction level is candlestick charting. If we change the charting technique and add candlesticks to the chart of the DAX 30 index, we see a clear picture that makes our decision convincing and valid. See Figure 6.7. Figure 6.7 DAX 30 chart from 0802 to 1002. Fibonacci correction levels and candlesticks. From the chart, we can draw the following rules for a solid short-term long trade in the DAX 30 index. The Fibonacci level 38.2% is reached. After the correction level is reached, we identify a doji candlestick pattern, which is a strong indication that the market price will at least not drop further from this price level. The following day, we identify an engulfing candlestick pattern that confirms the market price is ready for a correction. To receive still more confirmation of the potential trend reversal to the upside, we can wait 2 more days. The market price forms a double bottom. At the latest on the 5th day after the price movement touching the 38.2% retracement line, a Harami pattern assures us of a possible market entry long at control risk. We set the stop loss at the low of the day that breaks the 38.2% correction line. A similar simulation can be conducted for the 50.0% retracement level, which is also well recognized by traders. For traders who plan to keep stocks longer in a portfolio, this is a decent correction level, especially because it is reached much more often than the conservative 61.8% Fibonacci retracement level. Figure 6.8 shows a chart of the S&P 500 index between May and September 2002. Figure 6.8 S&P 500 chart from 0502 to 0902. Correction levels. Once again, we are caught in a situation where waiting for the 61.8% correction level might lead to a dead end with no trade at all. Using plain correction levels without additional indicators has little value, especially for traders with a short-term orientation. As before, this is where candlestick pattern recognition becomes part of the game. Integrating the candlestick charting technique into the general picture of Fibonacci price corrections changes the S&P 500 index chart as shown in Figure 6.9. Figure 6.9 S&P 500 chart from 0502 to 0902. Correction levels in combination with candlesticks. The candlestick pattern analysis runs as follows for a long signal in the S&P 500 index once the price move breaks the 50-point retracement line. The Harami candlestick pattern is a first indication that the market correction might not continue. The Harami pattern is followed by a hammer candlestick pattern. The hammer is a very strong confirmation that a trend change to the upside is about to occur. Finally, and in addition to the candlestick patterns, the resistance line is significantly broken to the upside. We get a buy signal at the high of the day with the hammer candlestick pattern and on the breakout of the resistance line. The most recent value before the long entry determines the stop loss. Instead of combining Fibonacci price corrections with candlestick patterns or 3-point chart patterns, traders can also merge them with Fibonacci extensions, support and resistance lines, and phi ellipses in an integrated Fibonacci-related approach. Fibonacci corrections and multiple Fibonacci tools trading signals based on Fibonacci corrections become more valid as more tools confirm a turning point in the market. All Fibonacci trading tools are devices for reflecting investor behavior. That is why it is easy to combine them. We are looking for clusters of confirmations of trend reversals. To get the full picture, we add Fibonacci extension levels as well as support and resistance lines to our starting trading device, the Fibonacci price corrections. The three main Fibonacci retracements 38.2%, 50.0%, and 61.8% are nothing more than the converted Fibonacci ratios 0.618, 1.000, and 1.618. When looking for trend changes, we can combine the calculations if the necessary swing sizes exist. See Figure 6.10. Figure 6.10 price band based on Fibonacci correction and Fibonacci extension combined. Many combinations of Fibonacci price corrections and extensions are possible. The rationale behind the calculation of the target prices that determine the price band is the following. The correction level calculated using the Fibonacci ratio 61.8% is reached just below point C if we take the distance between point B and point 1 and multiply it by the Fibonacci ratio 1.618, we reach a price target that is a little bit above point C. The pre-calculated price targets often do not overlap completely. As long as the price band formed by the target prices is very narrow, we find an ideal Fibonacci target level, for the price target is calculated twice by the Fibonacci figures 1.618 and 61.8%. Figure 6.11 is a bar chart example of the S&P 500 index between November 2001 and November 2002 that combines Fibonacci price corrections and extensions. Figure 6.11 S&P 500 chart from 1101 to 1102. Calculation of price band. Traders often ask whether they can predict price movements with the Fibonacci ratio. The answer is that we cannot say in advance whether a pre-calculated price target will ever be reached. But what we can say is that as soon as a price target pre-calculated by the combined Fibonacci figures is reached, the chances for a trend change are high. Although the best price targets are those at which the Fibonacci levels 1.618 and 61.8% overlap, these perfect targets are rare. Fibonacci extensions are calculated using the ratios from the phi series, 0.382, 0.618, 1.000, 1.618, 2.618, and so on. If we calculate large enough swing sizes, smaller ratios for calculating Fibonacci extensions become more important in combination with Fibonacci price corrections. If we take the latter argument into account, the analysis shown in Figure 6.11 on the S&P 500 index becomes easier to understand. In our example, we have applied the ratio 0.382 instead of 1.618. The price band on the chart, therefore, is based on the following calculations. The Fibonacci correction level of 50% between point A and point B leads to a target price of 975.00 points in the S&P 500 index. The Fibonacci extension level of 0.382 leads to a target price of 963.00 points in the S&P 500 index. Because we focus on large swings that last over months, we cannot expect to find price targets calculated at ratios of 1.618 extension or 61.8% correction to be easily reached. In our example, we have calculated the first wave of a long-term S&P 500 index market movement. If it holds true that we have finished the first and second wave of a three-wave price pattern, the S&P 500 index is currently in the third wave. The next price target is the high of wave 1 at 966.00. If the market price moves continuously higher, the correction levels of 50.0% and 61.8% become critical price targets that traders should watch carefully. In the event of further rising prices, new price extension levels based on swings that have not yet been realized may be used for additional calculations. Whenever Fibonacci price correction levels of 50.0% or 61.8% are reached on large swings, we might not enter the market right away based on daily price data and use a sophisticated entry rule instead. For short-term traders, however, especially those with an intraday perspective, these price goals are extremely important. See Figure 6.12. Figure 6.12 S&P 500 chart from 0502 to 1102. Short-term turning points. Thus far in this chapter, we have encouraged readers to wait for additional confirmations of trend reversals once Fibonacci correction levels have been triggered by candlestick patterns, three-point chart patterns, or other Fibonacci devices. Short-term traders, however, who only want to scalp a few basis points at very low risk, need to pay attention to the following price targets. At point A, the total distance from points A to D is corrected by 50.0%, followed by a strong price move in the S&P 500 index. At point F, the total distance from points D to A is corrected by 61.8%. The market price in the S&P 500 index reverses instantly to the downside at point F. If we switch the perspective after this intermezzo from short-term back to long-term, we finally set the focus to profitable combinations of Fibonacci price corrections, Fibonacci extensions, and phi ellipses. Figure 6.13 shows a perfect buy signal for a long-term investment immediately after the lowest low in the S&P 500 index as made late in September 2002. Figure 6.13 S&P 500 chart from 0502 to 1102. Long-term turning points. New lows or highs, especially in large swings and double bottom or double top formations, are always possible indications of major trend reversals. Investors should be highly alert for a trend change if other tools and parameters confirm the turning point. The price extension in Figure 6.13, calculated as the total distance from the high at 965.00 to the low at 868.00 multiplied by the Fibonacci ratio 1.000, leads to a target price of 772.00. The lowest low in the S&P 500 index is at 775.00. One can hardly get closer. The lowest low in the range from 750.00 to 800.00 in the S&P 500 index could have been calculated many months earlier, based on other price swings. We come back to this in the next section. Once the double bottom is made, our entry rule applies. The breakout of the outside line of the phi ellipse confirms the trend reversal. The buy signal is filled market on open on the day of the breakout. Summary. Trading the Fibonacci correction levels 38.2%, 50.0%, and 61.8% successfully depends on several factors. The biggest question is the swing size a trader is working with. If the swing size is large, the correction level 38.2% might be appropriate. However, if the swing size is too large, we might get a trade only once or twice a year. If the swing size is too small, we might get too many trading signals. The easiest way to find a good swing size on the products we want to trade is to look at sideward markets on historical data. The profitability of the approach also depends on whether we work with daily or intraday data. For daily data, we recommend trading the 61.8% correction level if a trader has the patience to wait for this level to be reached. However, as our examples on S&P 500 index data indicate, there might be times when looking for the correction levels is not good enough. What is needed is also an entry rule to confirm the trend change. In addition, it is always important to work with a stop loss. The integration of candlestick charting significantly improves the results. On the other hand, candlesticks suffer the disadvantage that we do not always find a valid candlestick pattern when our favorite retracement level is triggered, meaning that we miss trades. The best trading strategy while working with 61.8% correction levels is a combination of entry rule and 3-point chart patterns, as demonstrated in our examples. The 3-point chart patterns are always there and are always reliable. The chart examples on Microsoft and Alliance are proof that this approach can be easily applied to stocks or any other product with a trending market pattern and enough volatility at a good swing size. The biggest problem for a trader is to wait for the 61.8% correction level. The market price comes close but does not reach it, and then moves in the opposite direction. The trader has anticipated the price correction properly, but misses a big profit opportunity, because of working with a 61.8% correction level. To solve this problem, we have combined different correction levels with candlestick patterns and 3-point chart patterns in our examples. Combining Fibonacci price extensions and corrections can be of great help for a trader who is looking for solid entry levels. Long-term and short-term calculations based on price corrections, finally, can be combined with price extensions, 3-point chart patterns, and phi ellipses. Combinations of the three seldom show up. As discussed, it takes a lot of discipline to wait for such combinations, and it is an even bigger problem to execute the trading signals when they show up. Inexperienced investors often are afraid to take countertrend signals. To make investment decisions easier and more reliable, we look for multiple confirmations of trend reversals. Fibonacci price extensions. In general, extensions mean investments against the main trend, which is defined by the first impulse swing in a 3-wave move or a 5-wave pattern. Extensions are important as Fibonacci trading tools because they show up not only in fast moves over a couple of days or weeks in soft commodities, but also in financial instruments, derivatives, or currencies as indicators of major trend changes. Extensions occur at extreme points when media coverage sets investors on fire. Traders must be patient and disciplined because extensions are patterns that can rarely be detected in the markets. As stated, markets are in a trending state less than 1/3 of the time. Therefore, we receive many more signals on the basis of corrections than extensions. Generally speaking, extensions are defined on the basis of a 3-wave pattern. A target price is calculated from the initial swing size of the first impulse wave, multiplied by the Fibonacci ratio 1.618, or the alternative ratios 0.382. 0.618, 1.000, and the resulting product, once again, added to the swing size. In this section, however, we are not so much interested in extensions as trading tools to generate countertrend trading signals once the price target is reached. What we want to deal with are the price targets at the end of Fibonacci extensions because they are highly significant indicators of points in the market action where trend changes are likely. Whereas working with Fibonacci corrections means having a high and a low point and looking for possible correction levels in price, working with extensions means the opposite. We have a price swing from point A to point B as described in the previous section and want to know how far the market price might go before it runs into recess. TANS levels. Calculating price targets. Inexperienced Fibonacci traders may find these calculations confusing. The purpose of the chart provided in Figure 6.14 is to prevent readers from getting lost in the jungle of corrections and extensions. The chart shows the S&P 500 index between May and November 2002. The swing from point A to point B is the basis for our calculation. We calculate the three price targets for extensions by using the ratios. Figure 6.14 S&P 500 chart from 0502 to 1102. Price targets 0.618, 1.000 and 1.618. Figure 6.14 also shows the three corresponding price targets for market corrections at levels of 38.2%, 50.0% and 61.8%. If the market does not go higher than the high in point C and makes a new peak there, we have to recalculate our price targets up and down based on the new initial swing from point A to point C. Our main aim is to find price clusters, or multiple confirmations of price targets, at which major trend reversals can be expected. The following three-step approach in the S&P 500 index between July 2001 and November 2002 starts with the extension levels, continues with the correction levels and, finally, brings them both together to come up with price bands formed by price extensions and price corrections. Figure 6.15 contains three important price extension levels in the S&P 500 index, calculated at Fibonacci ratios 0.382, 1.618, and 1.000 based on the initial swing from points B to C. Figure 6.15 S&P 500 chart from 0701 to 1102. Extension levels. The swing from the valley at point B to the peak at point C is a corrective move to the strong downtrend starting in March 2002. We can draw three Fibonacci corrections at levels of 38.2%, 50.0% and 61.8% on the chart of the S&P 500 index, again between July 2001 and November 2002. The initial price swing this time runs from the peak in A to the valley in B. See Figure 6.16. Figure 6.16 S&P 500 chart from 0502 to 1102. Correction levels. The reason we conduct the analysis is to get to areas of support and resistance that are projections from today into the future. Our final step is to bring Fibonacci extensions and Fibonacci price corrections together in one chart, thereby defining price bands that are areas of potential major trend reversals. The chart combining the different price targets of the S&P 500 index was completed late in November 2002, shortly before we finished the first draft of this book. We did not, of course, know what the market price would do. However, we knew that the extension levels presented here would be important. We could not know whether and when the price targets would be reached, but if the market price in the S&P 500 index were to go to any of these price bands, it would find resistance. How much resistance? We did not know that, either, but readers who have worked their way through this book up to this point know the tools and how to handle them properly for a solid market analysis. Figure 6.17 shows the three resistance areas in the S&P 500 index derived from the combination of Fibonacci extensions and corrections. Figure 6.17 S&P 500 chart from 0502 to 1102. Resistance areas based on Fibonacci extensions and corrections. The three resistance areas can be analyzed as follows. 1. The first resistance area is between 963.00 and 974.00 points. The calculation is based on the correction level of 50.0% measured from the initial swing from the peak at point A to the valley at point B, and on the Fibonacci price extension calculated at a ratio 0.382 on the swing size from point D to point E. 2. The second resistance area is between 1022.00 and 1038.00 points. This price band is calculated based on the Fibonacci correction level 61.8% points A to B, an extension at a ratio 0.382, valley in B to peak in C, and a second price extension at a ratio 0.618, valley in D to peak in A. 3. A third resistance level shows up at about 1085.00 points. This can hardly be called an area, because two extensions, one calculated at a ratio 0.618 on the swing from B to C, and one calculated at a ratio 1.000 on the swing from D to A, both lead to almost the same target price in the S&P 500 index. It is important to realize that Fibonacci extensions and corrections point at trend reversals in price, not in time. An experience we had with one of our projections for the S&P 500 index illustrates the importance of time as a trading factor. A true story. In the investment magazine, Hedge Funds Review, 13, October 2001, page 18, we published an article under the working title, "How far will the S&P 500 index drop?" Our calculated target price was between 750.00 and 800.00 points. We were on the dollar with our calculation price-wise, but we did not expect the S&P 500 index first to go up and then reach our price target. We described as well how we would get a buy signal based on a phi ellipse should the market price not go lower but climb higher instead. This example reflects real life and shows exactly the dilemma while working with Fibonacci price targets. Calculations might be correct, but timing may be off. Nothing in this universe can calculate trend changes in price and time correctly all the time. But Fibonacci calculations have an astonishing rate of accurate forecasting in price if the time factor is briefly faded out. Long-term trend changes in the Japanese yen cash currency in contrast to the previous projection to define future resistance areas of the S&P 500 index. The following chart example shows trend changes in the Japanese yen cash currency. A historical daily data sample covers February 2001 to November 2002. 5 major trend reversals based on price extensions can be pinpointed for the 20 months, according to Figure 6.18. Figure 6.18 Japanese yen chart from 0201 to 1102. Major trend changes. The significant trend reversals in the Japanese yen cash currency are marked to F. The calculations of price targets to confirm the trend changes run as follows. The price band for the trend change at point A is calculated by multiplying the distance from point 2 to point 3 by the Fibonacci ratio 0.618, and by multiplying the distance from point 4 to point 5 by the ratio 1.618. The price band for the trend change at point B is calculated by multiplying the distance from point 1 to point 2 by the ratio 0.618, and by multiplying the distance from point A to point 6 by the ratio 1.618. The price band for the trend change at point C is calculated by multiplying the distance from point 7 to point 8 by the ratio 1.618, and by making use of the support level formed by the significant peaks at points 2 and 4. The price band for the trend change at point A is calculated by multiplying the distance from point B to point C by the ratio 1.000, and by multiplying the distance from point D to point 9 by the ratio 0.618. The price band for the trend change at point F is calculated by multiplying the distance from point A to point 10 by the ratio 0.618, and by a 50-point retracement measured on the swing from the peak at point 7 to the valley at point E. The tools applied do not identify the trend change. Indeed, there is no price band to capture the trend reversal at point D. Summary. Working with Fibonacci price extensions can be important to calculate long-term or short-term turning points in any traded product. We have presented examples for determining price bands as targets for market movements. To define the upper and the lower border of a price band and thereby separate the important price targets from the less important ones, we use Fibonacci price extensions calculated from different swing sizes. Fibonacci price extensions in combination with Fibonacci price corrections. Price bands, or clusters, are those significant areas on the price scale where price targets calculated from different swing sizes either overlap or are very close together. Price clusters are especially meaningful when conducting projections of future price movements as exemplified on the S&P 500 index. The Japanese yen cash currency example shows how major turning points in the markets can be identified successfully on highly volatile products. Support and resistance lines. Fibonacci corrections and extensions are profitable standalone trading solutions and are even more profitable when combined with each other. In this section, we want to add support and resistance lines. If we believe that chart patterns reflect investor behavior, it is reasonable to attach high importance to peak valley configurations, especially for drawing support and resistance lines. Support and resistance lines combined with Fibonacci extensions. In the previous sections, we discussed approaches to calculating valid turning points in the markets by combining Fibonacci corrections and extensions. In Figure 6.19, we show support and resistance lines in combination with price extensions on an S&P 500 index sample. The extension levels are the same as the ones shown in Figure 6.15. Figure 6.19 S&P 500 chart from 0501 to 1102. Support resistance lines in combination with Fibonacci extensions. Combining support and resistance lines with Fibonacci extensions maps the S&P 500 index well and provides useful information on where the market will find resistance levels in the future. 5 price targets and clusters show up. First, a price target at 938.00 points in the S&P 500 index. Second, a target band between 963.00 and 974.00 points. Third, a price band from 1022.00 to 1052.00 points. Fourth, a price band from 1085.00 to 1088.00 points. And finally, a cluster between 1158.00 and 1166.00 points. Again, we do not know what the S&P 500 index will do in the near future and whether some of the pre-calculated price levels will ever be reached. We are only saying that if one of these levels is reached, market pricing might have difficulty moving through it without any correction. Support and resistance lines identifying trend changes in addition to projecting price targets as shown on the S&P 500 index. It is interesting to analyze how important support and resistance lines are as trading tools and whether they give enough information to identify trend reversals in selected products. To explain what we are looking for, we start with some graphs that explain the concept, which is based on the notion that markets rotate. See Figure 6.20. The typical pattern is that support lines become resistance lines and resistance lines become support lines. Figure 6.20 Basic support resistance patterns. In our analysis, we refer back to the very beginning of the book, where we explained why we are looking for the magic number 3 in our analysis of trend changes. The 4 little graphics with basic support and resistance patterns in Figure 6.20 have the following meanings. We only look for support or resistance lines that are horizontal connections of peaks and valleys. A peak is valid if it has lower highs on either side of the highest high. A valley is valid if we find higher lows on either side of the lowest low. For a long trend change, see top left graph in Figure 6.20, we first need a valley and a peak to determine the trend line. We then need a second peak above the trend line to be broken to confirm the trend change. For a short trend change, see top right graph in Figure 6.20, we first need a peak and a valley to determine the trend line. We then need a second valley below the trend line to be broken to confirm the trend change. For a trend reversal to the downside, see bottom left graph in Figure 6.20, 3 valleys touching the support line need to be broken. For a trend change to the upside, see bottom right graph in Figure 6.20, 3 peaks touching the resistance line need to be broken. Figures 6.21 to 6.23 provide chart examples of the S&P 500 index, the Nasdaq 100 index, and the DAX 30 index. All 3 charts contain support and resistance lines drawn according to the principles previously described. These support and resistance lines define profitable market entries at major turning points. Combining support and resistance lines with Fibonacci extensions to identify price clusters is safer than working only with Fibonacci ratios. Figure 6.21 S&P 500 chart from 1101 to 1102. Trend changes based on support and resistance lines. Figure 6.22 Nasdaq 100 chart from 1101 to 1102. Trend changes based on support and resistance lines. Figure 6.23 DAX 30 chart from 1101 to 1102. Trend changes based on support and resistance lines. If we combine the results generated by using the Fibonacci ratios with the price levels retrieved from the support or resistance lines, the overlapping price targets are astonishing. Whereas the resistance and support lines are based on peaks and valleys way back in the past, the price targets calculated with the Fibonacci ratios are projections into the future. The test runs shown on the three chart examples are performed on a very short period of time and can only suggest how well the concept may work in future trading. This simple concept, based on support and resistance lines and peaks and valleys, will perform well on any product without optimization as long as there are volatile and trending markets. Support and resistance lines as profit targets. Support and resistance lines are reliable indicators of trend changes, so why not use them to determine secure profit target levels? If the trading signal results from a breakout of the resistance line or the support of a trend channel, doubling the size of the previous price band gives a good price target. This profit target rule was applied throughout Chapter 4 when discussing 3-point chart patterns. See Figure 4.30D for a recap. The width of a trend channel is the distance from resistance line to support line of the channel. If the trading signal is generated countertrend at the support line of a trend channel, the resistance line can be the first profit target. The second profit target is twice the width of the trend channel, vice versa for countertrend trading signals at the resistance line of a trend channel. The rest of this section explains options that traders have for taking profits. We concentrate on support and resistance lines and/or trend channel lines because these lines have proven reliable. Furthermore, we stick with the concept of using the magic 3 peaks or valleys in 3-point chart patterns. 3 points are the only requirements to trade successfully as long as traders have the patience and the discipline to follow the entry and exit rules based on this principle. To cover different markets and trading situations, we have selected 5 examples that are typical of different market segments. Among the 5 sample products are 3 stocks: IBM, Deutsche Telekom, Intel, 1 cash currency, Japanese yen, and a stock index future, DAX 30 index. They all can be analyzed in a similar manner. IBM sample trade. Our first chart example is IBM. We show the breakout out of a rectangle. Once we have entered the market, it is important to predefine a point at which the position has to be closed. In the end, we are looking for 2 exit levels, one in negative territory and one in positive territory. Our entry rule, based on the rectangle, is filled at a price level of $74.30. If we double the width of the rectangle, the simple rule leads to a profit target level of $82.50. Figure 6.24 shows the IBM trade for entry rule, stop loss rule, and profit target rule based on a resistance line in double width distance from the rectangle. Figure 6.24 IBM chart from 0402 to 1102. Sample trade. The sample trade makes our trading approach clear. We are looking for safe entry signals with a profit target that has a high probability of being reached. A rectangle is shown on the chart as a common 3-point pattern and is easy to recognize. Deutsche Telekom sample trade. Figure 6.25 deals with the German large-cap stock Deutsche Telekom. When the descending triangle is broken at €9.80, the resistance line at €13 defines the profit target. The resistance line runs parallel to the support line at €8.25. The short-term trader closes the position and takes a profit at €13. This represents a profit of about 30% in a short period of time. Figure 6.25 Deutsche Telekom chart from 0102 to 1102. Sample trade. If we double the distance from the significant high on the triangle line in August 2002 to the lowest low of the descending triangle in October 2002, the next important profit target can be precalculated at a level of €17.55. It is interesting to observe that the profit target resistance line at €17.55 is almost identical with the two significant peaks that were formed between February and April 2002. However, we can also draw a resistance line at €16.25 based on the peaks and valleys in January and April 2002. Which of the two resistance lines is the correct one, future price action will show. Most likely, market pricing will come up with a trading range between the two resistance lines. Intel sample trade. In our third chart example, Intel, we start with a sell signal out of a rectangle that is broken to the downside, as shown in figure 6.26. The profit target at twice the width of the rectangle is also the lowest low of the downtrend. Two buy signals are possible. The first buy signal can be generated at a price level of 15.15 United States cents when the resistance line of the descending triangle is broken. The second buy signal stems from the peak that penetrates the resistance line of the rectangle at the price of 16 United States dollars and 40 cents. Figure 6.26 Intel chart from 0102 to 1102. Sample trade. Within a couple of weeks, the profit target, which is the upper resistance line of the rectangle, is reached at 19 United States dollars and 89 cents. The short-term trader takes a profit of about 20% measured on the entry price. In a long-term perspective, an alternative strategy for maintaining accumulated profits is to hold the position until a trailing stop is triggered. If we double the width of the rectangle again as we did before, we would come to a second profit target level at 23 United States dollars and 50 cents, which is a powerful and optimistic projection of the trading potential of the Intel stock. Japanese yen cash currency sample trade. In the Japanese yen cash currency, a symmetrical triangle is broken to the upside at 118.90. The short-term oriented trader realizes a quick, but solid profit once the market price penetrates the high of the symmetrical triangle at 121.40. In a long-term perspective, we can calculate two profit targets. The first one is the resistance line at 125.50, based on the chart pattern in May and June 2002. The second profit target is at 127.16, that is, twice the height of the symmetrical triangle. Figure 6.27 shows the long trade in the Japanese yen cash currency and the corresponding stop loss and profit target levels. Figure 6.27 Japanese yen chart from 0302 to 1102. Sample trade. The experienced trader not only looks at the profit targets, but also carefully observes the overall picture. At the point where the first profit target is reached, we find a chart formation of an ascending triangle. We may wait for the second profit target, but more importantly, we may reverse our position and buy Japanese yen against US dollars prior to triggering the second target price as soon as the support line of the ascending triangle is broken. DAX 30 Index Sample Trade. Our final chart example, the DAX 30 Index, illustrates once again the symmetrical movement of market prices in stocks, stock index futures, cash currencies, and other trading vehicles. Figure 6.28 shows three market entries in the DAX 30 Index as of September and October 2002. The first market entry is short, as in the previous Intel example. After reaching our target price short, we find two options for establishing a long position. Figure 6.28 DAX 30 chart from 0302 to 1102. Sample trade. The market entry short occurs when the level of 3252.00 points in the DAX 30 index, i.e., the support line, is broken. Doubling the width of the rectangle points at a price target at 2572.00. The lowest low of the price move can be found at 2536.00. The first buy signal can be generated when the resistance line of the symmetrical triangle and the lowest peak are broken at a price level of 3000.00 points. Traders with the discipline to execute a buy signal at this price level can liquidate the position at the first resistance line at 3252.00. The alternative, second buy signal, is at 3330.00 after the breakout of the market price at the resistance line. The new profit targets are at the price levels between 3908.00 and 3938.00. The first price target at 3908.00 is the resistance line of the rectangle already used to calculate the sell signal. The second price target at 3938.00 is twice the distance from the valley at 3000.00 to the peak at 3461.00. We can use this chart pattern because it has formed three valleys at the bottom. We do not use the distance between the low at 2536.00 and the high at 3330.00 for the calculation because the price target would be at 4099.00. This is a good example of price clusters formed by a resistance line and a Fibonacci price target being better qualified than those based exclusively on the Fibonacci ratios. What this example also shows is that with the rotation of the market price, there is also a rotation between support and resistance lines. What is the support line when we get a sell signal becomes the resistance line once the market price changes the direction and moves up again. Summary: is finding a good entry point easier than knowing where to sell? Most traders have a problem being consistent in their investment strategy. Long-term profit targets mean big swings and big stop losses. Short-term profit targets mean smaller profits and smaller stop losses. A strategy with big profits at a small stop loss risk does not exist, even though everybody would like to have it. In this section, we introduced a concept that suggests when to liquidate an open position. What makes trading with resistance and support lines so valuable is that they adjust dynamically to different swing sizes and work for entry and exit signals as well if the trader has the discipline to follow the trading rules. There are two ways to work with profit targets. The first way is to generate an entry signal when the market price breaks out of a trading range, such as a rectangle. The profit target is then twice the height of the rectangle. The second way is to generate the entry signal out of a trend line such as a symmetrical, ascending, or descending triangle. If the entry signal is close to the support line, the profit target is the resistance line, and vice versa. As shown in the examples, getting to the first profit target can happen very quickly. Traders must decide whether to take the small, fast profits or stay longer in a trade and wait for the second profit target line. In strong bull or bear markets, staying longer in a trend makes a lot of sense. However, in sideward markets, taking profits a little earlier is the better strategy. Traders must determine what sort of market condition they are trading in and adjust their profit-taking strategy accordingly. Phi ellipses. Several ellipses are available on different charting tools. We call our trading tool the phi ellipse because it is a transformation of the original formula of the ellipse used in geometry. The phi ellipse is ideally suited for trading because it incorporates different Fibonacci ratios and changes its form dynamically, bigger, smaller, thinner, or thicker, based on these ratios. The phi ellipse is protected by a trademark and cannot legally be copied. Phi ellipses on daily data. As described in detail in Chapter 5, the basic structure of phi ellipses is always the same, even though they can be thinner or thicker, shorter or longer depending on the market situation. The strength of phi ellipses is that they can be dynamically adjusted to any price move, as long as the required peaks or valleys are available. There are two ways to work with phi ellipses. The first way is to analyze a trending market. If the market is going down, we are looking for a buy signal. If the market is going up, we try to find a sell signal. In short, we are looking for turning points counter-trend to the market action. The second option is working with phi ellipses that are placed horizontally on the chart. In these cases, we are looking for breakouts either up or down out of the phi ellipse. In other words, we get trading signals in the direction of the market trend. Phi ellipses counter-trend. We can draw 5 ellipses if we have at least 3 points, the starting point and 1 point on either side of the 5 ellipse. Because 5 ellipses can only be drawn after a 3-wave price swing, 2 impulse waves and 1 corrective wave, the second impulse wave has to be at least as long as the first impulse wave. In most cases, the longer the 5 ellipse, the stronger is the price correction if we analyze the end of the market swing correctly. This is why products like the S&P 500 Index, Nasdaq 100 Index, DAX 30 Index, DJ Euro Stocks 50 Index, cash currencies, or financial futures with high volatility and big price swings can be best traded with the 5 ellipse. Once the first 5 ellipse can be drawn based on a 3-swing price pattern, we still might not have found the final form of the 5 ellipse. Although we have chosen the starting point and 2 side points correctly, the final form might be longer or shorter, thicker or thinner. To solve this problem, we combine 5 ellipses with 3-point chart patterns and candlestick patterns. We can also anticipate the final point of the 5 ellipse with support and resistance lines, or with Fibonacci correction levels and extension levels. We have explained Fibonacci ratios, candlestick charts, and 3-point chart patterns in detail in the previous chapters to help interested traders find suitable combinations for entry rules that lead to higher profits at controlled risk. The following examples are typical of profitable combinations of 5 ellipses, candlestick patterns, and 3-point chart patterns. The selected charts can only be reworked by using the free WINPHI program that accompanies this book. Traders who want to test our strategies online and/or intend to develop their own strategies based on our recommendations can find an excellent analysis platform at www.fibertrader.com. Our first example of a 5 ellipse trade countertrend in combination with candlestick charting and regular chart patterns is on the S&P 500 index between May 2002 and November 2002. See Figure 6.29. Figure 6.29 S&P 500 chart from 0502 to 1102. Sample trade. After the first impulse wave from point 0 to point 1 and the correction from point 1 to point 2 are finished, we can draw a 5 ellipse as soon as the market price in wave 3, the second impulse wave, goes higher than point 1. The 5 ellipse has its starting point at 0 and its 2 side points at 1 and 2. While the market price moves higher, we try to find the final point of the 5 ellipse. The first sign that the price move is slowing down becomes obvious when the market price moves out of the 5 ellipse. The sell signal can be analyzed as follows. The market price moves out of the 5 ellipse. A wedge chart pattern confirms the end of the market trend. A candlestick engulfing pattern confirms the sell signal when the market price breaks out of the support line of the wedge formation. The profit target is set to 50% of the total swing from the starting point 0 of the 5 ellipse to the highest high of the market movement. The stop loss is placed at the peak before the short entry. The strong price movement to the downside leads to a solid profit on the position. A buy signal in the S&P 500 index shows up just 2 months later. See Figure 6.30. Figure 6.30 S&P 500 chart from 0502 to 1102. Sample trade. We start the 5 ellipse at point 0. The 2 side points of the 5 ellipse are at Valley 1 and Peak 2. Our primary goal is to define a market entry long once the final point of the 5 ellipse is reached and the market moves out of the 5 ellipse. We conduct the analysis according to the following parameters. A candlestick engulfing pattern confirms the trend change after the breakout of the 5 ellipse. A 2-day high breakout after the double bottom formation confirms the trend reversal. Additionally, the first profit target is at the resistance line at 875.00. The second profit target is marked by the resistance line at 925.00. After the breakout of the trading range between 875.00 and 925.00, doubling the size of the trading range leads to a third profit target at 976.00. The stop loss point is at the valley before the buy signal. Figure 6.31 provides us with a third trading example, this time on the Japanese yen cash currency between March and November 2002. Figure 6.31 Japanese yen chart from 0302 to 1102. Sample trade. The buy signal stems from a breakout out of a symmetrical triangle, which is also the beginning of wave 3, the second impulse wave of the market move. While the market moves higher, the sell signal is based on the following rules. Point 3 in figure 6.31 marks the final point of the phi ellipse. The market trend stops at the resistance line. A symmetrical triangle is formed that has its apex almost at the high of the phi ellipse. We sell short when the support line of the symmetrical triangle and the outside line of the phi ellipse are broken. The profit target is at 50% of the swing size from point 0 to point 3. The stop loss is placed at the peak before the sell signal. Finally, the Deutsche Telekom stock provides a striking chart example of trading tools in combination. See figure 6.32. Figure 6.32 Deutsche Telekom chart from 10:01 to 11:02. Sample trade. The most interesting trading signal on the Deutsche Telekom chart is the fourth one, the long entry EL4. The buy signal is based on a clear set of rules. A perfect phi ellipse can be drawn circumventing the market move from points B to D. We find a double bottom formation at point D. The second bottom is located at point A. Point D is also the head of an inverted head and shoulder formation. We enter the market long on a breakout of the outside line of the phi ellipse, which at the same time is a breakout of the peak between the head and the right shoulder of the head and shoulder chart formation. The profit target is triggered at the resistance line, which is defined as the parallel line to the support line running from point A to point D. The stop loss is placed at the most recent valley before the long market entry. The countertrend trading signals based on phi ellipses in various combinations with candlestick patterns and/or regular chart patterns have come out perfectly. It is just a small step to turn the approach upside down and analyze market entries at the final points of phi ellipses in the direction of the main trend. Phi ellipses in the main trend direction. At least as important as countertrend phi ellipses are those phi ellipses that can be traded in the direction of the main trend. All phi ellipses that trade with the direction of the trend have an almost horizontal position. Sideward patterns are often difficult to detect, and these horizontal phi ellipses are valuable because they make such patterns visible. The goal in trading horizontal phi ellipses is to participate in small price swings with a high number of profitable trades at controlled risk. However, many traders discover that this kind of trading demands higher discipline to execute the trading signals because higher slippage and commissions can take away much of the profit potential. In general, what makes phi ellipses relevant trading tools for sideward markets is that they can be adjusted dynamically to different sideward patterns. This is where most traders lack a trading tool. The phi ellipse shows not only how far a sideward market might go, but also where the stop loss level and the profit targets are. We have designed stop loss and profit taking rules by ourselves, and there is no reason other traders cannot come up with profitable solutions that suit their personal needs. We provide a few chart examples to illustrate how to apply horizontal phi ellipses in a profitable manner. We start with the S&P 500 index between May and November 2002, see figure 6.33. The phi ellipse in figure 6.33 surrounds a chart pattern that shows a significant peak at 965.00 and two significant valleys at. Figure 6.33 S&P 500 chart from 0502 to 1102. Sample trade. 875.00 and 868.00. Basic requirements for a countertrend phi ellipse are a starting point and two side points. In contrast, since we lack a starting point on horizontal phi ellipses, basic requirements for phi ellipses in the direction of the main trend are peaks and valleys on the upper border, lower border, or median line of the phi ellipse. The most important factor to watch while working with horizontal phi ellipses is that the phi ellipse is locked in, meaning that it cannot be moved higher or lower anymore. It is the constellation of peaks and valleys that gives stability to a horizontal phi ellipse. In our S&P 500 index example, we get overall stability through the two peaks in the middle that touch the median line of the phi ellipse. A sell signal is filled in the S&P 500 index once the support line of the phi ellipse is broken. The profit target is twice the distance between the peak at 965.00 and the valley at 868.00. The new resistance line is identical with the low of the price movement at 771.00 points where we take our profit. The stop loss is placed at the peak before the sell signal. A couple of horizontal phi ellipses can also be seen in figure 6.32. Long entry EL4 was discussed earlier. The two short entries ES1 and ES3 and the long entry EL2 are the ones that we focus on in this section. The first short entry is based on a phi ellipse locked in with three peaks on the upper side, one peak and one valley on the median line, and one valley at the lower side of the phi ellipse. Incorporated in the phi ellipse movement is also a symmetrical triangle. When the valley at the border of the phi ellipse is broken, we get filled on our sell signal. The profit target is reached at twice the width of the phi ellipse. The stop loss is placed at the peak prior to the sell signal. The first long entry is based on a very small phi ellipse. Although most traders might think such a small phi ellipse would not be significant enough for trading, it demonstrates that phi ellipses can be dynamically adjusted to bigger and smaller price moves. The phi ellipse in question gets its stability from two peaks on the upper border and two valleys on the lower border. The buy signal is executed when the upper border of the phi ellipse is broken. The profit target is twice the total width of the phi ellipse. The stop loss is at the valley before the market entry. The phi ellipse on which the second short entry is based gets its stability from two peaks touching its upper border, two peaks touching the median line, and one valley touching the lower border. The peak-valley configuration gives a unique form to the phi ellipse. Any other ellipse would not completely surround the market move. The sell signal is filled on a sharp breakout of the phi ellipse to the downside. The profit target is twice the total width of the phi ellipse. The stop loss point is at the peak before the short entry. To help readers follow our explanation and description of trading signals most easily, Figure 6.34 shows the Deutsche Telekom chart again. Figure 6.34 Deutsche Telekom chart from 10:01 to 11:02. Sample trade. Before we discuss phi ellipses in combination with candlesticks and our 3-point chart patterns on an intraday basis, we want to present a final striking example of horizontal phi ellipses as a tool to invest short-term in the direction of the main trend. The product in this example is the stock of US chipmaker Intel over almost 2 years between December 2000 and November 2002, as shown in Figure 6.35. Figure 6.35 Intel chart from 12:00 to 11:02. Sample trade. 5 sample trades show up on the chart, 4 short trades and 1 long trade. The first short trade is based on a phi ellipse that has 4 peaks on its upper border and 4 valleys on its lower border. The sell signal is executed when the lowest valley is broken. The profit target is calculated by doubling the total width of the phi ellipse. The stop loss is placed at the peak before the sell signal. The second short trade is based on a rare example of a phi ellipse with one peak in the middle on the top border, 3 valleys touching the median line, and 3 valleys on the lower border. The sell signal is filled when the lowest valley is broken. Shortly after the short entry, the market price reverses, but does not trigger the stop loss point at the peak before the sell signal. The profit target is reached after 3 months at the target price, pre-calculated by doubling the total width of the horizontal phi ellipse. To generate the third short signal, we can identify 3 peaks on the upper border of the phi ellipse, a peak and a valley touching the median line, and 1 valley on the lower border. Once the valley on the lower border is broken, we get a sell signal. The stop loss is placed at the peak before the sell signal. The profit target is calculated by doubling the width of the phi ellipse. The last of the 4 short signals is based on 2 peaks on the upper border, 2 valleys on the lower border, and a single peak touching the median line of the phi ellipse. We get a sell signal on a breakout of the lowest valley. The stop loss point is at the peak before the sell signal. In this case, the profit target is not reached. The stop loss is not triggered, either, so the position is reversed as soon as the only long signal in our Intel example shows up. The long sample entry is based on a phi ellipse with a steep slope to the upside. As explained in Chapter 5, we can get a buy signal on a breakout of the phi ellipse to the upside if we use an entry rule saying that we buy at the high of the day at which market pricing breaks out of the phi ellipse. As our selected examples have made clear, horizontal phi ellipses are ideal tools for short-term investments in the direction of the main trend on a daily basis. Moreover, horizontal phi ellipses are also the link between daily chart analysis and intraday analysis. Summary. In this chapter, we combined the three concepts of candlestick charting, Fibonacci trading tools, and three-point chart patterns. While each concept by itself is very interesting for a trader to work with, we were able to show by combining them that the number of trading signals is reduced and at the same time chances of profitable trades are increased. The biggest problem while working with the phi ellipse by itself is to determine its final point. We can draw a phi ellipse when we have 3 points, the starting point and 2 side points. While we always need to have a 3-wave price move to draw the phi ellipse, the second impulse wave in a 3-swing price pattern has to be at least as long as the first impulse wave. Once we can draw the first phi ellipse, it will very rarely have its final form already, for it will dynamically adjust to the price pattern in the future. It can be longer or shorter, thicker or thinner. In order to identify the final form of the phi ellipse and with it the entry price of a new position, we can combine the phi ellipse with, for example, a phi channel line, which is the outside line parallel to the median line of the phi ellipse. We can also combine the phi ellipse with candlesticks or three-point chart patterns. We can also anticipate the final point of the phi ellipse with support and resistance lines of Fibonacci corrections or extensions. We have shown on different examples practical applications of the combination of phi ellipses with candlesticks and chart patterns. All examples show that by means of combining the trading tools, entry and exit points can be better defined. In addition, profit targets and stop-loss points can be better determined. We have presented a selection of stocks, stock index futures, and cash currencies to demonstrate that almost any product can be analyzed based on a combination of these trading tools. It does not make any difference whether we look for long or short signals on weekly, daily, or intraday charts. Working with combinations of candlesticks, Fibonacci trading tools, and three-point chart patterns means that we are most of the time not invested. We have to wait for patterns to develop and may enter the markets according to the signals generated by the analysis as soon as the setup is completed. Once we have a signal, we can pre-calculate the profit target and the stop loss right away using the same trading tools. Following this approach, the percentage of profitable trades is very high at limited risk. An estimate of the percentage of profitable trades in chart patterns can be identified by looking at the scoreboard shown in Table 4.10. The biggest problem for a trader is having the discipline and the patience to wait for the combination of the three trading concepts to develop and then not hesitating to act once a signal shows up. The combination of the three trading concepts can be used to generate counter-trend signals to buy long at the bottom or sell short at the top of the phi ellipse. In these cases, the phi ellipse has either a slope upwards or downwards. The other option is to work with horizontal phi ellipse to analyze a sidewards market. In this case, we are trading with the trend direction. We buy when the market price penetrates the outside line of the phi ellipse on the upside and we sell short when the market price breaks out of the downside. To fine-tune the entry signals based